Much awaited CA Interlaw exemption oriented mega marathon is here. Just wait a minute. Having resources alone doesn't give you marks. You have to utilize them properly. And in this introduction to marathon, I'm giving you instructions which you have to follow them. Then only you can score maximum marks. You can even score exemption. Trust me. First of all, this marathon is applicable to May 26, September 26, Jan 27 examinations. The total duration of this marathon is 26 hours. If you see my earlier marathons, my main focus is covering all the concepts. But in this marathon, I covered all the concepts. Before each and every chapter, I gave sections chart and I narrated a story to remember these sections also. And also, very recent examinations, very recent past 3 to 4 examinations, how ICA twisted the concepts. Yes, I decoded all the things. And I also gave some tips, how ICA is going to ask questions. See, most of the examinees fail because of surprise element in the examination hall exam paper. So that surprise you are going to bypass after listening to this marathon. Trust me. This marathon of 26 hours is divided into 3 parts. Part 1, Part 2, Companies Act. Part 1, 10.5 hours, weightage 35 marks. Part 2, 6.5 hours, weightage 35 marks. And Part 3, Other Laws and LLP, 5.5 hours, weightage is 48 marks. You can see here Part 1, Prospectus, Incorporation, Deposits, Charges, MGT, Dividends. Part 2, Share Capital, Accounts of Company, Audit and Auditors, Foreign Company, Preliminary. And Part 3, LLP, FEMA, General Clauses Act, Interpretation of Statutes. My suggestion, watch LLP and Foreign Company after completion of all other topics of Companies Act, because you'll find a majority of the provisions that are there in other chapters of Companies Act. Similar provisions you will find. These two are not a new concepts, they are just byproduct of all other chapters of Companies Act. So watch these two chapters after completion of all other chapters in Companies Act. Clear? And throughout this marathon, I used my master notes. You can download it in Shrestha website, Shrestha for CA and CMA. Just go through the free resources tab. Here, CA Inter, P2, Corporate and Other Laws, DV Subramaniam sir. Just click on it. You'll find my master notes, you'll find my question bank, and you'll find my running notes. Master notes. So this is of just 220 pages. All the important words were highlighted, technical words were highlighted, and after completion of each and every lecture, after completion of each and every chapter, go through my question bank. This question bank is compilation of all MTPs, past 6 attempts MTPs, RTPs, and previous examination papers. So once you finish watching the chapter lectures, if you go through the question bank, you will assess yourself to what extent, you will gain confidence. Automatically you will gain confidence. If you are able to solve many questions, almost all the questions, your confidence levels almost will be good. And for moderate topics, I used my handwritten notes. This is my handwritten notes. You can download this from the same website. Clear? So master notes, question bank, and running notes. And sir, suggested speed for watching these lectures. My suggestion, standard speed is enough. 1 is enough. But if you are someone who are able to grasp concepts very quickly, you can watch them at 1.25 speed. But don't go beyond that. Why? Because at 1.5 or at 2, you will hear, but you can't retain the concepts for long duration. You may listen, but you can't retain them. And one more point, sir, directly I'll jump into one section, sir. I'll skip one section, I'll jump into another section. No, every concept is interlinked. Why? Because you see case scenario, multiple choice questions. So some mixture of 2-3 chapters they are asking, mixing some 2-3 chapters they are asking 3-4 MCQs. And most importantly, LLP FEMA General Clauses Act. LLP FEMA General Clauses Act. Compulsory case scenario questions are coming from this chapter. So don't take risk. Don't take this chapter's choice. Is it clear? So I wish you very, very all the best. Continue watching this marathon. Take care. Our next topic for marathon is share capital and debentures. If you look into the previous examination papers, 5 to 10 marks will come from this chapter. Reason, this chapter is having 30 sections and wide variety of topics are there. Of course, every company to run need finance. That finance is of two types: own finance, debt finance. Own finance is nothing but equity share capital. Debt finance, debentures, deposits. Debentures is for longer duration. Deposits is for shorter duration, that is max 3 years. Debentures is for 10 years. So the management of this own finance and debt finance is totally taken care by finance managers. Clear? But our role with respect to these concepts is conditions, procedures to be followed for issuing these shares. Clear? So section 43 to 72, but if you observe, all these 30 sections are divided into 4 parts. Initially 2 parts: share capital, debentures. You can see on the screen, share capital 43 to 70, debentures 71. Both had a facility called nomination, section 72. Nomination facility, like 1% company we have seen. In OPC, nomination is mandatory. Clear? Here also you have to fill up the form, nomination form. That means if something happens to the member, nominee will become member of that company. Clear? Nomination facility 72, not there in our syllabus, you can ignore. Now share capital, 4 parts. How many parts? 4 parts. BIT, 3 parts. Basics, issue, transfer. BIT, 3 parts. And the last part is alteration. Last part is alteration. Simply BITA. B stands for basics, I issue, T transfer, A alteration. In basics, first you need to know about kinds of share capital. You know, we are having 2 kinds of share capital: equity, preference. Types are different, kinds are different. Types means authorized share capital, issued share capital, subscribed share capital, paid up share capital. They are types of share capital. As per law, kinds of share capital means equity and preference. We are having 2 kinds. And what is the nature of share? Is it movable or immovable? Movable. That is section 44. Each and every share should be numbered, distinctively numbered. Like if you see 500 rupee note, my 500 rupee note will have some serial number, your 500 rupee note will have different serial number. Each and every share shall be numbered, 45. And you will find all these 3 in a certificate called share certificate. This is a document showing title. And because of holding this share certificate, person will have 2 rights: voting rights, dividend rights. Any right to be changed, we call it as variation. This is a story to remember sections. Okay, basics, kinds, nature, numbering. These 3 you will find in share certificate. Holding share certificate, you will get some rights and obligations. Rights means voting rights. Sometimes these rights may be varied, variation of rights. Obligations: whenever company make calls on shares, you need to pay call amount. You can also pay extra call amount, that is calls in advance. And for calls in advance, there will be no extra dividends. Understood? Basics over. Basics over. Kinds to dividends. From this basics, the important concept is duplicate share certificate in section 46 and differential voting rights section 43. But 2 times variation of rights also tested. 1 time calls on shares, calls in advance, dividends. These 3 points were tested for 6 marks 1 time. Once basics is done, issue. You can issue shares at a premium or you may issue shares at a discount. And you can also issue preference shares 52, 53, 54 and 55. For discount, issue of shares at discount is void, 53, but we had an exception, sweat equity, 54. Whereas issue and redemption of preference shares is taken care by 55. I completed. Basics over, issue over. Next one, transfer. In 44 I told you shares are movable in nature, so they can be transferred. 56. Transfer at par. Remember, transfer at par. P stands for personation, A stands for appeal, R stands for rectification. So personation 57, appeal 58, rectification 59. Transfer also over, 56 to 59. 56 to 59. Transfer at par. Next one, alteration. First, this is the original share capital. You can publish that original share capital. You can change the capital. Changing the capital is of 2 types, either increase, reduce. Once you increase the capital, you can issue those shares per money or at free of cost. Free of cost means bonus shares 63. For money, if you are issuing shares, 62. But these two incidents shall be reported to ROC, that is section 64. Coming to reduction, reduction is of two types: reduction of liability, reduction of capital. 65 is not there in our syllabus. Reduction of capital. This reduction of capital is also of two types. One is internal reconstruction you did in advanced accounting, that is section 66. So loss making company will do internal reconstruction 66. Profit making company may buy back its shares, that is 68. So with respect to buyback, we had 3 points: restrictions, conditions, CRR, prohibition. Restrictions on purchase of its own share 67, conditions for buyback of share 68, creation of CRR 69, prohibition of buyback 70. Total 30 sections. Total 30. We can't expect a question from which area? All the areas are, some areas are simple, some areas are important. From simple areas they may ask question, from important areas they may ask a question. There are some attempts, like 10 attempts I still remember, there is no question paper without bonus issue and buyback, either bonus issue or buyback. But recently trend changed. I say tagline, it's very simple: expect from unexpected areas. What? Expect from unexpected areas. So everything is important. So now share. Share means share in the share capital of the company. It includes stock. Share means share in the share capital of the company. It includes stock. What is the difference between share and stock? Share is a unit of share capital. 1 share, 2 share, 3 share. But stock is a bundle of shares. Previously, when Demat was not that much popular, shares were available in lot system. Like one lot may be 100 shares, one lot may be 200 shares. If you want to buy, you can't buy 50, you can't buy 60. You need to buy one lot. So transferability point of view, there is some difficulty. Oh my God, if I want to become a member of the company, I need to buy one lot. For sure, I need to buy one lot. That means 100 shares. Whereas stock, it is available in fractions also. You can buy 5% stock, you can buy 2% stock, you can buy 1% stock. Transferability point of view, stock is better than shares. But right now, because of demat form, shares are available in one number also. Lot system was removed. If you know about futures and options, F and O, lot system is there. Like one lot equal to 2950, 1475, that lot system is there. Previously for shares, that concept is there. So transferability point of view, that time stock played a crucial role. Right now stock is also an outdated concept. The difference, shares can be partly paid up, but stock should be fully paid up. No company can issue stock directly. First it will issue shares. Only fully paid up shares can be converted into stock. These are the differences. I think under old syllabus, one time they tested the differences. They didn't ask the differences. They asked, can a company convert partly paid up shares into stock? And the answer, company cannot convert partly paid up shares into stock. Only company can convert fully paid up shares into stock. These are the differences you can see. Stock is stated a lump sum, whereas share is the smallest unit. Originally, shares are issued to the shareholders, while in case of stock, fully paid up shares can be converted into stock. Thus, stock is not issued originally. It is obtained by converting fully paid up shares into stock. Next one, equity share capital kinds. We are having two kinds of equity. Share capital is of two kinds: equity, preference. Equity, very simple definition ma. Any capital other than preference share capital is equity share capital. It is of two types: ordinary shares, differential voting rights, differential rights. This differential rights I'll discuss with you next point. Don't worry. Now preference shares. Preference share capital means it is a capital which carry preferential rights. One is dividend payment, the other one is repayment of the capital. Dividend payments or repayment of the capital. Sir, both compulsory. Either one satisfied, it becomes preferential capital. They should be given preferential treatment, priority. That priority may be with respect to either dividend or with respect to redemption of capital, or both. Any one condition satisfied or any one right is there, it becomes preferential capital. Now you tell me, can a company directly issue preference shares without issuing equity shares? No. Why? At least for priority purpose, equity share capital should be there. Logically, preference shares are not irredeemable, they are redeemable. That means it is not a permanent capital, but company should have a permanent capital. That permanent capital is equity. See, many financial analysts told that equity capital is like an oxygen, whereas debentures is like a energy booster drinks. We need both. Without oxygen, we can't survive. Completely, we can't dependent on oxygen only. We need some nutritional, energy booster drinks. So that is what, according to one financial analyst, the differences between equity and debenture. Nice narration. Fine. Next one. Preference shareholders may participate in equity pool post preferential allotments. Such preference share capital is known as participative preference shares. Generally, after payment of preference dividend, after payment of equity dividend, balance amount will be given to equity shareholders only. Yes or no? Whatever earnings that was retained by the company, that amount belongs to whom? Equity shareholders. Along with equity shareholders, if preference shareholders are also getting participation rights, then such preference shareholders are known as participatory preferential shareholders. Simply participative preference shares. The only difference between equity and preference is equity is a permanent, preference is a temporary. This is normal. But who is the risk taker? Equity. In case of liquidation, who will be given top priority between these two? Preference shareholders. First, after redemption of preference shareholders, balance leftover will be given to the equity shareholders. But to find out their rights, whether they are convertible or non-convertible, participatory or non-participatory, next one, cumulative or non-cumulative, you need to go through the terms of the issue and you need to go through the AOA. Generally, preference share capital is to be non-participatory cumulative preference shares. Cumulative means you all know, 1 year dividend we didn't pay, that amount will be added to the next year dividends. Accumulative. Next one, equity shares with differential rights. Equity shares with differential rights. Conditions to be satisfied for issue of equity shares with differential rights. Listen carefully. The conditions are ATOM. What is the condition for issue of equity shares with differential rights? Autumn. A stands for Articles of Association Authorization. T stands for, I'm sorry, just a moment, just a minute. Actually, autumn only, but very recently T was deleted. Some 3-4 years back amendment came. Time limit for to encourage startups. This T time limit was deleted. So therefore, the condition, the cheat code to remember this one is default MOA. Default MOA. Exactly reverse we need to study. A stands for Articles of Association, O stands for Ordinary Resolution, M stands for Maximum Limit. Maximum limit. So AOA authorization is compulsory, and for issuing equity shares with differential rights, OR is compulsory. And if you are a company whose equity shares were listed on recognized stock exchange, then such company ordinary resolution shall be passed through postal ballot. For other companies, you can conduct meeting, at meeting you can pass ordinary resolution. Only for listed companies, OR shall be passed through postal ballot. And maximum limit, voting power of differential rights shall not exceed 74% of the total voting power of the company. Simply voting power from ordinary shares plus voting power from differential rights. If you assume it as 100, the point is voting power from differential rights maximum 74. That means voting power from ordinary shares minimum 26. 26 plus 74, 100. You understood that combination? That mathematical calculation I won't do since it is a marathon. Next one, defaults. If you go through ICA study material, or if you go through these points, 5, 6, 7 points, 5, 6, 7, yeah, these 3 points. No, 4 also you need to cover. 4, 5, 6, 7 points. It becomes clumsy. Let's see. Defaults. I classified defaults into 2 categories. Time defaults, subsisting defaults. Subsisting means at the time of issue of equity shares with differential rights, company should not have these defaults. These defaults company should not have at the time of issue of equity shares with differential rights. Time defaults means prescribed time period you should not have these defaults. Time defaults again classified into 2 categories, 3 years, 5 years. First I will discuss with you subsisting default. That means present defaults. How many are there? 1, 2, 3, 4, 5, 6. What are they? Declared dividend non-payment, preference share capital redemption mistake, debentures redemption default, interest on debentures default, deposits default, interest on deposits default. Sir, how to remember? Tell me sources of finance. Tell me sources of finance. Equity share capital is there. Preference share capital is there. Next one, debentures is there. Deposits is there. And term loans are there. Total 5 sources are there, right? First 4 you write under subsisting. Last term loan you write it under 5 years. Over, matter over. First 4 means with respect to equity share capital, I will do a default with respect to non-payment of dividend. Preference share capital, I will do default in repayment of preference share capital. Debentures, interest on debentures. Deposits, interest on deposits. Sir, preference share capital dividend will be there, no sir. That you write under 5 years. Over. Sources of finance, if you remember, 4 points write under subsisting default, 1 point write under 5 years defaults. So the meaning of this subsisting default means today if you are planning to issue equity shares with differential rights, you should not possess these defaults. Next, coming to 3 years. We are in which financial year? Say for example 26-27. We are in the financial year 26-27. Last 3 years, I repeat, 3 preceding financial years, that means 25-26, 24-25 and 23-24. Preceding 3 financial years, you should not possess these defaults. And these defaults are of 2 types of monetary, non-monetary. Non-monetary means ROC filing, non-filing of financial statements, non-filing of annual returns. Monetary defaults means if you are penalized by RBI, SEBI or under FEMA or under Securities Contract Regulation Act during the 3 preceding financial years, then the current financial year you can't issue equity shares with differential rights. Are you getting my point? See, we are in the financial year 26-27. So go back 3 years. 1, 2, 3, 24, 25, 26, 24, 25, 23, 24. During these 3 years, if you are not possessing these defaults, then you are eligible. Which defaults? ROC filings, penalties. Penalties under 4 acts. Very easy to remember. Money related, RBI, FEMA. Securities related, SEBI, SCRA. Next, 5 years. This 5 years is different. The year of rectification you need to understand. Here, when you committed default is not a matter. When you rectified is a matter. Suppose I committed a default in 15-16, sir. Now 26-27, can I proceed? When you committed is not a matter. When you rectified it. Suppose I rectified it in 21-22 years, sir. 21-22 you rectified. Ignore that year. Wait for 5 years. That means 22-23, 23-24, 24-25, 25-26 and 26-27. These 5 years ban. From 27-28 onwards, you can issue equity shares with differential rates. Sir, what are those defaults? I already told you. Preference dividend, term loans, principal repayments, interest payments. These 2 override. Another 2 is employee statutory dues. And other one is IEPF dues. See, total 3 types of defaults are there. Subsisting, 3 years, 5 years. Subsisting means at present. 3 years means preceding 3 financial years. 5 years means you should not check year of default. You should check year of rectification. After rectification year, wait for 5 years. So those defaults are term loans, interest, preference dividend, employee statutory dues, IEPF transfers. So you should not have these defaults at present, preceding 3 years, upon rectification 5 years. Then you are eligible to issue equity shares with differential rights. Even in our material also it looks very simple. No subsisting default. Dividends, deposits, debentures, preference shares. Deposit interest, debenture interest. And company has not defaulted. This is subsisting. This is not defaulted. Preference dividend, employee statutory dues, IEPF, term loan. But if you see note point, you will understand. Upon expiry of 5 years from the end of financial year in which such default was made good, company may issue differential voting rights shares. And next one, company has not been penalized by the court tribunal in the last 3 years. RBI, SEBI, SCRA, FEMA. And 4th point, if you see, company has not defaulted in filing financial statements, annual returns for the last 3 years. Understood? So if they want to give tricky question, they may narrate a story with this kind of error. Term loan default was committed in the year 2021. However, it was rectified in the year 23-24. Now you need to add 5 years. 5 years to be added to 23-24 or 2021 confusion. That is highly tricky question. Tricky question. Understood? That's it. Next one, existing equity shares cannot be converted into DVRs. Automatic conversion is not there. Automatic conversion is not allowed. The only difference between differential voting rights and ordinary shareholders is voting rights and dividend rights, the most popular topic, most popular example for DVRs is Tata Motors shares. To acquire that land, Land Rover and Jaguar company cars. So Tata Motors, I think in the year 2010, they issued differential rights. The concept is for every 10 shares, one vote will be given. Generally, one share equal to one vote, that is ordinary share. But when 10 shares gives you one vote, this is nothing but differential rights. Promoters will take high voting rights shares, whereas public will take low voting rights shares, because public is not interested in voting. Public is interested in dividends. And the beauty of this share is they get dividend 5% extra. Normal dividend plus 5% extra dividend they will get. Clear? Okay, fine. So register of members include details, DVRs issued with the shareholder details. This is disclosures. Board of directors shall disclose the issue of differential rights in the board report for the financial year in which issue was completed. And exemptions, this section is not applicable to two companies, IFSC companies and private companies. Both IFSC and private companies are not required to follow this section, provided MOA AOA provides otherwise. Suppose if MOA AOA is silent on section 43, then section 43 is applicable to both IFSC companies and private companies. Section 43 is exempted only if the AOA tells that 43 is not applicable to us. Clear? So in this entire, you have to remember these defaults. Default MOA, write it in reverse. AOA authorization or tricky point, listed company conducted general meeting to pass ordinary resolution. Valida? No. Resolution shall be passed through postal ballot. And all these points I already discussed with you. See, differential voting rights holders will also get bonus shares, right shares, but subject to two differential rights. Say for example, I am holding ordinary shares, you are holding differential shares. Tomorrow if company announce bonus shares, you will get differential shares as bonus, I'll get ordinary shares as bonus. There will be no reversal mode, like you getting ordinary, I getting differential shares. It's not allowed. If you are having differential shares, bonus rights also differential only. If I'm holding ordinary shares, bonus rights also ordinary shares only. The only difference between me and you is voting rights, voting power. Next one, share certificate. It's a document showing title. It's a document showing title. It is valid only if it is signed by the two directors. If a company is having MD or whole-time director, one of these two directors should be MD or whole-time director and the other director should be normal director. And if common seal is there, affix common seal. If no common seal, no problem. If company is having CS, then share certificate should be signed by one director and one CS. See, share certificate, director is considered to have signed the share certificate if their signature is affixed. Facsimile methods such as engraving, lithography, digital signing, but not rubber stamp. Share certificates, definitely it will be in thousands of share certificates. Say for example, your CA foundation mark sheet you take, you will find BOS chairman signature. Do you think BOS chairman will manually sign all your mark sheets? It's nothing but lithography or digital signing, not a rubber stamp. While printing only, the signature will come on your mark sheet. Same point here also. Important point is duplicate share certificate. Duplicate share certificate, when will be issued, if original share certificate is lost or destroyed, or if it is defaced, mutilated or turned into two pieces, for example. Or Diwali crackers, during Diwali festival, half of the share certificate was burnt. That is nothing but defaced, mutilated. Sir, complete share certificate burnt, sir. That means original share certificate is lost or destroyed. So in this case, you need to file an application for duplicate share certificate. Along that, you need to pay a fees maximum of 50 rupees. And company giving duplicate share certificate, it is a duty of company to print on the share certificate, duplicate issued in lieu of so and so original share certificate number, and print it as a duplicate one only. Time limit for issue of duplicate share certificates: if you are an unlisted company member, you will get duplicate share certificate within 3 months. If you are a member of listed company, duplicate will be issued within 45 days. Sir, listed company demat form of securities, no sir, are outdated law maker. as per outdated lawmaker, if equity is listed security, it will be in demat form. What about preference? Suppose preference is unlisted. Preference is unlisted. Should it be in demat form or manual form? Manual form. You lost manual share certificate, preference share certificate. You will get it within 45 days in case of listed company. Exactly double 45 days double, 90 days, nothing but 3 months unlisted companies. And you have to maintain a record. To whom you issue duplicate share certificates, you have to maintain a record. Disclosures are necessary. In case of demat form of securities, depository records will act as a prima facie evidence. Suppose your net worth. In your net worth, you mentioned that cash balance 20 lakhs. If you are having physical cash, I'll come and count, yeah, 20 lakhs tallied. If the 20 lakhs is there in your account, I will ask you bank statement. In that bank statement, if 20 lakhs figure is there, valid only. Similarly, this point also, depository records will act as an evidence regarding your ownership. And manner of issuing certificates, duplicate certificates. AOA authorization. Section 46 overrules company AOA for issuing certificates. So Section 46 will take care of issuing duplicate share certificates. And duplicate share certificates applicable only for physical shares, not for demat form of securities, because demat form of securities, you can't destroy them unless you reduce the number. In case of buyback, they will reduce the number. Prerequisites for issue. What are the prerequisites for issue? Surrender letter of allotment. Under section 39, you file in case of prospectus, you file an application, you got allotted, your application got selected and you got allotment letter. If you submit letter of allotment, you will get share certificate, and that share certificate will be in which form? Form SH1. Sir, what about these fractional coupons, sir? Fractional coupons, for example, company announced bonus shares, the ratio is 1:10. What is the ratio? 1:10. For every 10 shares you are holding, 1 bonus shares will be given. Suppose if you are holding 9 shares, can company give you 1 full share for 9 shares? No. There you will get a 90% coupon. There you will get a 90% coupon. And you need to search for another fractional coupon of 10%. Suppose I am holding 1 share, I'll get 10% coupon. If I sell it to you, now these fractional coupons, 90 plus 10, how much it will be? 100. You will get 1 complete share. Either surrender letter of allotment or surrender fractional coupons, you will get complete share certificate. In that share certificate, you will find names of the shareholders, number of shares held by you, and amount paid upon each and every share. And recording of details, everything will be updated in the register of members. See, if you are having 500 rupee note, I will check the serial number whether it is valid or not. If the same 500 rupee note is there in your bank account, will I ask what is the denomination of that 500? Can I ask you serial number? That's what, demat form. Next one, maintenance of share certificate records. This is important point, All records shall be maintained at least 30 years and permanently in case of disputed cases. All the records shall be maintained at least 30 years and permanently in case of disputed cases. Next one, blank form. Sir, what is this blank form? If you go to a bank, withdrawal form, deposit form, all those are blank forms only, right? So company will also have blank share certificates. So once company receive letter of allotment, or once company receive fractional coupons, or once company receive transfer agreements, company will make printout on the blank forms, serially numbered and printed. Surrender certificate shall be defaced, that means cancelled, and can be destroyed after 3 years subject to board resolution in presence of duly authorized person. Sir, why one will surrender certificates? A little bit concept is there. Images. See, this is a share certificate image, This is a share certificate image. So blank form only will be there, and it will be printed whenever company receives allotment letters. If you see, this is a partly paid up share, maybe where it is, yeah. It is a partly paid up share because paid up per share is 5, and to be paid on allotment, how much? 5 rupees is there. Until then, this is a partly paid up. When you pay complete amount, company will take back this share certificate, and company will issue new share certificate. So you giving share certificate to company is nothing but surrendering share certificates. Once company receive this surrender, once company these certificates, they must be destroyed within 3 years. That is the point. Getting my point? Next one, punishment. This is also important point. If duplicate certificates were issued with an intent to defraud, Haridas Mudra, one fellow is there, stock market broker, and he did a big scam of issuing duplicate certificates. Duplication. Like you might have heard about, money got duplicated, fake currency, right? So if share certificates got duplicated intentionally with an intention to defraud, then company, what is the fine? Minimum 5 times of the face value of shares involved. Suppose 1 crore, suppose 10 lakhs, for example, 10 lakhs face value of securities got duplicated. 10 lakhs into 5, minimum fine 50 lakhs. Maximum 10 times of 10 lakhs means 1 crore. Statutory limit 10 crores, whichever is higher. And for officer in default 447. If accident happens, ambulance will come. What is the ambulance number, vehicle number here? 108 only, right? In Companies Act, wherever fraud comes, vehicle number 447 will come, because criminal liability 447. Punishment to the defaulter, section 36, 447 only, fraud. Personation of security 447. Section 8 company fraud also 447. Incorporation of company by furnishing false information 447 only. So wherever fraud word comes, 447 will be there. And 447 punishment I already discussed with you. Public interest affected, not affected. Not affected, greater magnitude, lesser magnitude. Clear? So with this 43 we completed. 46 also we completed. Next one, voting rights of the shareholders. In the voting rights of the shareholders, you have to remember two types of voting. Show of hands, poll. Show of hands, one member, one vote. Tell me, show of hands, how many votes? One member, one vote. Whereas poll, number of shares equal to number of votes. Suppose I am holding 1 million shares. In show of hands, I can't raise my hand 1 million times. That's why one time only, one member, one vote. But poll, proportionate voting power. See, proportionate voting power means what is the total share capital? Suppose total share capital 10 crores. And I am holding 1 crore share capital. 1 out of 10 means how much? 10%. My voting power is 10%. That is with respect to poll. And the dangerous point, Nidhi company. If examiner want to ask a tough question, he can ask a question on this. MCQ 2 marks question. Read this point. A member cannot exercise voting rights exceeding 5% of the total voting rights. Nidhi companies, the lawmaker intention is there should be no concentration of power in few hands. So let me give you one small example. Nidhi company, total paid up share capital 10 lakhs ma. Mr. A is holding 60,000 shares. Sorry, 60,000. Just wait. Yeah, A is holding 60,000. B is holding 1 lakh. C is holding 25,000. Let me change it. A is holding only 40,000. Yeah, A is holding 40,000 capital. B is holding 1 lakh capital. C is holding 25,000 capital. And D is holding 60,000 capital. Now we need to, all remaining members are holding just 1% of the company's capital only. Now we need to decide the voting power of these 4 individuals. Clear? Chalo. So A 40,000 holding, 40k divided by 10 lakhs means how much it is? 4%. Can he exercise 4% voting power? Yes. B 1 lakh divided by 10 lakhs, how much percentage? 10, but he can exercise voting power only 5%. C can exercise 2.5% voting power. D can exercise 5% only voting power. Sir, 6% is holding. No, sir. In excess of 6%, we will not consider maximum voting right. Each individual, how much? 5% only. It prevents concentration of power in few hands. This one point you have to remember. Nidhi company, there is a restriction on voting power. Max to max, a member can exercise how much voting power? 5%. Next, voting rights of the preference shareholders. You have to remember these 3 points. Preference shareholders will get voting power with respect to the matters affecting their rights. Winding up, reduction of capital. Their rights means what? Suppose 10% preference share capital issued for 6 years time period. Now based on this point, they will get 2 rights. One is every year they are entitled to dividend of 10%. After 6 years they are entitled to 100% of the capital. Now if I want to reduce this 10 to 6%, if I want to increase this 6 to 10 years, tell me, their rights are getting affected or not affected? Getting affected. They will get voting power. And important point is second point. If preference dividend remain unpaid for 2 or more years consecutively, then preference shareholders will also get voting power along with equity shareholders. Many students are having a confusion. Sir, what about this preference share, sir? Whether it is a cumulative or non-cumulative? Forget about cumulative, non-cumulative. Every preference shareholder, whether cumulative or non-cumulative, immaterial. If they are not getting dividends for 2+ years continuously, then along with equity shareholders, preference shareholders will also get voting power. Sir, how much voting power, sir? Very simple. Suppose equity share capital 10 crores, preference share capital 5 crores. Now you need to add it 15 crores. Ask each individual how much they are holding. Suppose Mr. A is holding some 15 lakhs. 15 lakhs divided by 15 crores, 1%. B is holding 30 lakhs. 30 lakhs divided by 15 crores, 2%. That's it. Shareholders vote proportionately to the paid up share capital of their shares class in AGM or EGM. But once preference shareholders were paid their dividends, their voting rates will become 0. Getting my point? And of course, IFSC companies, private companies had a privilege. If their MOA, AOA provides that 47 is not applicable to us, then 47 is not applicable to them. In section 6, I told you, Act overrides MOA, AOA, but sometimes Act will give freedom to the company. You decide whether to apply my section or not, it will give freedom. One such freedom is section 47. Can I proceed? Next one, 48, variation of rights of the shareholders. 5 points. 5 points you have to remember. 5 points. One is, first of all, basic variation of rights. Just now I discussed with you, 10% preference share capital redeemable after 6 years. Now company's financial performance is not good. They are unable to pay 10%. They want to reduce it to 6%. Then I advise the company what to do. Then you have to write this section 48. So reducing rate of dividend means affecting the rights of the preference shareholders. For that, preference shareholders consent is to be taken. How much consent is required? That is a point. Now you need to understand whether postal ballot is applicable or not applicable. If postal ballot is applicable, consent is to be taken from at least 3/4 of the holders of the issued shares. Postal ballot not applicable, sir. You can call for a meeting. Then special resolution is enough. Students think that both are same. No, sir. No. Both are not same. Suppose 100 members are there. Each member is holding 1 lakh rupees preference share capital. Under 3/4 of the holders of the issued shares means 100 into 3/4, that means 100 into 1 lakh means how much? 1 crore. 1 crore into 3/4 means I need to get consent from 75 lakh rupees holders. If postal ballot is not applicable, I can call for a meeting. Suppose in the meeting, out of 100, 20 people came. Out of 20, 16 gave vote in favor, only 4 gave vote against. Special resolution passed or not passed? Yes, because 3 times of the votes against is there, votes in favor. Special resolution is said to be passed. Which one is easy? Special resolution at meeting is easy, but it is decided by postal ballot. Section 110 I will discuss with you. Section 110. So if postal ballot is applicable, yes, written consent from 3/4 of the holders. No, wrong. It's not 3/4 of the holders. 3/4 of the capital holders. What is the difference, sir? 3/4 of the capital means 75 lakhs. This 75 lakhs may be held by 1 individual, 2 individuals, 3 individuals, or 10 individuals. So here the restriction is not on the number of holders. The restriction is on capital. 3/4 of the capital holders. That means holders of the issued shares. Next one, variation is allowed only when MOA, AOA allows the variation. Sir, suppose MOA, AOA is silent, sir. Then go with issue terms. Like the shares you issued maybe under prospectus or maybe under private placement, right? Go through the issue terms. In issue terms, there should be no prohibition on variation. If there is prohibition on variation, you can't change the terms. Sima, very simple. 2 conditions. First one, check constitutional documents, MOA, AOA. If silent, go with issue terms. Next one, get 3/4 consent. If meeting is possible, get special resolution. So 2 points over. Third point, this point was tested as 2 marks MCQ in September attempt, if I'm not wrong. September attempt. What is this point? If variation affects right of another class, consent of 3/4 of that other class is also required. Suppose I'm having Class A equity shares, Class B equity shares. Class A equity shares, I'm increasing voting power of Class A equity, for example. As a result, Class B voting power will come down. If one variation affecting, variation of one class affecting variation of other class, you have to take permission from both the classes. But first class, either you can take special resolution or 3/4 consent. But other class, consent of 3/4 only. Special resolution, that point is not there. Generally, in regular class, to understand this point, I used to teach like this. One example, suppose differential voting rights is there, ma. Small example I'll tell. Equity shares with ordinary shares, suppose 10 shares are there, ma. 10 shares means each share how many votes? 1 vote. Total how many votes are there? 10 votes. Equity shares with the differential rights also there, ma. 10 shares will give only 1 vote. That means 10 into 1 divided by 10, how many votes are there? 1 vote. Now 10 plus 1, how many? 11 votes. Getting my point? So if you ask me percentage, 1 by 11, that means 0.9%, for example. No, sorry. 9.0 percentage, for example, 9.09 percentage. And equity shares with ordinary shareholders will have 90.1 percentage control. Imagine these equity shares with the differential rights, they get dividend, which is 5% extra. Normal dividend plus 5% extra. Now listen, you will understand this. Suppose if company want to reduce this 5% to 3%, this class people rights are getting affected. Therefore, check MOA, AOA or check issue terms. Check issue terms. Next, obtain special resolution or consent from 3/4 of the capital holders in writing. This is simple. But imagine if company wants to increase voting power of these 10 shares. Instead of 10 shares 1 vote, they want to give each share 10 votes. Each share how many votes? 10 votes. Now after alteration, what happens? Ordinary shares 10 into 1, 10 votes only. Whereas differential rights, 10 shares into 10 votes, it becomes 100. So in total voting power of 110 votes, differential rights holders are getting 90.9%, whereas ordinary shareholders are getting 9.09%. Are you getting my point? Changing rights of one class affecting the rights of other class. Now from both the classes you have to take permission. Understood? And very important, this section is applicable only if company is having more than one class of share capital. If company is having only one class, AGM is better. There should be more than one class. Equity preference. In equity also ordinary shares, differential rights, like that. Next one, dissenting shareholders. Right of dissenting shareholders. Suppose I got 86% consent. For variation I got consent from 86%. And that means how many of them are against to the proposal? 14%. So they are having a right to go to NCLT. They can reverse this variation. For going to NCLT, they must have a status. That status is 10% or more. They can point out this question. They can point out this one, ma. So what would be the status, or what should be the status that dissenting shareholders should possess for filing an appeal with NCLT? And the answer is 10% or more. And what is the time limit for filing an appeal? 21 days. Within 21 days of variation, yes, they should file an appeal with NCLT. And now ball is in the court of tribunal. Tribunal will decide whether variation to be allowed or not to be allowed. And tribunal order is final. Once tribunal passes any order, it should be filed with ROC within 30 days. Communication with ROC. Special points, ma. Cancellation of shares or reduction of capital does not amount to variation. Section 66, 61 we will see. Issuing new preference shares, pari passu. Pari passu means equal ranking. Existing shares and new preference shares will have same rights. It will also not amount to the variation of the rights. It will also not amount to the variation. So in the entire variation, remember, once again I'll repeat 5 points. What are the 5 points? Check constitutional documents, MOA, AOA or issue terms. Get consent. Variation of one class affecting other class. Get consent from other class also. Now dissenting shareholders are having an option to appeal with NCLT. Within how many days? 21 days. How much they should possess? 10%. Suppose I got 99% consent. Now how many dissenting shareholders are there? Just 1%. Can they go to NCLT? No. Now NCLT will decide it. Once NCLT passes any order, file it with ROC. Over. Next, 49 to 51, simple points. 49 to 51, simple points. 49, calls. With respect to calls, one condition. That condition is call should be on uniform basis. Call should be on uniform basis. That means, suppose I like this group and I don't like that group. Both are holding same class of shares. So to this class, fixing call amount as 1 rupee. To that class, fixing call amount of 4 rupees. Allowed or not allowed? Not allowed. Entire class, one call amount only. Call should be on uniform basis. Call should be on uniform basis. Shares of same nominal value but with different paid up amounts do not fall under same class for uniform calls. If you see Tata Motors, ordinary shares, differential shares, both face value 2 rupees only. Both face value 2 rupees only. Sir, simply face value 2 rupees, no. I mean nominal value or face value. Face value matching. Can I call these two shares as same class of shares? No, 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 no. You need to go through the description. Shareholders may pay a part of call amount due and the company is obligated to accept that amount tendered. If a member is paying only half of the call amount or 25% of the call amount, company should accept that call amount. Next one, calls in advance. See, calls in advance, company can accept only upon satisfaction of one condition. Remember this point. To accept calls in advance, AOA authorization is compulsory. To accept calls in advance, AOA authorization is compulsory. And with respect to advance calls, there will be no extra voting power because calls in advance is a liability. You'll get voting power in proportionate to paid up share capital. Capital is different, liability is different. So for calls in advance, you won't get extra voting rights. No extra voting rights. Sir, whether will I get extra dividends, sir? It depends on section 51. If your AOA is silent, not only you, everyone will get dividends on face value. That means depositing extra money, you won't get any extra benefit compared with others. But you will get one benefit, that is interest on calls in advance. In CA Foundation accounts, I think you might have solved the problems. Okay, so for calls in advance, interest benefit will be there. Dividends, it depends on 51. One time this point was tested for 2 marks. Can I proceed? Suppose AOA authorized company to pay dividends only on paid up value. Only on paid up value. Now you paid extra amount. For that extra amount, will you get any extra dividend? No. Can I proceed? Next one, issue of shares at a premium. Issue of shares at a premium. Last time, January attempt, exceptional topics marathon, when I'm doing this, I told, remember this cheat code, B square E P square. B square E P square. One student remember that cheat code as it is he wrote in the examination, it seems. Not B square E P square, he abbreviated that B square E P square. Seema, in Companies Act, there is no restriction on fixation of premium. It's up to you. You can fix premium any amount, 10,000, 20,000, 50,000, it's up to you. Companies Act is placing restriction on utilization of premium. Utilization of premium. Here companies are of two types. Companies that follow section 133, others. Sir, what is this 133? AS. If you are preparing financial statements in accordance with accounting standards, then you can utilize securities premium only for B square E. All other companies, for example, big companies, banking, insurance, electricity, will they follow accounting standards? No. They can utilize securities premium for 5 purposes. B square E P square. What is this B square E P square? B square, bonus issue, buyback. E stands for expenses connected with issue, like underwriting commission. P square, preliminary expenses, premium on redemption of preference shares, premium on redemption of debentures. That's it. Getting my point? So you can see here, utilization of securities premium, fully paid up bonus shares, preliminary expenses, write off expenses connected with issue, premium payable on redemption of securities, buyback of securities. But section 133 companies, they can utilize only for 3 purposes. Sir, other than this purpose, if I utilize securities premium, what would be the treatment? Instead of debiting securities premium, you need to debit capital. Suppose if you want to utilize securities premium for payment of dividends, generally entry would be like this: reserves account debit to dividend payable account, like this. Now you don't debit securities premium. Instead of debiting securities premium, debit equity share capital. Allowed or not allowed? Not allowed, because reduction of capital provisions will apply. And about this point, the meaning of this point is you will understand in internal reconstruction chapter. For reduction of capital, securities premium will be treated as paid up share capital. Like in internal reconstruction, accumulated losses, miscellaneous expenditure, everything you will write off against capital, right? You can also write off against securities premium, but for that NCLT approval is needed. Section 66. Internal reconstruction, you practiced it? Okay, fine. See, time came, that's why I'm telling, both for those who are watching on YouTube or now also, don't start preparation with big chapters because they kill time. They kill time. Definitely they kill time. They occupy large portion of time. And small chapters, they are very high in number. So with little time, you can't concentrate on small chapters. And again, these big chapters, easy chapters are definitely not. One small adjustment, that's it. For example, if you take income tax, total income problem, PGBP problem, if you start doing it, one adjustment, entire problem finish. Yes or no? I got 85 marks in tax. May 2014 attempt. I got 85 marks. I attempted only 95 marks. And the strategy I followed, I kept 5 heads aside. First, I prepared indirect tax completely. Next, I prepared all the miscellaneous chapters of income tax. Miscellaneous means residential status, TDS, TCS, return of income, advance tax. All these are generally you think miscellaneous. But from that miscellaneous only 50% will come. And there is no chance of giving tough questions in these miscellaneous topics, direct questions only. And then I prepared house property, very simple, other sources, then salary. In salary also allowances, perquisites last, and then I prepared capital gains, and any time left over I prepared PGBP, because I know students will read PGBP and capital gains, and the question paper setter, he will ask a question how he experienced in his previous clients files. Getting my point? So so if these big chapters are easy, I'll encourage you, go with big chapters, but they will be tricky only. So that's why first 5 marks chapters you should target, next 10 marks, next 14 15 marks, like that. Okay, fine ma. So section 52 we completed. Section 52 is about utilization of securities premium. 53, issue of shares at discount, allowed or not allowed? Not allowed. If you issue if you issue shares at a discount, it will be void. Remember, this is share, this is not a debenture. This is not a debenture, because in FM, if you remember, zero coupon bonds, one concept is there, that is a debt security, that is also a debenture only. What happens in case of zero coupon bond? Every year I won't pay interest, but at the end of period, at the maturity, I'll redeem it at par. Like 10,000 is a zero coupon bond. Right now I will collect how much amount? I will collect some 4,000 only. After 10 years you will get 10,000 rupees. Now is it at discount or not at discount? At discount only. Whether section 53 is applicable to this point? Not applicable, because 53 focus only equity shares. Zero coupon bonds are completely outside of section 53. Can I proceed? Next, yes, a company shall not issue shares at discount except two things. One is sweat equity. Second one is when debt is getting converted under a statutory resolution plan or debt restructuring scheme. In internal reconstruction, if you remember, in internal reconstruction, creditors say, for example, 6,000 crores ma. Creditors use 6,000 crores, interest some 2,000 crores. Example. In case of this debt restructuring scheme or statutory resolution plan, what happens? This is technically you'll find in IBC, Insolvency and Bankruptcy Code 2016. At final level, you will read it. So here, what happens? One resolution plan will be proposed. According to this plan, what happens? This interest, company will request for waiver of this interest. Creditors will agree. And balance 6,000 crores, company will tell like this: we will repay 2,000 crores immediately, and for balance 4,000 crores, we will allot securities, we will allot shares. Face value 10 rupee and paid up value issue price 8 rupee. When issue price is less than face value, we call it as discount. Yes or no? Face value how much? 10. What is issue price? 8. Discount or not a discount? Discount, but allowed. This is a revival to the SIC units. Revival to the SIC units allowed. Sweat equity allowed. Revival to SIC units allowed. Other than these two, if you issue shares at a discount, you need to refund them, and the penalty will be amount collected through issue of discount shares, through issue of shares at discount, or 5 lakhs, whichever is less. Getting my point? 5 lakhs or amount raised through issue of shares at discount, whichever is less. This is the punishment. Also, you need to refund all the money along with interest. How much? 12% per annum. Clear? This restriction does not apply to debt instruments. Beginning only I told you. Next one, issue of sweat equity shares. This point I added. Maybe in your material this point may not be there. You can add this point, E point. Okay, issue of sweat equity shares. Tell me, to whom company will issue sweat equity shares? Employees, directors. One qualification this employee should possess, that is, he should be permanent employee. Employee should be permanent. They may work in India or outside India. They may work in our company or our holding company or our subsidiary company. But they should be permanent employees. And issue of sweat equity shares, it should satisfy 5 conditions. Issue of sweat equity shares, 5 conditions to be satisfied. That is sweat only. S stands for special resolution. W stands for working employees. Just now I explained. Permanent employees, they may work in India or outside India, either in our company or our holding company or our subsidiary company. And E stands for existing class of shares. Existing class of shares. They should not be given new class of shares. Existing class of shares. And A stands for generally articles of association authorization is also required. Not mentioned here. AOA, okay. AOA authorization also required, but no need to write it. And T stands for time limit. The time limit is that special resolution is valid for 12 months only. That means once you take special resolution, within 12 months, allotment of sweat equity shares should be done. If not done, once again you need to take special resolution. Once again you will get a validity period of 12 months. 12 days or 12 months I told? 12 months only I told, right? So validity of special resolution is 12 months. But for getting special resolution, you have to convey them. What type of shares you are giving and what is the number of shares you are giving. What is the current market price and what consideration you are getting and to whom you are issuing these sweat equity shares. Of course, listed companies should comply with SEBI regulations. In 24, I told you, issue and transfer of shares by listed companies. Who will administer those activities? SEBI. So listed companies, SEBI regulations. Rights of sweat equity shareholders, they rank pari passu with other equity shareholders. Like, they are becoming members at zero cost or for a non-cash consideration. Suppose you subscribe shares at current market value, but these people are coming into the company. These people are coming into the company at cheaper prices, maybe at free of cost. So is there any differential treatment? No, both will have same treatment, same dividend rate, same voting powers. These 4 points, very, very, very important. So listen carefully. My present paid up share capital is 100 crores ma. What is my present paid up share capital? Just a second. Yeah. See, company C Limited, present paid up share capital is 100 crores. Now, to what extent they can issue sweat equity shares? That is the question. Normally, every year 15% or 5 crores. 15% of paid up share capital or 5 crores, whichever is higher, they can go. So, in year 1, they issued 15 crores sweat equity shares. So, at the end of the year, how much is my paid up share capital? 115 crores. Now, year 2, company wants to issue equity shares. Now, in year 2, to what extent they can issue preference shares? Now the point is, yes, every year, what is the maximum limit? 15% only. 15% of paid up share capital or 5 crores, whichever is higher. Which paid up share capital I should consider, sir? This paid up share capital only you have to consider. Other than sweat equity, what is the paid up share capital? That means 100 only you have to take. So now 15% of paid up share capital means how much? 15 crores. Now can company issue 15 crores sweat equity shares? Am I using word preference? Just asking you. Am I using word preference? No, right? Is it okay? Listen. Let me repeat the story one more time. What is my existing paid up share capital other than sweat equity? Other than sweat equity, 100. So in year 1, to what extent I can give sweat equity shares? 15%. That means 15 crores I allotted. Now in year 2, to what extent I can give sweat equity shares is the question. Now here you need to understand this second time limit, 25% of that lifetime limit. Sweat equity issuance must not exceed 25% of the paid up equity share capital. That means what, in the second year if I give 15 crores, 115 plus 15, it becomes 130. And what is the component of sweat equity in this? 30. 30 divided by 100 means it is going 30% not allowed. So in the second year, I can give only 10 crores only. Sir, what about 15%? 15% individually, but accumulation 25% it should not cross. Getting my point? So to increase it, what to do? You issue normal shares to the outsiders. You raise your normal share capital. Automatically sweat equity share capital component will also increase. But for startups, this is not 25%. Startups, it is 50%. Up to 10 years of incorporation, they can go up to 50%. They can have 50% of normal capital as sweat equity capital. Lock-in period, once allotted, they are not transferable 3 years. In house property, sorry, in capital gains, I think in capital gains, lock-in period concept is there. Once you sell a capital asset, and if you invest that amount in another capital asset, you should not sell it for 3 years or 2 years like that. Lock-in period is there, right? Same concept here also. Lock-in period 3 years. Once allotted, you are not allowed to sell for the next 3 years. Valuation. Why we are giving sweat equity shares? Because employee contributed something to the company, some intangible asset we are getting, some intellectual property rights we are getting. So that intangible asset and the shares we are giving to that employee, both should be valued by the registered valuer, and accordingly accounting entries should be recorded. Like, if you are getting asset, depreciable or amortizable asset, record it in the balance sheet. Suppose I'm getting asset of 90 crores and I'm also giving shares of 90 crores. Then I will record like this: intangible asset account 90 crores to equity share capital. Face value only I'll record. Balance amount I'll record it in securities premium. This is entry for one. Other cases, I'm not getting any asset, but as a matter of motivation, I'm giving shares before that experiment becomes success. Like you all know, in income tax we had a research and development concept. Expenditure incurred during research phase should not be capitalized, should be charged to P&L account, and expenditure you incurred during development phase can be capitalized. That concept is there in income tax. So suppose this is in research phase only, sir. To motivate employees, I'm giving shares upfront. Since no asset is coming, you can charge it as an expenditure as per accounting standards, like salary and wages account 90 crores to equity share capital 9 crores to securities premium 81 crores. This is the entry. Understood? If you are getting asset, capitalize the asset. If you are not getting asset, charge to P&L. Next, these are the disclosures: board report disclosures, registers disclosures, and all these registers shall be maintained at registered office. Company transparency is very important. Transparency is possible only if they maintain records. That's why in differential voting rights and in sweat equity registers we need to maintain. Definition of employee, I told you, permanent employee. Value addition means intellectual property rights. One example which I used to teach in classroom is suppose our car, for example, we'll take one car, high demanded car. What is a high demanded car? Okay, you people are students, no? Bike only we will take. What is a highly demanded bike? For example, Honda Unicorn, right? Honda Unicorn is giving a mileage of 50 kilometers per liter. One of the employee did an experiment. As a result, with same cc, with same capacity, it is giving a mileage of 80, 60% hike in mileage. Now you tell me, demand for Honda vehicles, Unicorn vehicles in public will rise or will not rise or will rise. This benefit company is getting enjoyed because of that employee. So that employee should be honored. Cash, there is a law of diminishing marginal utility. We give more and more cash also, that person at one point of time, I am working, I'm getting salary, nothing extra. If you make that fellow owner of the company, that fellow will be motivated. So sweat equity, ESOPs are nothing but biscuits only to motivate employees. Okay, fine. No, marathon, right? Only points we need to cover. At least you remind me, this is a marathon, not a regular class. Okay. Next one. Issue and redemption of preference shares. Section 55. The beauty of section 55 is it covers both issue as well as redemption. Issue conditions. Conditions for issue. AOA authorization. For issue of preference shares, AOA authorization is compulsory. And members approval. That too special resolution is required. Sir, why sir? Array, after payment of taxes, profit after tax is there, right? PAT, profit after tax. Generally, this profit after tax belongs to equity shareholders. But because of preference shareholders, before equity, preference shareholders will get dividends. That means you tell me their priority is getting disturbed or not. Some portion of profits are going to preference shareholders. Since equity shareholders right is getting affected, equity shareholders approval is taken. What kind of approval? Special resolution. AOA authorization, special resolution, and company shall not have subsisting default in the redemption of preference shares and in the payment of dividend due on the preference shareholders. See, there is a proverb, ma. If you are unable to satisfy one family, why another family? I don't know whether proverb is there or not. Just telling. If you are unable to satisfy one fellow, why another fellow? The same point. You are not able to satisfy your existing preference shareholders. See, don't take in illegal way. Online students, don't take it in an illegal way. I told joint family and nuclear family example. One family means my family. Another family means my parents' family. Like that also you can think. Now listen carefully. What is the point is, existing preference share capital 80 crores is there. Existing preference shareholders, some 8 lakh people are there. Timely you are unable to pay dividends to them. Timely you are unable to redeem them. Then in that case, why new preference shareholders? So keeping these defaults, don't go for new preference shares issue. First you rectify these defaults, then you can go with new preference shares issue. A company cannot issue irredeemable preference shares. Maximum duration will be 20 years. But for infra companies, the period is 30 years. For 21st year onwards, every year 10% redemption should be done. So conditions, total 6 conditions. First one, AOA authorization. Second one, special resolution. And third one, no subsisting defaults. And fourth one, no irredeemable, only redeemable. And that redeemability also, what is the duration? 20 years. But infra companies, 30. 21st year onwards, every year you need to redeem how much? 10%. So by the end of 30th year, it becomes 0. These are issue conditions. Redemption conditions, sir, face value is 100 rupee. How much face value? 100. And redemption value is 120 rupees. That means here we are having two components. One is face value of 100, other one is premium on redemption, which is 20. For face value, the available sources are free reserves or issue proceeds. Free reserves or issue proceeds. If you go with free reserves, you need to create CRR, which will be utilized for issuing fully paid up bonus shares. If you go with issue proceeds, no need of CRR. CRR is not required. Now with respect to premium, the question is, sir, for premium, which source I can use? Just now in section 52 I told you need to classify company into two categories. Section 133 company, others. Others, they can use free reserves, they can use securities premium. Whereas section 133 companies, they can use only free reserves for premium on redemption of preference shares. Understood? This is one condition. And what about AOA? Is AOA authorization required for redemption? No. not required. AOA authorization is not required. So sources we have seen profits, free resource, nothing but profits eligible for dividend distribution or proceeds from fresh issue. Another important condition, preference shares should be fully paid up. And if you select profits, then face value of shares so redeemed shall be transferred to CRR. The reason is, capital after redemption will come down. So it creates panic situation among the creditors. To cool them, no, this is normal only. This is normal only. We are having reserves, nothing to worry. What creditors will tell? Oh, these reserves will one day become zero if you declare entire reserves as dividends. So simply to cool them, we create CRR, that too from reserves only. And when you issue bonus shares, again capital will come back to original position. So CRR is like an assurance. Don't worry, this reduction is temporary effect only. So because of this CRR, capital will come back to normal position. If you go with issue proceeds, what happen? Temporarily capital will increase. Again it will come back to normal position. That is the reason of CRR. Next one. Sources for premium on redemption. Yes. Following accounting standards are, then redemption can be only from company profits. Others, they can utilize securities premium account or they can utilize company profits. Unable to redeem preference shares. One attempt, this was tested for 5 marks. 3 points you need to remember, ma. Unable to redeem preference shares, 3 points you need to remember. What are the 3 points, First, obtain consent from them. See, ma, redemption is of 2 types. How many types? 2 types. Actual, deemed. Actual means what? We will take your shares, we will pay money to you. Deemed redemption, what happened? We will take your shares. In that place, we will give new shares. Right now, we are not having money. If you demand money, insolvency only. You won't get single rupee also. But if you allow us to do business for some duration, we can generate profits, we can pay you. Like that, I will convince you. Convincing alone is not sufficient. I need to get consent from you. How much consent? 3/4 in value. 3/4 in value. That means 100 crores is the preference share capital. I should get consent from 75 crores rupees preference shareholders. Then go to NCLT, file a petition. NCLT will give permission, but dissenting shareholders are there, no? To these dissenting shareholders, actual redemption should be done. That means you have to pay them. You have to pay them. Getting my point? And in case of deemed redemption, the issue will not only cover redemption amount, but also cover dividends that are in arrears. Suppose last 2 years dividends are in arrears. Those dividends will also be covered in this issue. Say for example, 20 crores is the outstanding dividends. Now I'll issue new shares, not only cover 100 crores of existing capital, but also 20 crores dividend in arrears. Total 120 crores worth of preference shares, I'll give it to you. Understood? So 3 conditions you have to remember. 3 conditions. One is 3/4 consent. Second one is NCLT approval. NCLT will give approval only when the dissenting shareholders were paid off. And new shares will cover not only the outstanding amount, not only principal amount, but also outstanding dividends. And you have to remember this B point also. This is a privilege, ma. The issue of redemption of further redeemable preference shares does not amount to increase or reduce the capital. That means he is telling section 66 provisions will not apply here. For example, I'm taking 100 crores preference share capital from you, shares, and I'm giving 120 crores worth of preference share capital because to cover unpaid dividends. Whether increase is there or not there, but increase related provisions will not apply. This is a relaxation. Suppose I'm giving 80 crores only. Reduction is there, no sir, but still reduction related provisions will not apply. Relaxation. Understood? So with this 55 we completed. Next one, transfer at par. This is second part. Transfer at par. 4 sections we are covering here. Transfer, personation, appeal, and rectification. So this I will cover in my handwritten notes. Sima, what can be transferred is the question. What can be transferred? Securities or interest. securities, interest. If you give plain reading, you'll get a confusion. Sir, securities of the company can be transferred, interest of the company can be transferred. See, this interest, I'm using the word for company without share capital, like company limited by guarantee without share capital, unlimited companies without share capital. That concept is there, right? In that concept, ownership will be measured in interest, and this is not a new term. In partnership firm, ownership will be determined in this interest only, with the word interest only. I'm having 30% interest, I'm having 20% interest. Same is getting used in company without share capital also. Same terminology we are using in company without share capital also. So what can be transferred? Securities or interest. So here two parties you will find, transfer or transferring. Conditions for transfer: there should be a transfer instrument which is SH4. It should be signed by both transferor and transferee. It should be dated and it should be stamped. Remember, all man-made agreements should be stamped. Transfer agreement is also man-made agreement, so it should be stamped. And it should be delivered to the company within 60 days of execution. Within 60 days of execution, SH4 and transfer deed shall be submitted to the company. SH4 plus share certificate. If you are not having share certificate, maybe you might have letter of allotment. Sir, I lost share certificate, I lost letter of allotment. Then submit indemnity bond. So SH4 is compulsory, but these are the other things. If you are having security certificate, give it. Or if you are having letter of allotment, you can give it. See, letter of allotment is a coupon. Share certificate is a document showing title. You can transfer share certificate or you can transfer letter of allotment. But along with that, SH4, it should be delivered within how many days? That is important point. It should be delivered within how many days? 60 days of executing the documents. And these all conditions will not apply if the shares are in demat form. Why? If shares are in demat form, just one click, sell, automatic sell, buy, automatic buy. Getting my point? Money is in your hands, then you need to take the deposit receipt or withdrawal receipt in bank. But if money is in account, GPay, PhonePe, any extra vouchers are required or not required? So demat form, this condition is not applicable. But transmission, transmission is applicable in 3 cases: death of the member, insolvent of the member, liquidation of the company. Holding company, member of subsidiary company, holding company is getting liquidated, or member is becoming lunacy. Now you tell me, transfer or present or competent or not present, not competent. Then in case of transmission, the legal heir will get the securities. For that, execution of SH4 required or not required? Not required. So not applicable in case of transmission, demat form, and for government company also. Government company, transfer of securities, SH4 is not applicable. Separate procedures we need to follow. Next one. Next point. Just if you are having material, just look at the point. SH4, duly stamped, dated, name, address and occupation, everything to be written. That's what executed by the transferor and transferee. Exemption, I covered these points. If instrument is lost, if transfer instrument is lost, if not delivered within 60 days, company may register the transfer on the terms of indemnity decided by the board. Next important point is partly paid up shares. In case of partly paid up shares, members liability will become zero now, or members liability will be there. Members liability will be there. Yes or no? So if transferor is submitting documents to the company, here application is done by transferor alone, and shares involved in this transfer are partly paid up shares, then company should not register this transfer unless 2 conditions are satisfied. What are the 2 conditions? First, company should give prior notice to the transferee, and transferee should give no objection within 2 weeks. Suppose if transferee, there is no reply from the transferee within 2 weeks, then company can assume it as no objection and company can register. The reason is because of transfer of partly paid up shares, transferee gets liability. Whether transferee is willing to take that liability or not, we need to confirm. Suppose if that application is executed by both transferor and transferee, then this concept will not come. This concept will come only when shares are partly paid up and application is executed by transferor alone. Remember the time period for NOC, how many weeks they need to wait? 2 weeks. Next one, transmission. So cases of transmission, you can see death of a member, insolvency of the member, lunacy. Shares are transmitted to the administrator appointed by the court. Next important, if someone asks you what is the difference between transfer and transmission, you have to tell transfer is voluntary whereas transmission is operation of law. In transfer, there will be consideration, whereas in transmission, no consideration. In case of transfer, SH4 is present. Transmission, SH4 is not present. When SH4 is not there, in transmission, no need of stamp duty, whereas in transfer, stamp duty is pakka. Both the parties should execute transfer, whereas both the parties are not required for transmission. Getting my point? Next one. These are important time limits. From incorporation date, within 2 months, MOA subscribers should get share certificates. In case of allotment, within 2 months, allottee should get share certificate. Try to understand the difference between 2 and 4, 2 and 3. In 2 and 4, if you see, shares debentures word was given. Whereas in third point, they mentioned securities. Securities here, cover both shares and debentures. Getting my point? For transfer, whether it is a share or debenture or not a matter, the statutory time limit is 1 month. Once company receive documents, within 1 month, share certificate should be given to the transferee. Getting my point? Whereas for allotment of debentures, debenture allottee will get certificate within 6 months. In case of shares allotment, allottee of shares will get certificate within 2 months. Simply remember 2216. First to incorporation, shares. Next to allotment, shares. 1 securities transfer. 6 allotment of debentures. And for IFSC companies, these many limits are not there. Only one limit, that is 60 days. That is 60 days. And you tell me, if you are making a Google Pay transaction, amount will be debited in your account right now. And when that amount will be credited to the recipient, immediately or after 30 days? That's what, in demat form, immediately. Okay. Now suppose F is a member of C limited company. One day F died and F is having only one son, S. So in this case, by way of transmission, F shares will be transmitted to S. Now here S will have two options. Option 1, request company register shares in his own name. This is option 1, that is transmission. Option 2, why these shares? I want money. So directly he can sell them to outsider. Sir, he is not member, no sir, but law assumes he is a member only. So direct transfer of security of the deceased by the legal representative. That is the point. A legal representative can transfer deceased person securities without being the holder of those securities. Even though he is not a holder, he can still transfer those securities or interest. Securities means company with share capital. Interest means company without share capital. In case of default in section 56, penalty 50,000 company as well as officer in default. In case if there is a fraud, automatically 447. Next one, forged transfer can be tested. Can be tested. Just I won't explain complete thing. Just remember to this example. Sorry, just listen to this example. Just listen to this example. Three people Three people. Omkar, original shareholder. Original shareholder. And can you tell me one name which starts with F? F. One person name, and another name I will write Imam, innocent buyer. Fahad, for example. I think Fahad Fazil sir, actor, right? Yes or no? But not sir. Another name, Fahad. Listen to this story. Company C Limited. Omkar is the original shareholder of C Limited. He is holding 1000 shares. One day, Fahad entered into Omkar premises, looted all these 1000 shares, executed SH4, that is transfer deed. Fahad signed both the signatures. Fahad as a transferee, as a transferor Omkar. Now you tell me, this is nothing but forgery, yes or no? Imitating the signature of another person is forgery. Now is this document valid or invalid? Invalid. When Fahad submitted these documents to C Limited, C Limited should oppose this transfer, but C Limited registered this transfer. Immediately Fahad transferred shares to Imam. He is an innocent buyer. Innocent buyer. He don't know about, he is not having knowledge of this fraud, forgery, etc. Now in the register of members, whose name is there? Imam. 1 year completed. During this 1 year, C Limited paid some 20,000 rupees dividend to Imam, some 500 shares bonus, and in register of members also Imam name is there. After 1 year, Omkar got it out. Why I'm not getting dividends? Why I'm not getting? Why am I not getting? Notice calling for general meeting. He verified register of members and he came to know that one forged transfer happened. This is the situation. But in our material, from examination point of view or material point of view, you need to discuss the rights of each and every person. So what are the rights available to Omkar is the question. Omkar, original member, he can demand company to restore his name back. So he can demand the company, and he can also demand those 500 shares. He can also demand dividends of 20,000 rupees. Is C Limited liable? Yes, because C Limited is negligent. Sir, then what about Imam, sir? If C Limited is taking back all the if C Limited is taking back the shares from Imam and giving it to Omkar, Imam will be at risk, no, sir. C Limited should compensate Imam. Why? Because Imam acted on the share certificate which was given in the name of Fahad. If company didn't give this Fahad, share certificate in the name of Fahad, Imam would not have purchased the shares. So company's liability, company should compensate original member, company should compensate innocent buyer. Now company is at loss, no, sir. Company will get compensation from forged transferee, that is nothing but Fahad. Getting my point, Seema? See, remedy for genuine third party buyer. Third party buyer means who? Remedy for real owner, remedy to the third party buyer. Remedy to the real owner. Owner can delete the name of transferee's name. Imam name can be deleted. Restore the original shareholder. Owner rights completed. And what is the remedy to the genuine third party buyer? Company cannot deny ownership rights to the genuine buyer who acted in good faith, and company shall restore the name of original shareholder, but may be asked to compensate innocent buyer. And what is the remedy to the company? Company can seek indemnity from the first transferee, that is nothing but Fahad, who used the forged instrument. Logical only. Next one, role of dematerialization. In case of demat form of securities, duplication, forged signatures will happen or will not happen? Will not happen. So no, not an issue. So transfer provisions completed. In transfer, you have to remember 2216, 30 days, 2 weeks. 30 days, 2 weeks, and 60 days. 2 incorporation date onwards 2 days. Sorry, 2 months. Allotment case 2 months. Transfer case 1 month. Debentures allotment case 6 months. From event date, within this time limit, certificate should be given. Duplicate is different, ma. Duplicate, what is the time limit? For listed company 45 days, unlisted company 3 months. For IFSC company 60 days. And what is this 30 days? What is this 30 days? No, it's not 30. It's again 60 days only. Transfer documents shall be given to the company within 60 days of execution of transfer. And if it is partly paid up shares, then company should give 2 weeks time period to the transferee whether to raise any objection or no objection. Clear? Can I proceed? Next. Personation. Personation. Changing the identity of the shareholder. Have you seen Chandramukhi movie? Famous movie. I think it came before your birth only, I think. So in Chandramukhi movie, beautiful narration. Rajni sir used to tell like this. Ganga stood like Chandramukhi. Ganga became Chandramukhi. This one also same. On share certificate, you won't find the photo. You won't find the photo of the individual. You will find only names. Do you think on this earth, one person will have only, unique names? 2 or more persons will have same names. Say for example, one person named Mr. Ram holding 1000 shares. There is another person with the same name. He is trying to take his shares. That means he want to change the identity. In that case, that second person, who intentionally personates as owner for the security or interest. Security means company with share capital. Interest means company without share capital or any share warrant or coupon. Then that fellow will get following punishment. But here, obtaining or attempts to obtain, receives or attempts to receive. Here it is not, criteria is not obtaining and receiving. Even if you attempt to receive, even if you attempt to obtain, then also you'll get punishment. What is the punishment? Minimum imprisonment 1 year, maximum 3 years, and minimum fine 1 lakh, maximum 5 lakhs. Clear? Small section only. Whereas personation, in case of prospectus, the punishment is 447, and disgorgement of gain, seizure of securities, transfer all these things to the IEPF account. 38 personation is different, 57 personation is different. Here personation of shareholder, there it is personation of security. Next one, refusal of registration and appeal against refusal. Listen carefully. Transfer or transferee, once they execute transfer deed, what they will do, within 60 days they will send the transfer instrument to the company to register the transfer, right? Now company is having two options: either register the transfer and issue share certificate in the name of transferee, or reject the transfer. If company reject the transfer, it is the duty of company to give notice of refusal to the transfer or transferee, or the person who intimated transmission. Company should give notice of refusal within how many days? 30 days. Now who will be the aggrieved party? Transferee will be the aggrieved party. Why? Because transferee already paid consideration to transferor. So aggrieved party, transferee or transmission intimator, can challenge the decision of the company in NCLT. And how many days transferee is having to challenge? That means for filing an appeal, how many days transferee is having? If it is a private company, 30 days from the notice of refusal. If it is a public company, within 60 days from the notice of refusal. Suppose, sir, transferee didn't receive share certificate, transferee didn't receive notice of refusal also. Then the time limit is add 30 to these both dates. That means 60, 90. But understand the difference. Here 30 days from the notice of refusal, but here 60 days of delivery of documents to the company. Getting my points? Very simple, Masi. Day 0, transferee submitted documents to the company. Company gave notice of refusal on day 30. Then you can file appeal. Time limit for filing an appeal is 60. 30 plus 30, 60 only, right? Suppose we didn't receive notice of refusal. Then the time limit is 60 days from the date we delivered documents to the company. Again, same time limit only. 30 plus 30, 60. You can see here, 30 plus 30, 60. 30 plus 60, 90. Here it is from notice of refusal. Here it is from date of delivery of documents to the company for registration of transfer. Time limits you have to remember: 30 for private company, 60 for public company in case of notice of refusal. In case of no notice of refusal, 60 in case of private company, 90 in case of public company. Now NCLT either may dismiss the order or pass an order ordering the company to register the transfer of securities. And comply NCLT order within how many days? 10 days. Contravention, punishment same like above: imprisonment 1 to 3 years, fine 1 to 5 lakhs. That is about refusal of registration and appeal against refusal. Can I proceed? Next one, rectification of register of members. Listen carefully. I'm the member of company, but my name was removed from the register. Or I'm not a member, but my name was recorded in the register. Suppose I'm a transferee, but company is making delay in updating the register. I'm the transferee, transfer registration also done, but my name they are not entering into the register. In that case, the aggrieved party can go to NCLT. But here aggrieved party may be in India, maybe outside India. Like foreign members, if you take, they may be outside India also. So in that case, no need to come to NCLT. You can go to competent court outside India, which was decided by Government of India. Central government will decide which is the competent court. Go there, file an appeal. So you have to convince my name was wrongly entered, or my name was wrongly omitted, or company is doing some delays. Company is committing some unnecessary delays in updating the registers. Now NCLT will order the company to rectify the register. That's it. Sir, whether transferee get voting rights or not? Transferee will get all the rights. Suppose if NCLT orders transferee rights will be void for the time being, then only transferee will not get any rights. transferee will not get any rights if it is suspended by NCLT. Understood the concept? Same points same points in the material also. You can directly go through the material. So to save the time, I'm used my handwritten notes. Any doubt? In the entire section, if there is a fraud, section 447 will come. See, this is section 60 types of share capital. Authorized, called up. Authorized share capital, it is the maximum amount of share capital that a company is authorized to issue as specified in MOA. See, MOA balance sheet. In balance sheet, you will find paid up share capital. In MOA, you will find authorized share capital. This is the maximum power company is having to issue shares. Is it clear? So that portion of capital which was offered to the people is issued. That portion of capital which was subscribed by the people, we call it as subscribed. And the portion of capital which we call it as called up share capital. And excluding call scenarios, we get paid up share capital. So simple types of capital. Next one, alteration of share capital, section 61. Alteration of share capital, section 61. In this section, 3 points you have to remember. Types of alteration, procedure for alteration, communication with ROC. 3 points. First one, types of alteration. Just remember an example. Authorized share capital 100 crores divided into face value of 10 rupee and number of shares 10 crores. See, this is my original share capital This is my original share capital, 10 crore shares, each face value 10 rupee, total 100 crores. Now alteration of share capital is of total 5 types. How many types? 5 types. Increase. I need more money. So I want to increase 100 to 120. That is increase of capital. First point over. Suppose I issued only 80 crores. Balance 20 crores I don't want. So I am having an option to cancel that unsubscribed shares. See, cancellation of the shares that not been taken. That means this is what? Unsubscribed shares. Unsubscribed shares. So in a case A, 100 crores will go to 120 crores. In case E, 100 crores will come to 80 crores. Understood? Either increase or cancel. Nothing but diminish. 2 ways over. Next one, consolidate and divide. Number of shares 10 crores. Oh my god, more number. Difficult to track. Then I decided. What I decided? Let consolidate them into one share and divide it into 10 lakh shares. Sorry, 1 crore shares. That means what happened? My face value, revised face value would be 100. Previously 10 crores into 10 rupees. Now 1 crore into 10 rupees. That's what consolidate and divide. I'll consolidate all the shares into one share and then I will divide it into 1 crore shares. Now revised face value will be 100 rupees. But here important point is, if consolidation and division results in changes in voting power, it shall be approved by the tribunal. It shall be approved by the tribunal. Sir, what this point means? Sometimes because of consolidation, small minority shareholders, 10 shares will be merged as one share, 10 shares will be consolidated as one share. So what about minority shareholders? Those who are having 9 shares, 8 shares, 7 shares, what they will do? They will surrender these shares to promoters. As a result, other than promoters voting percentage will come down, promoters voting percentage will increase. Whether it is a genuine or not a genuine, NCLT will come and comment. Getting my point? So because of consolidation, if there is change in voting power, it requires prior approval of NCLT. Next one, consolidation over. Increase, cancel, consolidation. So next one is split. Subdivide shares into smaller amount. That means right now what is the face value? 10 rupee. I will revise it to 5 rupees. So previously 10 into 10 crore shares, now it will be 5 into 20 crore shares. It is nothing but split. This is also alteration only. But in case of alteration, you have to take one measure. That is, suppose previously face value 10 rupee, paid up value 8 rupee. When you are dividing this share into 2 parts, say for example 5 rupees, paid up value should also be divided into 2 equal parts. That's it. Same proportionate. Out of 5, 4 over. Increase, cancel. Consolidate and divide, split. And the last one is conversion of shares into stock or reconversion of stock into shares. So total how many ways of alteration is there? 5 ways. Now what is the procedure for alteration, sir? First check your AOA, whether AOA permits it or not. Sir, AOA authorization is there, sir. Then conduct general meeting, obtains ordinary resolution. In incorporation chapter, I clearly told you, alteration of MOA requires yes, sir. But rectification of name and alteration of capital clause, OR is enough. OR is enough. And the last point is, notice must be given to ROC within 30 days of alteration along with altered MOA. That's it. Over. Alteration of capital is over. Procedure you have to remember. AOA, ordinary resolution, ROC filing. That's it. 5 ways of alteration of capital. Next one, FISH, further issue of shares. Section 62. At the time of incorporation, company already made issue to the subscribers of memorandum, that is initial issue. Other than initial issue, every issue will be treated as further issue. Further issue, how many options are there? 3 options. You can see on the screen 3 options. First priority should be given to the existing shareholders. Why? Because they are owners of the company. They are owners of the company. First, any need, ask them. If they are willing to purchase, rights issue. They are not willing to take additional shares, then get special resolution, go to employees. Sir, amount is very huge, employees can't afford it. Then take special resolution, go to outsiders. Maybe public at a large, prospectus, or identified persons, private placement. Clear, everyone? See why priority should be given to the existing members. One simple logic, you listen. You people are, imagine 10 persons, each holding 10 lakh shares. So what is the total capital? 1 crore. And how much voting power you are having? 10%, 10%, 10%. Suppose I need another 1 crore. Without asking you, if I go to public, if I bring another 10 persons, capital will be 2 crores. Each one of you holding 10 lakhs, 10 lakhs, 10 lakhs. So there is no change in holdings. But if you see percentage of holdings, previously your holding percentage is 10%. Right now it is getting reduced to 5. That means your voting percentage is affected or not affected? Affected. That's why I need to take special resolution from you before going out. Even with employees also. That's what sweat equity, special resolution. Employees ESOP also, special resolution. Okay. Rights issue, there will be ratio ma. In the ratio you can make rights issue. Employees, special resolution is a condition. Of course, this you have to remember ma. In examination, tricky point means this point only they will test. Few companies OR is enough. Which few companies? If it is a private company which has not committed default in filings with ROC, both financial statements and annual returns. Financial statements 137, annual returns 92. And if you are a specified IFSC public company, then for you SR is not required, OR is enough. Remember, 2 companies, private company, IFSC companies, no default in filing annual returns, no default in filing financial statements. For you, OR is enough. Listed companies, SEBI norms will apply as usual. Other persons, special resolution. If shares are for non-cash consideration, obtain a valuation report also. This I already discussed with you in sweat equity concept, registered value or valuation report. Next one, rights issue. In case of rights issue, remember time limits. So one time a point was tested for 2 marks, MCQ. Remember time limits. See, today giving notice, tomorrow offer period starts. Valida, invalida? It logically, valida, invalida? Invalid. I need to give some time to you. You need to search for funds. You need to go through the document, right? So 3 days before, at least 3 days before offer period, I should give intimation. Read at this point. 3 days before issue opens, members should be given intimation, notice. That means today if I am giving notice, after 3 days I can open offer. And this offer period should be minimum 7 days, maximum 30 days. As per act it is 15 days, but in rules this 15 days was already reduced to 7 days. So offer period, that means if you want to subscribe additional shares, you will be given offer period. That offer period minimum of how many days? 7, maximum of 30. It can't be more than 30, it can't be less than 7. Remember 3 time limits ma. 3 days is for intimation and offer period minimum 7 days, maximum 30 days. Of course, if you are a private company, if your members agree, 90% of members agree in writing, then these 3 days to 7 days can be reduced. Privilege to the private companies, because it will have only 200 members, all 200 members will live beside company only. So if 90% of members agree, the statutory period of 3 days to 7 days can also be reduced. Understood? But for all the even for IFSC companies also, if 90% private companies and IFSC companies, if 90% of members agree, then shorter acceptance period, same, that only I told you. So 7 days 3 days can be reduced with 90% members consent. That means, what is the normal time limits? 3, 7 to 30. 3, 7 to 30. Whereas private company, IFS companies, if 90% of members agree, then this minimum periods can be reduced. Sir, can maximum period can be increased, sir? Can maximum period be increased? No. Maximum period is fixed. So the letter of offer shall contain number of shares, period for acceptance. Also state that if shares are not accepted within the specified time, it is nothing but deemed declined. Confirm that renunciation benefit is also there. In capital gains, you have did problems for renunciation of rights, right? Same concept. If any existing member is not taking additional share, then those additional shares can be disposed by the board of directors in a manner not disadvantageous to the company. Not disadvantageous means there should be no profit, no loss. There should be no loss, there should be no profit. That's it. That's it, ma. Length of the notice also I mentioned. This is a normal point. You can read it. Mode of delivery of the documents. For rights issue, board resolution is enough. General meeting is not required. Remember this point also, because there will be a question like this. One of the shareholder raised a contention that company made rights issue without members' approval, and he told that allotment is irregular. Comment. They can ask question like this. Now you have to write, for rights issue, members' approval is not required. Ordinary board resolution is enough. Why? Because it is a right given to all the members proportionately. We are giving you right to subscribe additional shares. If you are not taking it, means it's your fault, not company's fault. And unsubscribed shares will be disposed by the board of directors in a manner not disadvantageous to the company. That's it. This is another tricky point. This F point, another tricky point. Section 62 does not apply to the debentures or loan conversion. 10 years back you issued convertible debentures, ma. What is the specialty of convertible debentures? Tell me. Specialty of convertible debentures. At the time of maturity, those debentures will be converted into equity. That means after 10 years, I'm converting them into equity, means I'm giving equity shares, right? What section 62 is telling, if you are giving equity shares to the other than existing members, special resolution to be taken, yes or no? But this rule is not applicable there. Why? At the time of issue of CDs only you took special resolution. Why once again special resolution at the time of conversion? So converting debentures, previously if you have taken special resolution, at the time of conversion, one more special resolution is not required. That is one point. That is one point. Second one, CG directed conversion. CG converted conversion. For this, Vodafone Idea is the best example. Last, I think 2 years back, I think. Google will remember everything, ma. Vodafone Idea debt to equity. I think it's not debt to equity. Spectrum juice to equity. This is best example. See, very recently, Vodafone India is having a liability to the government, 36,950 crores. Company is not having any funds. That's why Government of India ordered to convert this amount into equity shares. When government is passing an order, you have two options: accept or appeal. If you want to appeal to NCLT within 60 days of government order. If you accept, automatic conversion. Sir, my MOA is not permitting to issue new shares, sir. No problem. CG order is enough to increase your authorized share capital to the extent of CG mentioned amount, CG ordered amount. Automatic increase. Section 61 will also not apply. Many students will read this point wrongly. See, observe carefully. Government can order the conversion of debentures loans. Okay, which debentures, which loans? Debentures issued to the government, loans granted by the government. That means here who is the recipient? Not ordinary people. Government is a recipient. So government will consider the reasonable terms. Government will consider financial position of the company, loan terms, interest rate, and other relevant factors. And it will pass an order, convert these debts into equity. If you disagree, file an appeal with NCLT within 60 days. Tribunal will hear both the parties and pass an appropriate order. And here section 61 will not apply. Government orders conversion, company's authorized share capital automatically increases by the value of converted shares. MOE is altered accordingly. Clear? And entire section 62 is not applicable to Nidhi company. Nidhi company, it's altogether a different concept. Nidhi companies were popular once upon a time in rural areas. These banks are not there in rural areas. They need technology, right? They need internet facilities. So to cultivate habit of savings in the rural areas, government came up with a concept called Nidhi banks. So Nidhi companies were used to be there in rural areas. Members used to contribute the money. So that village people, residents will contribute money to the Nidhi company. But the base condition to deposit your savings with Nidhi company, you must be a shareholder in that Nidhi company. So every day shareholders numbers may increase, may decrease. Every day new shares will be issued. Every day some shares will be bought back. Now applying section 62 will not be possible practically. So every time issuing equity shares to the new member, all other members come and vote in favor means all other members, they are also from village background only, rural area people only. Do you think they are very rich in Companies Act knowledge? So how can you ask them to cast vote in favor of issuing new shares to the new members? So practically not possible. That's why Nidhi companies were exempted from section 62. Can I proceed? So in section 62, what we discussed is rights issue. In rights issue, remember 3 limits I told you. 3 days for notice period, 7 days is minimum offer period, 30 days is a maximum offer period. Of course, with 90% of the members consent in IFSC companies and private limited companies, you can reduce this minimum period over. Next one, employee stock options, special resolution is required. Any other persons, special resolution is required. But in any other persons, SR is not required in 2 cases. What are those 2 cases? Case 1, converting debentures. Case 2, government direction. That's why you are converting loans into equity. Over. Finish. Next, 63, issue of bonus shares. Issue of bonus shares. Bonus shares are issued to the existing shareholders as fully paid shares at free of cost. The other name for issue of bonus shares is capitalization of profits. Simply the entry will be like this: free reserves account debit, CRR account debit, next one, securities premium account debit to equity share capital. That's it. This is the entry. So based on this entry, I think you understood. Sources for bonus issue is free reserve, securities premium, capital redemption reserve. Of course, revaluation reserve is not allowed. In one attempt, they asked a question like this: paid up share capital of the company is 10 crores. Authorized share capital of the company is 15 crores. Revaluation reserve 2 crores. General reserves 1 crore. Securities premium 1 crore. CRR 1 crore. Now, to what extent company can issue bonus shares? That is the question. To what extent company can issue bonus shares? The ratio, for example, option A 1:2, option B 3:10, option C 2:10, option D for example 4:10. If you are telling 1:2 means you are considering revaluation reserve total 5 crores. 5 crores is to 10 crores means 1:2. This is wrong. This is not allowed. Which we can utilize only 3: free reserves, security premium, CRR, 3 crores only. So 3 crores. You need to check whether authorized share capital permits it or not. Yes, in authorized share capital 5 crores free capital is there. So 3 crores if I give, so 3:10, that is the ratio. In one attempt, 5 marks question came like this. Can I proceed? Conditions for bonus issue. First you write AOA authorization. I told you, for company to do anything, AOA permission is required. AOA permission is required. Next one, board approval. Next, members approval. Sir, for rights issue, members approval not required. For bonus issue, members approval required. What is this? In bonus issue, ask the question. For rights issue, members approval not required. For bonus issue, members approval is required. What is this? In bonus issue, capitalization of profits is happening. Till today, you are seeing profits. Tomorrow onwards, you won't see that profits because it was getting capitalized. So this is subject to members approval. So bonus issue, members approval is required. And company should not have these defaults. Which defaults are? Deposits, debentures, interest to principal. Total 4. Interest on deposits, interest on debentures, and statutory dues such as employee provident fund, gratuity, bonus, employee statutory dues. So these 5 defaults company should not have at the time of issue of bonus shares. Partly paid up shares must be made fully paid up before issuing bonus shares. Bonus shares cannot be issued in lieu of dividends. Same point in dividends chapter we discussed, section 123. Sima, dividend once declared, it can't be paid in kind, it should be paid in cash. Clear? Bonus is like kind, but it is different concept. This is a capitalization of profits. Suppose this time dividends 20%. When you are coming to the company for collecting the dividend, I am telling 4 free shares to you, like that. So in the place of dividend, can I keep bonus shares? No. That is a different route. This is a different route. Bonus issue is not a substitute to the dividends. Clear? And issued shares should be fully paid up. The people who are receiving bonus shares, they should also possess fully paid up shares. Observe carefully. I'm the company, I'm giving bonus shares. You are the members receiving the bonus shares. The condition is, I can't give partly paid up bonus shares to you. I should give fully paid up bonus shares. And the people taking bonus shares, they should possess shares which should be fully paid up. So that's it, ma. So conditions, easy to remember: AOA, BR, OR, no defaults, not in lieu of dividends, fully paid up shares, bonus issue, fully paid up, and the eligible candidate should also possess fully paid up shares only. Enough. Defaults 5 types: deposits, interest, debentures, interest, employees, statutory dues. Next one, section 64, ma. So in 55, whenever you redeem preference share capital. 61, whenever you increase share capital, alter share capital. Section 62, government order to convert loans into equity. In these 3 cases, it is the duty of company to communicate with ROC. Form number SH7, time limit is within 30 days. Clear? That's it. Alteration of share capital, government order, redemption of redeemable preference shares, or else punishment. So 3 sections I wrote here: 55, 61, 62. In all these 3 events, 64 is applicable. Company has to communicate with ROC. Form number SS7. Time limit is 30 days. Can I proceed? Let's continue. Reduction of capital 66. The best way to understand this concept is internal reconstruction. In paper 1, internal reconstruction chapter, there or not there? There, no? That's it. Section 66 is over. So here in section 66, what happens? Reduction is of 3 types, ma. Reduction is of how many types? 3 types. In material also you can see this is 1, 2 and 3. 1, 2, 3. See here, face value is 10 rupee, paid up value is 8 rupee. And I don't want to make another call. For me 8 rupees is enough. So in that case, company may reduce this face value to 8. Now 8 minus 8, members liability is 0. Extinguish or reduce liability on unpaid share capital. Next one, cancelling paid up share capital either if it is lost or unrepresented by available assets. Internal reconstruction. Say for example, equity share capital 10 crores, outstanding liabilities 10 crores, fixed assets 6 crores, current assets 8 crores, P&L debit balance 8 crores. You tell me, is this asset worthy asset or zero worth? Zero worth. Cancellation of unrepresented capital. I call it as cancellation of unrepresented capital. If I sell all the assets, getting 14 crores, 10 to outside liabilities, then balance 4 only to the equity share capital holders. So cancellation of unrepresentation capital of balance 6 crores. 6 only, right? I wrote it as 8, right? No, it's not 8, 6. Next one, if it is excess capital, then company may pay it off and amend memorandum accordingly. Suppose face value 10 rupee, paid up value also 10 rupee, but I don't want 2 rupees per share. I'm having idle amount. Instead of having idle money, if I return it to the shareholders, they will find better alternatives to grow their money. So I will return 2 rupees. Now revised paid up value will be 8. If I reduce face value also to 8, 8 minus 8, members liability will become 0. What is difference between section 61 and 66? In 61, I played games with unsubscribed capital. The shares which were not taken by the people, I cancelled them. Whereas section 66, the shares which were taken by the members, I'm playing games, either reducing the paid up value or reducing the face value. This is possible only with special resolution of the members. This is possible only with the special resolution of the members. And alone, special resolution alone is not sufficient. NCLT approval is also required. So prerequisites for reduction of the capital is special resolution and NCLT approval. So after passing special resolution, file an application with the tribunal. Of course, section 66 is not applicable to 68. For buyback, 66 is not applicable. Sir, in buyback also capital will be reduced. No, sir. But there we create CRR. Capital will come back to normal position. So that's why their NCLT approval I am not taking. Here, there is no chance of creation of CRR. So for buyback, this section is not applicable. That means you tell me, is NCLT approval required for buyback? No. For redemption of preference shares also, NCLT approval is not required. Alteration of memorandum. Yes, when you are revising face value, automatically it will have impact on what? MOA. So alter memorandum of association. Diminution means reducing unsubscribed capital, which is different from capital reduction. Here, I am playing games with balance sheet capital, whereas diminution means I am playing games with MOA, unsubscribed share capital. So for that OR is enough, but for this not only SR but also NCLT approval is required. See what I covered in 66 so far. Types of reduction. One is cancellation of uncalled capital. First one is cancellation of uncalled capital. Second one is cancellation of unrepresented capital. Accumulated losses I'm writing off. And third one is cancellation of unwanted capital. I'll return money to you and I'll cancel it. Getting my point? Uncalled, unrepresented, unwanted. And for this, what steps we need to follow? Special resolution, NCLT approval. NCLT approval is not required in 2 cases. Which 2 cases? Buyback, redemption of preference shares. Next one, there should be no default with respect to deposits and interest on deposits. If company has subsisting defaults like deposits repayment or interest on deposits payment, then company cannot proceed with capital reduction. So no default. Next, once tribunal receives an application, company is sending application to NCLT. Sir, my members approved it, sir. Please approve it. Now immediately NCLT will forward this application to 4 people. Who are those 4 people? RD, central government, ROC, SEBI only when company is listed. If company is not listed, SEBI won't come. And finally, creditors. This group is very important. My dear creditors, company wants to reduce its capital. Check whether your interest is affected or not. And NCLT will wait for 3 months time period. How many months? Tell me. 3 months. Within 3 months, if there is no objection from these parties, then NCLT will ask each and every creditor, is it okay, is it okay, is it okay, one more time. If creditor interest is not getting affected, immediately NCLT will check accounting standards compliance, whether company complied accounting standards, accounting treatment. In internal reconstruction, you people will write entries and you people will revise, you people will prepare revised balance sheet, right? So whether that preparation of financial statements is in accordance with accounting standards or not, NCLT will verify not directly but through a certificate issued by the company auditor. So if any of these parties raise objection within 3 months, tribunal will consider them. No objections, assume that there is no objection. Then tribunal will approve the reduction of capital if it is satisfied creditor claims either discharged or settled or secured, or finally their consent is obtained or not. And they will check accounting treatment. For that they ask auditor's certificate. And finally tribunal will give green signal. So publication of tribunal order. company must publish tribunal order in 2 newspapers as decided by the NCLT. So this allows for representations and objections from the affected parties such as creditors, which will be forwarded to NCLT. See what actually happened is, one example to understand this much more. One example. See ma, this is my balance sheet ma. Paid up share capital only you will find here. Face value 10 rupee, paid up value is 8 rupee, so 8 crores. Outstanding debenture holders, for example, 10 crores. Fixed assets 4 crores, current assets 4 crores, P&L debit balance 10 crores. So total 18. Now about financial position of the company, who knows better? Members only will know better. Now members in AGM seeing these financial figures, oh my god, if company now, if it enter into winding up stage, this 4 plus 4, 8, not sufficient to discharge this 10 crores liability. Immediately liquidator will ask, contribute 2 rupees each. So 2 crores, everything will be settled. Members will think like this, already 8 crores became 0. Again we need to bring 2 crores additional money, additional loss. Why? Let's do one thing. Let's pass special resolution, revise face value to 8. Now 8 minus 8 how much? 0. In that case you tell me, members are safe, right? Members are safe, but what about creditors? So that's what NCLT will see a clean, NCLT will verify each and everything. Suppose there is a chance, the chance is maybe what these people will do, paid up share capital, they will write 8 crores, outstanding debenture holders, instead of 10 crores, they may write it as 8 crores only. Getting my point? Now fixed assets 4 crores, current assets 4 crores, P&L debit balance some 8 crores, balance sheet tallied. NCLT will know the information given by the company. NCLT will not know what about other creditors, whether this is complete or not. NCLT don't know. That's why NCLT will order company, come on, publish my order in the 2 newspapers. So now creditors will go through the financial statements, and creditors whose names were deleted, the 2 crores rupees worth creditors who are there, they will come forward, they will raise objections. Sir, my name is not included. Now what NCLT will do? It will cancel the reduction order. Did you understand the concept? So that is a point ma. That is a point. So this allows for representations and objections from the affected parties such as creditors, which will be forwarded to NCLT. If there is no objection, company must file a certified copy of tribunal order and approved minutes to the registrar of companies within how many days? 30 days. So filing with ROC, normal one, but in that you need to submit what is the revised face value, what is the revised paid up value, and what is the revised authorized share capital. You have to mention these points: total share capital after reduction, number of shares, value per share, face value, paid up, revised paid up value. ROC will register the same and issue the certificate. Suppose these 2 crore worth creditors, they came forward after reduction of share capital. Suppose then what would be the situation? That is the next point. Creditors right to object failed to object. I am also creditor, but my name was omitted in the record. That's why NCLT didn't took my permission. NCLT didn't took my consent. Now I can file an objection with NCLT. NCLT will pass an order. What order they will pass? Do you remember lifting of corporate will in CA Foundation? Once corporate will is lifted, separate legal entity status will be gone. Members will get unlimited liability. Here NCLT will remove capital reduction order, lifting of capital reduction order. So in that case, what is the original face value? 10. What is the original paid up value? 8. Revised face value 8, revised paid up value 8. So now members are thinking our liability is 0 only. See what members are thinking, they are liable only for the difference between amount paid on the share, reduced amount deemed to be paid as per tribunal order. They are thinking about revised face value minus revised paid up value. They are thinking like that, their liability is 0. But once NCLT removes this order, their original liability will get back. What is the original liability? 10 minus 8, 2 rupees. So they are liable for original liability. Sir, they means who, sir? Present members, sir? No. The members, the persons who are members at the time of reduction of share capital. That means A is the member, he transfers shares to B transfers shares to C transfers share to M. M is the present member, but M is not liable. Who is liable? Original member. At the time of reduction of capital, who is the original member? That member gets original liability. And this cheating practice, who did? Directors. Directors will get punishment under section 447. Getting my point? What is this extra paragraph, sir? Very simple, ma. If company still exist, or if company is wound up, if company still exists, NCLT will assume that before reduction of capital, if company was wound up, what would be the members liability? That liability will apply. That means 2 rupees per share. Sir, company already wound up. Now NCLT assume that company is still alive. If company is still alive, what would be the members liability if it is liquidated at present? It is assumption. You can see here. You can see here, every person who was a member of the company at the time of registration of tribunal orders shall be liable to contribute towards the debt or claim. If company is wound up, creditor can apply to the tribunal to be included in the list of contributories. Tribunal may settle the list of contributory, issue calls and enforce payments from them as in a normal winding up process. Company already died, sir, but still we assume that company is alive. Under normal winding up process, what would be the procedure? That procedure will be followed up. If company still exists, we assume that before reduction of capital, if company wound up, what would be their liability? That liability will be continued. Can I proceed? And officer's punishment is 447. This already I told you. Section 68 is not affected by section 66. 67. You are having a mobile, right? Every one of you are having mobile. It's your mobile. Now if I ask you, what is that mobile price? 10,000. You will tell, say for example, 10,000 or 50,000, for example. And if I ask you, can you buy your own mobile? Can you buy your own mobile? Similarly, shares is also property of the company. No company can purchase its own shares. That is section 67. Sir, buyback is there? No. Under buyback, once company purchase shares, company will scrap them. Company will destroy them. Under section 67, you know, what is the intention of the lawmaker under section 67, you know? For example, paid up share capital is 10 crores. Bank balance 10 crores. Simple entry. Just now we issued shares, we got 10 crores. Now what company is doing, you know, with the 10 crores, company is taking back the shares. And in the place of bank account, they are writing entry like this: investment. You know, our company is C Limited only. Investment in C Limited 10 crores. You tell me, this balance sheet, will it have any sense? No. So this is not allowed. That is section 67. A company limited by shares, limited by guarantee with share capital, cannot buy its own shares unless reduction of share capital is done as per the provisions of the act. This is nothing but buyback. Buyback is an exception. Of course, exceptions are there, ma. Two companies. Nidhi company. Whenever you want to quit from the company, you can surrender your share. Nidhi company will pay the price. For Nidhi company, section is not applicable. That means section Nidhi company can purchase its own shares. And same shares it can sell to another people also. Next one, for private company, IFSC companies, you see, for private companies, you see the condition. What is the condition they are telling? No other body corporate has invested in the share capital of the company. That means in my private company, there should be only natural members, not artificial members. And second one, total borrowings from the banks and financial institutions should be less than, it's not less than or equal to, less than 2 times of the paid up share capital or 50 crores, whichever is less. And there should be no subsisting default in repayment of those loans at the time of purchase. Suppose if my capital is, say for example, 10 lakhs, twice of the paid up share capital means how much? 20 lakhs. Total debts less than 20 lakhs means 19 lakhs, for example. If that is the case, you tell me public interest is there or not there? It's a minute case. Public interest will not be there. Even bank, financial institutions interest is also not getting affected because timely it is repaying the loans. So since no party right is getting affected, no party interest is getting affected, private company, if you want, you can do purchase of your own shares because debt is very small, less than twice of the paid up share capital. And with respect to repayment of the debt also, the company is not making any default. So entire section 67 is not applicable to two companies, private companies, Nidhi companies and IFSC companies also. But for private companies, you have to remember 3 conditions. In the entire register, in the entire members list, there should be no other body corporate. Maximum loans twice of the maximum. No, loans should be less than twice of the paid up share capital or 50 crores, whichever is less, and there should be no default in repayment of the subsisting there should be no subsisting default in repayment of those loans. Next one, prohibition on indirect purchase of own shares. Prohibition on indirect purchase of own shares. Sir, what is this point? First point, direct purchase. Second point is financial assistance to purchase the shares. Second point, company won't purchase the shares, but company is financing its directors, company is financing its employees, company is financing known people to purchase the shares. If this is done, artificial demand will be created, speculation will happen, share price artificially will be increased. So indirect financial assistance also not allowed. A public company, look at the wording here. He told company, that means all companies, private to public, but in exception private company, satisfying conditions is exempted, whereas subsection 2 focus is on public company only. A public company cannot provide any financial assistance to anyone for purchasing its own shares as well as holding company shares. This is already there in section 19. Subsidiary company not to purchase holding company shares, either directly or indirectly. But there are exceptions. General rule is simple, but you have to remember exceptions, because one time this point was tested for 2 marks. Another time this point was tested for 5 marks. Exceptions important. What is the general rule? Public company cannot finance anyone to purchase its own shares or its holding company shares. But we had 3 exceptions. How many? 3. First one is lending business, for example SBI. Tell me, SBI is a listed company, yes or no? Yes, its shares are getting traded on the stock market. SBI is having approximately 10 crore borrowers, approximately. Now, do you think SBI will run an investigation agency what these people are doing with the money, with the borrowed money? Suppose, I applied for a personal loan, 10 lakhs. I transferred that amount to my Demat account. From that, I purchased SBI shares. Possible or not possible? Possible. But do you think SBI will closely monitor me what he is doing with its 10 lakhs? So, if it is done in the ordinary course of business, I'm eligible for 10 lakhs and I got 10 lakhs loan. Suppose I'm eligible for 10 lakhs loan, but I got 10 crores loan. And with this money, I am buying SBI shares. Now you tell me, is it ordinary course or not in ordinary course? Or not in ordinary course. If it is not in ordinary course, it is not exception. Punishment will apply. SBI over. Second one, employee share purchase scheme. See, employees are also very much interested in the dividends, but they won't have sufficient funds to purchase the shares. In this case, company can provide financial assistance to the employees. Companies can provide financial assistance to the employees in the form of loan. You can see C point. Company can give loans to the employees for purchasing the shares. And if you are having material, just correct this one point, It was split into 2 points actually. Just combine those 2 points. The loan amount does not exceed 6 months salary, and the loan shall be used for fully paid up shares purchase or subscription. That is one difference you have to incorporate in your material. See, in case of employee loan, 3 conditions to be satisfied. Come on, repeat 3 conditions. Condition number 1, he should be employee other than directors or KMP. He should be employee other than director or KMP. If you want to finance your director, again exemption will not come, exception will not come, punishment will come. So he should not be director or KMP. Maximum financial assistance is 6 months salary. Suppose 30,000 is the salary. How much loan I can give? 1,80,000. And with that money, he should purchase partly paid up shares or fully paid up shares? Fully paid up. Suppose if he is purchasing partly paid up shares, then also exemption will not come, punishment will come. 3 conditions cumulatively to be satisfied. Other than director KMP, 6 months salary, and fully paid up shares. Next one, employee purchase scheme. Here, you know what I will do? Instead of giving loans to each and every employee, I'll form a trust. I'll appoint one, trustee. The trustee will take care of all the things. First, I'll give loan to the trustee. Trustee will purchase the shares on behalf of employees. But for this, 3 conditions are important. First, special resolution. See, this is like individual. C point is like individual employee. Interested candidate will come. Whereas B point is for group of employees. Group of employees. For this special resolution compulsory, and purchase of shares must be through a recognized stock exchange if company is listed. If it is unlisted company, the price should be valued by registered valuer. And maximum how much loan I can give to the trust, maximum 5% of company's paid up share capital and free reserves. In one attempt, this, September attempt only, September 25 attempt, this point was tested. Maximum how much finance can be given, that is 5% of company paid up share capital and free reserves. And company must disclose details about voting rights, including name of the employees who did not exercise voting rights directly and the reasons. Of course, these shares are for the benefit of employees only. You can see these shares are for the benefit of employees, but they are held by the trustee. Trustee will exercise voting rights. And this section is not an hurdle. This section is not a hurdle to redemption of preference shares. Sir, 67 is telling no company can purchase its own shares. No, sir. But 55 is telling compulsory redemption of preference shares. Conflict is there? No. Answer is very simple. Special provision overrides general provision. So section 55, redemption of capital is not affected by this section 67. Non-compliance of this section, company 1 lakh to 25 lakhs, officer in default, up to 3 years imprisonment and 1 lakh to 25 lakhs punishment. Clear? See, in this entire section, you have to remember only 3 points. Private companies were exempted. Which private companies? Satisfying 3 conditions. Which 3 conditions? No body corporate is a member. Maximum loans. No. Loans less than twice of the paid up share capital or 50 crores, whichever is less. And there is no default. No subsisting default at the time of purchase of these shares. Neither company exempted, IFSC companies exempted. That is one. Second one, lending business. Normal point only. No need to remember limits. Ignore. Third point, important point is employee loan. Here you need to remember 6 months salary. And next one, employee purchase scheme. There you need to remember 5% of the paid up share capital plus free reserves. If it is a listed company, purchase should be done through recognized stock exchange. If it is an unlisted company, purchase should happen at the price valued by the registered valuer. That's it. Last but one important topic, buyback of shares. Sources for making buyback: free reserves, securities premium account, and proceeds of the issue proceeds. The word specified securities means ESOPs and sweat equity shares. You can see here specified security means employee stock option, other securities notified by the government. So note, issued shares, buyback shares should not belong to same class. They should not belong to same class. They should belong to different class. If they belong to same class, it looks like offer for sale of securities. Section 28 will come. Section 28 will come. So when you are making buyback of shares, to finance this buyback, if you are going with a issue of shares, 2 shares should be belong to different class. They should not belong to same class. And if you select free reserves as a source for making buyback, you have to create CRR, and CRR will be utilized for issuing fully paid up bonus shares. Next one, conditions for buyback AOI authorization required, special resolution. Another tricky point, buyback if you have solved problems, this trickiness you will not find. Observe carefully, notes resolution, observe resolution point, and observe this one. These 2 points are different how they are different? This is number of shares I can make buyback. Here I am talking about shares number. Here I am talking about amount required for making buyback. That means this is money, whereas this is number of shares. Try to understand the difference, because students are getting confused between this 25% and this 25%. Just look at the material. You look at the material, a resolution point only, special resolution. Special resolution must be passed in general meeting unless buyback is 10% of paid up equity share capital plus free reserves plus securities premium, then board resolution is sufficient. Maximum buyback with the special resolution is 25% of paid up equity share capital, free reserves, securities premium. And you will see here, another buyback point. Maximum buyback is 25% of paid up share capital only. One more point. 25% of paid up share capital is there or not? In a single year, buyback cannot exceed 25% of paid up share capital. We'll write that point. Just wait. So in a single year, maximum buyback in a year shall not exceed 25% of paid up equity share capital. I think that point is there. Okay, fine. There or not there? Just add this one point. Now let me explain this point. See, in a year, maximum you can make buyback of 25% of the paid up share capital. But to finance this buyback, amount needed to finance this buyback, if it is up to 10% of the paid up equity share capital plus free reserves plus securities premium, board resolution is enough. If it is exceeding 10%, then special resolution is required. With special resolution also, up to 25% only you make buyback. What is the difference? Ma face value 10 rupees ma. Whereas buyback price is, say for example, 40 rupees. Getting my point? 1 crore worth shares are there. 1 crore paid up share capital is 1 crore. My free reserves 1 crore. There is no securities premium. Imagine. There is no securities premium. Only free reserve is there 1 crore. Now, as per number of shares, buyback is permitted up to 25%. That means 25 lakhs worth paid up share capital I can make buyback. But 25 lakhs into buyback price, how much? 40 rupees. 25 lakh shares, 25 lakh rupees is a paid up share capital I told. Divided by 10 into 40. You'll get number of shares. 25 lakhs is my paid up share capital which I want to make buyback, right? So 25 lakhs divided by 10 into buyback price 40 rupees if you apply, you will get 1 crore rupees. But if you see the source, maximum I can utilize 25% of paid up share capital plus free reserves plus securities premium. That means 2 crores into 25%, I can spend only 50 lakhs for buyback. Solve buyback problems, you will understand. Amount that I can spend on buyback is maximum 25% with special resolution. If it is with 10% only, board resolution is enough. In a single year, I can make buyback of 25% of paid up equity share capital. Post buyback, debt equity ratio should not be more than 2:1. Are you all getting my point? The difference is because of buyback price only. Buyback price only. You understood the sum, right? Buyback price 40 rupees, face value 10 rupees. Okay. Next, what kind of shares can be bought back? Only fully paid up shares can be bought back. And listed company should comply with SEBI norms and regulations. Remember, once buyback is completed, so these limits are over, right? Come back to material. Yes, buyback must be completed within 12 months from the date of passing the resolution. Do you remember sweat equity, right? Once special resolution is passed, within 12 months sweat equity issue should be done. Here also, once resolution is passed, within 12 months buyback should be done. But for passing special resolution, first you need to give notice calling for a meeting and explanatory statement. In that explanatory statement, you will find justification for buyback. Buyback, you can do it from existing members or open market or from employee stock option or sweat equity shareholders. Just a second. I'm discussing with you buyback from whom. Buyback can be done from existing shareholders or from an open market or employee stock option or sweat equity shareholders. Very recently, Infosys made a buyback. So from open market, they bought back the shares. Next one, procedural steps. If you go through the procedural steps, 7 points are there. 7 points are there. First one is, once you decide to make buyback, file a letter of offer with the ROC. Then within 20 days of filing with ROC, communicate the same to the members. Same like letter of offer ma. In rights issue we have seen it, right? Offer period will be minimum of how many days? 15. Maximum of 30. But there 15 is reduced to 7. Here offer period minimum 15, maximum 30. Same concept. But there minimum was reduced to 7. Here not reduced. Offer period minimum 15 days, maximum 30 days. Proportionate acceptance if shares offered exceed the buyback quantity. See, I am asking 1 lakh shares for buyback. I got application for 2 lakh shares. Proportionate, that means for every 2 shares I got, for every 2 applications I got, I will accept only 1 application. Verifications will be completed within 15 days and payments will be done within the next 7 days. If there is no payment, then I need to return back your shares within 21 days of closure of the offer. Within 21 days of closure of the offer period, I need to communicate with you about the rejection of offer, and I need to return those shares to you. That is the procedural steps. Next one, declaration of solvency. Before you make buyback, a declaration of solvency shall be filed with ROC, and if it is a listed company, then you have to file same copy with SEBI. What about this declaration of solvency? Even if my company enter into liquidation right now, my assets are sufficient to meet liabilities. So simply, next 12 months I am able to do the business. Going concern means 1 year only. Next 12 months I am able to do the business. In the worst case, if my company enters into liquidation phase, my assets will be sufficient to meet the liabilities. It should be signed by 2 directors, including managing director. After completion of buyback, within 7 days, destroy the physical securities. If it is demat form of securities, extinguish them. That means reduce the count. And cooling period. Once buyback is done, same kind of shares company should not issue within the next 6 months. Within the next 6 months, same shares cannot be issued. Remember in buyback, 2 limits regarding cooling. One is 12 months, other one is 6 months. 12 months, once buyback is done, next 12 months you can't make another buyback. 6 months, once buyback is done, the shares involved in the buyback can't be issued. Sir, already we destroyed. No, sir. Authorized share capital, say for example 1 crore shares, and issued shares, imagine 90 lakhs. Paid up shares also 90 lakhs only. You bought back 10 lakh shares. As a result, paid up shares come down to 80. Authorized share capital is same only, right? So here unsubscribed shares count is going up. That means balance unsubscribed shares, can I issue to the public or can I issue to the employees? The answer is you should not issue them for the period of 6 months. But we had exception. If you see, bonus shares or discharge of existing obligations like conversion of warrants, conversion of stock options, sweat equity, or conversion of preference shares. These existing obligations you can go. In one attempt, 3 marks true or false like question came. That is, the question is, once buyback is completed, company is not allowed to make buyback within the next 6 months, and the shares involved in the buyback should not be issued for the next 12 months. True or false? Answer is false. Exactly reverse they told. In the question, exactly reverse they told. Fresh buyback can't be possible for the next 12 months, and issue of the bought back shares is not possible for these 6 months. Remember exceptions: bonus shares, conversion of the warrants, stock options, preference shares, debentures into equity. You can utilize same class of shares, no problem. Once buyback is done, maintain a separate register, update all the dates, update all the things in the register. After completion of buyback, file a final form with ROC, and if you are a listed company, file with SEBI also. That is within 30 days of completion of buyback. In case of non-compliance, punishment 1 lakh to 3 lakhs to the company, 1 lakh to 3 lakhs. Same punishment is to the officers in default. If you have done buyback from the free reserves, CRR to be created. CRR will be utilized only for the purpose of issuing fully paid up bonus shares. Section 70. One time it was tested. Did you remember sources of finance in case of equity share capital with differential rights? 5 sources of finance are there, right? Preference, equity dividend, equity share capital, preference share capital, deposits, debentures, term loans. Write all these 5 points here itself. You can see repayment of deposits, redemption of debentures, redemption of preference shares, payment of dividends, repayment of any term loan or interest thereon. Write 5 sources of finance here, except interest on debentures. I read the Bear Act also. In that also, interest on debentures point is missing. Dividends both are covered. Dividends to any shareholder means maybe equity, maybe preference. So 5 sources of finance covered except interest on debentures. If you had these defaults, rectify them and wait for 3 years. Logic is very simple. If you are unable to repay debenture holders deposits, why are you going with buyback? So first repay them, wait for 3 years. Next year you can make buyback. Along with this, other non-compliance provisions are also there, like 92 non-compliance annual returns, 123 dividends, 127 books of accounts, 127 also dividends only, 129 financial statements. Non-compliance of these 4 sections also, buyback is prohibited. comply them, buyback is allowed. Clear? With this, buyback completed. Let's summarize all the limits that are there in buyback, starting with monetary limits, amount of buyback, and the type of resolution we need. So here, if the amount required for making buyback is 10% of paid up equity share capital plus free reserves plus securities premium, then board resolution is enough. Beyond this, special resolution is required. And with special resolution also, you can make buyback. That means you can invest into the buyback up to 25% of paid up share capital plus free reserves plus securities premium. Clear? So maximum investment with the members approval you can invest in buyback is 25% of paid up share capital plus free reserves plus securities premium. If it is up to 10%, board resolution is enough. But in any financial year you take, company can make buyback of maximum 25% of paid up equity share capital. So this is with respect to number of shares. One is amount required for making buyback, and the other one is number of shares that can be bought back in each and every financial year. Next, coming to the time limits, if I pass board resolution or if I pass special resolution, depending on the situation, this resolution will have a validity period of 12 months. That means what? Buyback should be completed within 12 months from the date of passing resolution. Clear? And once buyback is completed, for example, 1st January 2026 buyback started and 31st March, for example, imagine 31st January 26 buyback completed. 31st January 26. Now, when can I make fresh buyback, sir? Sir, can I make fresh buyback 1 year after 1st January or 1 year after 31st January? And the answer is 31st January. So when buyback got closed, so closure of buyback, you can't make fresh buyback up to 1 year. Minimum 1 year you have to wait. That's what going concern assumption is telling. Next one. Yes, before making buyback, it is a duty of company to file a document with ROC. Yes, that is letter of offer. And this letter of offer shall be dispatched to members of the company. Within how many days? Within 20 days of filing with ROC. Yes, company should dispatch all these letter of the offer documents to the members. And in that letter of offer, you will find offer period. It should be minimum 15 days. Maximum 30 days. Clear? And from the closure of offer period, offer period closed here. From the closure of offer period, company will have 15 days to verify the applications. So 15 days time limit is for verification of applications. Once verification is done, within 7 days, payment should be done. Payment should be released. Suppose company is unable to make payment because company received more applications. In that case, it is the duty of company to communicate rejection of application within 21 days. It is the duty of company to communicate your application got rejected. Rejection communication. Simply about communication of rejection should be done within 21 days from the closure of offer period. Understood? So with this time limits in this buyback completed. Next, related to the filings. So declaration of solvency is there, return of buyback is there. Declaration of solvency. In the declaration of solvency, you will find a period of 12 months. Next 12 months, company will do business. Even if company enters into liquidation phase, company assets are sufficient to discharge its liabilities. Next one, return of buyback shall be filed by company, with ROC. If company is listed, then with SEBI also. Within how many days? Within 30 days. So next one, post buyback. Two more time limits are there. One is destruction or extinguishment of securities. Destruction of shares that were bought back. So what is the time limit for destruction of shares? 7 days. Next one, once buyback is completed, next 6 months, company shall not issue same class of shares. Even rights issue also prohibited. But what are permitted within the next 6 months? Bonus issue permitted, Next one, conversion of warrants into the shares, preference shares into shares, ESOPs and sweat equity shares are permitted. So these are the total limits, time limits and monetary limits that are there in buyback. Clear? Next, let's proceed with the next topic, that is debentures. If you look at the definition of the debenture, it is not an exhaustive definition, it is an inclusive definition. Here the word debenture was not defined and the list of items were given. So if you see, debenture includes debenture stock, bonds, instruments evidencing debt. Debenture stock is similar to the stock, the definition which we read in share. Share means share of the company. Share means share in the share capital of the company and includes a stock. So debenture stock is also bundle of debentures only. And next one, any instrument evidencing debt to the company, it becomes a debenture. You mention any name, you call that instrument any name, but if it is evidencing debt to the company, it becomes debenture. And debenture excludes the instruments that are specified in RBI Act 1934, Chapter 3D instruments. Let's see the material. The instruments that are mentioned under Chapter 3D of RBI Act, even though they evidence debt to the company, they are not treated as debentures. That means Section 71 is not applicable to such instruments and other instruments prescribed by the central government in consultation with RBI. So this is a future point. It's not relevant right now. So what is excluded from the definition of debenture? Only instruments that are specified in Chapter 3D of RBI Act. They will not be treated as debentures. In the features of debentures, C point I already covered in section 46. Whether it is a share certificate or debenture certificate, it will be valid only if it is under common seal of the company or it's signed by 2 directors or 1 director and 1 company secretary. Same point is there in section 46 also. So here the most important point is F. As per section 71 subsection 2 of the act, debentures do not carry voting rights. See, they are creditors, outsiders. They're not owners of the company, so they should not be given any voting rights. If a company issues debentures with voting rights, such issue will be treated as void. Ultra virus, simply ultra virus as to the act. Next one. So if you look at the definition of debenture, yes, debentures includes debenture stock, bonds, any other instrument of a company evidencing a debt, whether constituting a charge on the assets of the company or not. If charge was created, the debenture is a secured debenture. If charge was not created, it is unsecured. So section 71 is applicable to both secured debentures as well as unsecured debentures. Next one. So debentures may be redeemed in full at the end of the term or in installments. So debentures, company cannot issue irredeemable debentures. So debentures are redeemable in nature only. And the terms of issue may allow conversion of debentures into equity shares at the maturity at the option of the debenture holders. Such debentures are known as optionally fully convertible debentures. I discussed with you in section 62 also. Section 62, in case company issue convertible debentures, already at the time of issue, company has passed special resolution. Therefore, at the time of conversion, one more special resolution required or not required. Section 62 exception. Next one. What is the time limit for issue of debenture certificates? 6 months from the date of allotment. Sir, in case of transfer, within 1 month of submission of documents, for registration. So section 56 limits. Next one, issue and redemption of debentures. So this is the section 71. Section 71, let's see. A company may issue debentures with an option to convert them into shares wholly or partly at the time of redemption. That means debentures can be convertible debentures or non-convertible debentures. In prospectus chapter in section 42, I clearly told. So issue, if the issue is with respect to equity or preference or convertible debentures, every time one special resolution is required. If it is non-convertible debentures, then you have to check the borrowing powers of the company. Because of this issue, because of this proposed issue, you have to check, what is the outstanding debt, plus proposed issue. If it is up to 100% of the paid up share capital of the company plus free reserves and securities premium of the company, then board resolution is sufficient, or else one special resolution shall be taken for all the issues that will be covered in that year. I told, right? So that point you need to remember. See, if borrowings from the debentures exceed company's paid up share capital, free reserves and securities premium, special resolution is required. Sir, what type of debentures is this? Non-convertible debentures. If borrowings do not exceed the above limits, board resolution is sufficient, and temporary loans from the banks are not considered as borrowings. For example, overdraft facility, short-term loan facilities. Short-term loan facilities are not covered. In this outstanding debt, we will consider only long-term loans. Temporary loans are not considered. Next one. Issue of convertible debentures require special resolution. No negotiation. If they are convertible debentures, again comparing with 100% of the paid up share capital plus free reserves plus securities premium, will come or will not come? Will not come. Even if it is a single debenture also, special resolution is compulsory. Can I proceed? Next one, secured debentures. Third point I already covered. Debentures do not carry voting rights. And fourth point, redemption period cannot exceed 10 years from the issue date. Can you tell me what is the duration of preference shares? What is the redemption period for the preference shares? 20. And in case of infrastructure companies, 30. Provided 21st year onwards, every year how much redemption should be done? 10% I told. Here, installment wise redemption is not there. Either 10 years, normal companies. Infra companies, companies setting up infra projects, for example, L&T, GMR. Infra finance companies, suppose L&T Infra Finance, for example, L&T Finance, which is financing infra companies. Infrastructure debt fund NBFCs, and companies permitted by regulatory authorities such as CG Ministry or Department, RBI, National Housing Bank, any other statutory authority. For these 4 companies, technically there are only 3 companies. Fourth one will be permitted by the authorities. So which 3 companies can issue debentures for 30 years? Infra companies, infra finance companies, infra debt fund NBFCs. These 3 companies can issue debentures with a maximum redemption period of 30 years. A charge is created on company assets for secured debentures. Next one, debenture trustee appointment. Debenture trustee appointment. First of all, when debenture trustee is required, in 7th point you can see, if a company issue debentures to the public or its members exceeding 500, rights issue. For example, letter of offer only will be given. So if the number of existing members exceeds 500, that means more than 500, or if debentures are offered to the public, then company must appoint 1 or more debenture trustees and issue a prospectus for public offer. If you are going with public at a large, prospectus is compulsory. In that prospectus, you have to name the debenture trustee. So company shall appoint a debenture trustee before issue of prospectus or letter of offer for subscription of its debentures. Sir, why both the documents are there? See, prospectus is for public at a large. Letter of offer is given to the members. Very simple point, you can easily understand. See, if after qualification, if you want a job, so what will you do? You will prepare a resume and you will send it to the interested companies, yes or no? Whenever company need funds, if company is going to public at a large, it will also prepare as a document. In our terminology, resume, but company's at point of view, prospectus. If company is going to the identified persons up to 200, there also company will prepare a resume. But technically we call it as private placement offer cum application letter. If company is going to the existing members, then company will give letter of offer. Document names different because purpose is different. Clear? So letter of offer is given to the existing members, whereas prospectus is given to the public at a large, and private placement is given to the private placement offer cum application letter is given to the identified persons. So written consent from the proposed debenture trustee must be obtained before appointment. That is for sure. Before naming someone, even if you see nomination clause in OPC, before naming someone as a nominee, yes, we should obtain written consent from the nominee. And before naming someone as a director of the company, we should obtain written consent from the director, proposed director. Here also same, from the proposed debenture trustee, we need to obtain written consent. Debenture trust deed shall be executed in Form SH12 to protect the interest of the debenture holders within 3 months of closure of issue or offer period. Within 3 months of closure of the issue or letter of offer period, debenture trust deed shall be executed. See, this is an agreement between 2 parties. One is company and the other one is debenture trustee. Sir, why trustees are? Very simple, Who are the owners of the company? Members. And you all know separate legal entity concept. Company is separated from its members, right? So can members participate in day-to-day affairs of the company? No. But every year, members can attend general meeting. Members can make some crucial decisions. So since they are owners, they are allowed to general meeting. What about the debenture holders? Are they are the owners of the company? They're just creditors. They can't participate in day-to-day affairs. They can't attend general meeting. Then how their interest will be protected? To safeguard the interest of debenture holders, there should be one person. Simply, to protect the interest of shareholders, we are having auditor, right? Auditor will audit the financial statements and express the opinion. So similar to auditor, for debenture holders, debenture trustee will be there. And the agreement between company and debenture holders is executed between company and debenture trustee. Trustee, he is just in charge of debenture holders' interest. Disqualifications of debenture trustee important. From this topic, either you can expect that limits 100% of the paid up share capital plus free reserves plus securities premium, or you can expect a practical question on disqualifications of debenture trustee. Following people are disqualified. Following people are disqualified to act as debenture trustees. Sir, who are these people? Beneficiary holding shares. Beneficiary holding shares in the company. See ma, here two types of ownership will be there ma. Legal ownership, beneficial ownership. For example, company C Limited is there. Company C Limited is there. I am holding 1000 shares in C Limited. I am holding 1000 shares in C Limited. I am having legal ownership, but I am not holding these shares for myself. I am holding these shares on behalf of T. So now who is T? Beneficial owner. And who is Mr. V? Legal owner. Debenture trustee disqualification, it is not talking about legal owner. Even though you may be a legal owner, you can still be debenture trustee, provided you should not have any beneficial interest. So in my example, two persons are there, Mr. T and Mr. V. Now who is disqualified according to this first point? T is disqualified, no beneficial interest. Sir, is V allowed? Yes, allowed. Suppose V is having both legal interest as well as beneficial interest, sir. Now V is also disqualified. Second one, promoter, director, KMP, officer or employee of the cash companies. Cash means company, associate, subsidiary, holding. Promoter, director, so KDP, KMP, director, promoter, EO, employee, officer. KDP, EO of cash companies, disqualified. Next one, relative of promoter, director, KMP of just company. Here it's not cash company, it's just company. Relative of KDP, EO not covered, only KDP relative of our company is also disqualified. Beneficiary entitled to receive payments from the company, I call him as creditor ma. Entitled to receive payments from the company means creditor only. So creditor is also disqualified, but we had an exception, except as remuneration payable to the debenture trustee. Trustee rendering services, definitely he expects some remuneration. Now, is he entitled to receive payments from the company? Yes, but he is not disqualified. Other than trustee, any person entitled to receive payments from the company, disqualified. Next one, anyone indebted to the company. Indebted means debtor. Debtor of cash plus SH. 5 companies are there here. 5 companies, cash plus SH. Company, associate, subsidiary, holding, subsidiary of holding, simply fellow subsidiary. Total 5 companies. And next one, anyone who has furnished guarantee for the principal debt. Guarantee, nothing but surety. Surety. Suppose you are the debenture holders. Company is issuing debentures to you. I am the guarantor. Guarantor means tomorrow if company don't pay, I am liable to you. If I am appointed as debenture trustee, if I was appointed as debenture trustee, yes, some manipulations are happening in the company. As a result, your interest will be affected. Now it's my duty to communicate such manipulations to you. But if I communicate with you, immediately you will ask company to pay the amount. Company will not repay. Immediately you will ask guarantor to pay you will ask guarantor to repay the amount. Who is the guarantor? Me only. Getting my point? See, if you observe all these disqualifications, since independence is getting affected, they are getting disqualified. Getting my point? All these people are decision makers of the company. So they will not communicate their decisions if they are against to the debenture holders. Next one, and the creditor debtor also you can see, debtor is undue influence. Debtor is having undue influence with the company. Creditor will also have some kind of undue influence only. Sir, creditor is dominant party. No, sir. If creditor is straightforward, if creditor want to communicate with the debenture holders, company may tell like this. If you communicate everything with the debenture holders, we won't pay you amounts. I'll go to court. Okay, go to the court. Pending cases almost 5.2 crore cases are pending. Average time period required to settle the case is 5 to 20 years. That's what. Okay, fine. Next one. Anyone having a pecuniary relationship with the company amounting to 2% or more of the company's gross turnover or total income or 50 lakhs or more, whichever is lower. Two limits, statutory limit 50 lakhs. And percentage wise 2% of the company's turnover or income. Suppose I'm the Asian Paints dealer for Tamil Nadu. Asian Paints dealer for Tamil Nadu. Asian Paints is the company which manufacture paints, and I'm the authorized dealer for Tamil Nadu. Whenever I need stock, immediately I will pay the amount and I'll get the stock. That means I'm neither debtor nor creditor. Neither debtor nor creditor. So there is no relationship, no sir, debtor creditor relationship. Can I be appointed as debenture trustee? Answer is no. Why? Because if I take actions against to the company may cancel my dealership. That pressure will be there on me. So that's why any kind of pecuniary relationship, they're asking material relationship, they're not asking even a single rupee relationship there, you'll be disqualified. They're not telling like that. Material relationship. What is the material relationship? 2% of the company's turnover or total income of the company, or 50 lakh rupees, whichever is lower. That means during the financial year and two immediately preceding financial years, observe carefully here, 2 plus 1, 2 is preceding financial year, 1 is current financial year. So total 3 years, current year and immediately preceding 2 years. So in these 3 years, total amount of transactions per annum, if it exceeds 50 lakh rupees, disqualified. Why 50 lakhs? Because 2% of the company's turnover will be in thousands of the crores, thousands crores. So naturally 50 lakhs would be the minimum amount only. So in any year, if the limit is crossed at 50 lakhs, I'll be disqualified. Next one, filling casual vacancy. Before issue of debentures, company appointed Mr. A as debenture trustee. Now A resigned from the position, or A died, or A disqualified. Now there arises vacancy, casual vacancy. The board may fill any casual vacancy in the trustee office. If it is caused by resignation, it requires approval of majority debenture holders. Simply ratification. Majority of debenture holders should approve the new debenture trustee appointment. A trustee can be removed with the approval of holders of not less than 3/4 in value of outstanding debentures at the meeting. Observe carefully, here majority means more than half. Here 3/4 in value. Suppose outstanding debentures is 100 crores. 3/4 in value means simply 75 crores worth debenture holders. 75 crores worth debentures holders must give approval for removal of the trustee. Debenture trustee must protect the interest of the debenture holders and can convene the meetings to address doubts, grievances on receiving a request from the debenture holders holding at least 1/10 of the value. See, debenture holders meeting will be convened by debenture trustee either on suo motu basis or when there is a demand from the debenture holders. But the demand should be raised by the debenture holders having at least 1/10 of the outstanding debentures value. It's not 1/10 of the number of debenture holders. It's not number. It's 1/10 of the debentures value. That means 10 crore rupees. Any terms exempting trustee liability for breach of trust is void unless approved by the holders of not less than 3/4 in value of outstanding debentures. So this point the meaning of this point is, suppose in a trust deed, company told that even though you are negligent, you will not get any punishment. So will he be protected because of this clause in the debenture trust deed? No. But he will be protected if it is approved by the 3/4 in value of the outstanding debentures. Simply it's like special resolution only. So from the debenture holders, if they are holding 3/4 of the outstanding debentures, if they give permission, if they give approval, debenture trustee can be protected from negligent activities. These are common points, general points. Company must pay interest and redeem debentures according to the terms. If the company assets are insufficient to discharge liability, then trustee can file a petition to the tribunal to impose restrictions on further liabilities. If company fails to redeem debentures at maturity or pay interest on due dates, tribunal can order immediate redemption and payment. See, This is an anticipatory breach, and this is actual breach. In Indian Contract Act, we had two types of breaches: anticipatory, actual. Actual means on due date you are making a default. Anticipatory means before due date you are making a default. So here, according to B point, right now my total assets value is 30 crores and my total outstanding debentures, say for example outstanding debentures is 40 crores. If companies still incur new liabilities, the debenture holders may not get complete amount because already company's financial position is bad. So don't incur new liabilities. For getting that order, trustee can file a petition with a tribunal. Whereas C point, on or after date of maturity, company is not paying the debenture amount. Now, any debenture holder can file a petition with tribunal. Tribunal will order for immediate payment. A contract to take and pay for debentures can be enforced through a court order that is for specific performance. Next one, central government may prescribe procedures for securing the issue of debentures, form of debentures trust deed, inspection and obtaining copies of the trust deed, quantum of debenture redemption reserve. All these things CG is having power to prescribe. Last point, debenture redemption reserve. CRR is different, DRR is different. CRR, capital redemption reserve, we create post buyback, post redemption. But DRR is something we create before redemption. And this is like a savings. This is nothing but a savings. Debenture redemption reserve is a saving. To meet future obligation, yes, company has to accumulate some savings. So how much DRR should be created? 10%. To which companies DRR is applicable? First you can see all India financial institutions exempted, banking companies exempted, listed companies also exempted. Then unlisted companies which are other than all India financial institutions, other than banking companies, they need to create 10% of outstanding debenture value as DRR. Whether it is publicly placed debenture or privately placed debenture. Next one, investment requirements. See, reserve means keeping profits aside, and that profits can be utilized only for redemption of debentures. Investment means whatever amounts you kept aside, you have to invest them in liquid assets. And there is a mistake. Actually, there is a mistake. How much amount I'm keeping aside? 10%. How much I can invest max to max? 10. But lawmaker is asking me to invest 15%. Getting my point? Previously it is like this, 25%. Sorry, before it is like more than 15% we need to keep a reserve, and 15% we need to make investment. But that was reduced to 10%. This was not reduced. Okay, fine. So this is all about investments in the liquid assets. Liquid assets. So you can see here deposits with any scheduled bank, unencumbered securities. Unencumbered securities mentioned in clauses subclause A to D and E of section 20 of Indian Trust Act 1882. So in these securities you need to make investment. How much investment? 15%. On what, sir? On what? On debentures maturing during the financial year ending on 31st day of the March of the next year. Observe carefully, here 2 years are there. Debentures maturing the current financial year and maturing the 31st March of the next year. And this amount should be deposited on or before 30th April. Simply, standing on 30th April 2026, standing on 30th April 26, you have to invest 10% of, 15% of debentures maturing 26-27 financial year plus 27-28 financial year. So 2 financial years, current financial year, next financial year. What is the total amount of debentures that are getting matured? On that, apply 15%. That amount should be invested in the liquid assets on or before 30th April 2026. And usage, DRR and these investments cannot be used for other purposes. These amounts should be used only for the redemption of debentures. Clear? With this, debentures completed. Let's continue marathon with the next concept, accounts of companies, section 128 to section 138. Every company is required to maintain books of accounts. Based on books of accounts, company prepare financial statements, and directors will prepare one more report, that is board report. So both financial statements and board report, company is required to issue to the members. Not only these two, but also audit report. So every company is required to issue financial statements, board report and audit report to its members. Next one, certain class of companies are required to prepare quarterly financial statements, that is periodical financial results. Recently inserted section 129A. And these financial statements and board report may be revised, sometimes compulsory, other times voluntary. Compulsory change of financial statements, compulsory revision of financial statements means reopening of books of accounts. See, this section comes into the picture whenever there is a fraud in the company affairs. If authority believes that there is a fraud in the company affairs, so authority will order for section 130, that is reopening of books of accounts. Sir, there is no fraud, sir, there is error. Sir, what is the difference between fraud and error? Fraud is an intentional mistake. Error is unintentional mistake. For example, I bought a capital asset. By mistake, I charged it to profit and loss account. Capital expenditure, by mistake, charged it to P&L. I identified that mistake. It is unintentional mistake, so that is an error. You can rectify the error by voluntarily revising your financial statements and board report. So that is the difference between compulsory revision and voluntary revision. And in the financial statements, we will have various financial parameters: turnover, net profit, net worth. Based on these financial parameters, we will check applicability of 5 things. What are those 5 things? NFRA, applicability of NFRA, applicability of CSR, and mode of circulation of financial statements, mode of filing with ROC, and internal audit. So total how many concepts are there? 12 concepts. Each and every concept is important, because recent attempt, January 26 attempt, the questions they asked is applicability of XBRL filing, a minute concept. And next one, signing of financial statements and board report in case of one person company. So each and every minute point you have to understand and you have to remember. Chalo, let's begin. Starting with key definitions. See, three important definitions are there in this chapter. 3 important definitions. Of course, financial year we completed in general meetings chapter. Do you remember financial year? If date of incorporation is on or after 1st January, you tell me when the first financial year will be closed. 31st March of that year or 31st March of next year? 31st March of next year. In that case, the maximum duration of the first financial year will be 15 months. I told, right? So same concept, but you have to remember this point, Observe carefully. If a company or body corporate in India is a holding or subsidiary or associate of a company incorporated outside India and follows a different financial year for consolidating its accounts abroad, it can apply to the central government for approval to adopt the same financial year in India, and even if it is not exactly a year. That means, in India, one company is there, C Limited. Its holding company may be outside India, or its subsidiary company may be outside India, or its associate company may be outside India. And for the purpose of preparation of consolidated financial statements, definitely all these companies should follow same period as a concept, they should follow. Suppose my holding company or majority of my subsidiaries are outside India, they are following Jan to December as financial year. If I alone follow April to March as a financial year, period will not match, I can't prepare CFS. So that's why in that case, I can request central government. So tell me, who is having authority? Who is having authority to grant permission? Central government. If you file application with CG, if CG approves your application, you can follow different period as financial year. That means you can follow calendar year as a financial year. Remember, authority name, central government. Next, 2 definitions. Books of accounts, financial statements. Both are inclusive definitions. Books of accounts includes 4 items. How many items? 4 items. What are those items? Receipts and payments, sales and purchases, assets and liabilities, and cost records. Of course, last one is not applicable to all companies. It is applicable to prescribed manufacturing service companies. That means, last item is not applicable to trading entities, trading companies which are engaged in wholesale trade, retail trade. For them, it is not applicable. Only which are in manufacturing sector, which are in service sector, for them only it is applicable. Clear, everyone? So what are those 4 items? Receipts and payments, sales and purchases, assets and liabilities, cost records. Next one, financial statements includes 5 components. How many? 5. Balance sheet, profit and loss account. Of course, for section 8 companies, we should not use word profit and loss account. We should use word income and expenditure account. And third one is cash flow statement. Statement of changes in equity, explanatory notes, notes to accounts. In this third point is very, very important. Cash flow statement, very, very important. Just listen to me carefully. Yeah. There is a company, for example, C Private Limited. So cash flow statement, first cash flow statement, is it applicable to all companies? It is not applicable to 4 companies. How many companies? 4. What are those companies? OPC, small company, dormant company, that means inactive company, and private company, which is a startup, but that company should not have 2 defaults. Which 2 defaults? 92 section 92 default, section 137 default. That means they should be regular in filing financial statements with ROC, annual returns with ROC. Clear? Now listen carefully. C Private Limited company, paid up share capital is 20 lakhs, turnover is 20 crores. For the financial year 2025-26, company filed AOC 4, that means financial statements with ROC. 2 months later, ROC raised an objection stating that financial statements filed by C Private Limited does not contain cash flow statement. Do you agree with ROC objection? You tell me whether C Private Limited is required to prepare CFS or not required. Not required because it is a small company. Getting my point? But in a tricky way, they can also ask like this. Suppose C Foundation, which is a Section 8 company. Remember carefully, which is a Section 8 company. Its capital is 20 lakhs. And the gross receipts is 20 crores. Filed financial statements with ROC without cash flow statement. ROC raised an objection. Whether that objection valid or invalid? Valid or invalid? Valid. ROC objection is valid because small company excludes Section 8 company. Remember the point. Section 8 company will not come under small company definition. 5 companies, I told you, 5 companies will not come under the definition of small company. Which 5 companies? Public company, holding, subsidiary, Section 8 statutory companies. Clear? Yeah. Next one. Yes. 3 definitions we completed. Remember, cash flow statement is not applicable to OPC, small company, dormant company, and private startups. A private company recognized as a startup by a Department of Commerce and Industry under Companies Act 2013 or 1956. So startup company means, always remember, startup company means only private companies will get qualification startup. Only private companies, not all companies. Private companies gets startup recognition. Next one, compliance. Remember, compliance. Financial statements should comply with FAT rules. Which rules? FAT rules. F stands for form. What is a form? Schedule 3. A stands for accounting standards. T stands for true and fair view. Schedule 3 amendments. Yes, Division 1 talks about AS, Division 2 Ind AS. And central government is having power, of course, specified IFSC companies, subsidiary of foreign companies can align their financial year with our holding company without CG approval. Sir, why tribunals are, before amendment, before, 2018, the power is with tribunal for changing the year, But right now power is with the central government. I told you for changing the year concept, you have to file an application with CG. But for IFSC companies, no need to file application. Directly you can follow different period as financial year. That means relaxation, that's it. Next one, section 128, books of accounts. Section 128, books of accounts. See, there is no limitation or there is no relaxation. Every company shall prepare books of accounts for every financial year, irrespective of operations. Sir, this year there is no operations, sir, but still you have to maintain books of accounts. No sales, maintain books of accounts, which must give true and fair view of state of affairs of the company, branch office, transactions happened at registered office as well as branches. Okay, so first point, it is about maintenance of books of accounts, every company. Second point, on what basis, sir? Cash basis or accrual basis? Accrual. Remember, LLP can maintain books of accounts, cash accrual. But for companies, always accrual. And which system? Double entry system. That means both debit and credit aspect should be recorded. Next one, place of keeping books of accounts. Sir, where to keep books of accounts? Always registered office. Books of accounts and financial statements always shall be kept at registered office. If you remember, books of accounts, books and paper, 2 definitions are there. Note point. I didn't told, just you see here. Books and paper includes books of accounts, deeds, vouchers, writing, document, minutes, registers maintained on paper or in electronic form. So the difference is, in books of accounts you will find financial information. In books and paper you will find both financial information and non-financial information. Minutes, for example, MOA, AOA, vouchers, everything comes under books and paper. Books of accounts means only those 4 components, only those 4 items. Now if you observe carefully, what he is asking to maintain at register of is books of accounts. That means, sir, what about minutes? Minutes again 2 types. Yesterday I told you, minutes 2 types. General meeting minutes, board meeting minutes. General meeting minutes compulsory at register office only. But board meeting minutes you can maintain at any place in India. Yes or no? Is he asking books and paper to be maintained at register office? No, he is asking books of accounts to be maintained at registered office. Next one, at any other location. Here there is a hidden point. There is a hidden point. 2 attempts back, I think September 25 attempt, this hidden point was tested. Suppose my company is having 10 branches. My company is having 10 branches. 9 in India, 1 is outside India. Sir, can I maintain books of accounts with respect to branches at branch premises? Yes, but for that these 2 conditions should be satisfied. And sir, head office books of accounts also, can I maintain them at any place other than registered office? You can maintain only when these 2 conditions are satisfied. Sir, which 2 conditions, sir? Board can decide to keep books at any other place. That means board resolution is compulsory. And second one, within 7 days of board resolution, company shall file a notice with ROC indicating the new address of such place. That means branch books of accounts also, if you want to maintain books of accounts at branch premises, you should comply with this provision. And they will confuse you in examination by asking whether it is board approval or members approval. Remember, books of accounts will contain confidential data. Members will keep on changing. Maybe our competitor might purchase our share and come to the registered office. If he is allowed to verify books of accounts, all our trade secrets will be looted. So that's why books of accounts, there is no access to the members. So for change of books of accounts address, for changing, for shifting books of accounts from registered office to any other place in India, whose approval required? Board approval. Board approval. Don't get confused. Members approval is not required. Next one, So 2 conditions. First one, board resolution. Second one, communication with ROC. Within how many days? 7 days. Next one, books of accounts at branch office. If company has a branch office in or outside India, it must maintain proper books of accounts at that place, at that office, which comply with section 128 subsection 1. That means this point only. If the books are maintained outside India, quarterly summary returns shall be sent to the register office. These must be kept open for director's inspection. See, books of accounts at branches, these branches, how many types, 2 types, Indian branch, foreign branch. For foreign branch, he is telling quarterly. Whereas for Indian branches, periodically. It's your wish. Monthly, 2 months once, 3 months once, it's your wish. But branch is outside India. Every quarter, completion of every quarter, they should send summarized returns to the head office. Getting my point? So quarterly summary returns, remember, it is not applicable to all branches. It is applicable only to foreign branches. Next one, inspection of books of accounts. Sir, who can inspect books of accounts? Option A, members. Option B, directors. Option C, authorized persons. Simply in brackets I am writing, having power of attorney given by the directors. And option D, all of the above. All of the above. So question, who can inspect books of accounts? Members, directors, persons who are authorized by the board of directors. Option D, all of the above. For example, option D instead of all of the above, both B and C. Both B and C. You understand the question? May 25 attempt. May 25 attempt. This point was tested for 5 marks. Descriptive question. 5 marks, this point was tested. Who can inspect books of accounts? Undoubtedly, one option is correct, directors. Even directors cannot authorize outsider or any other person to inspect books of accounts on his behalf. Suppose, sir, I'm financially illiterate. Sorry, Companies Act point of view, I'm illiterate. That means I know nothing about Companies Act. So can I appoint a chartered accountant who can carry inspection on my behalf? No. No. Getting my point? Only director can inspect books of accounts. And remember ma, here companies two types ma. Companies two types. One is company, other one is holding company and subsidiary company. Holding company and subsidiary company. Simply let me write here subsidiary. Sir, I'm a director of the holding company. Can I carry inspection of subsidiary books of accounts? Yes, with board approval. Yes, with board approval. Whereas to inspect my company books of accounts, board approval is not required. Any director can inspect books of accounts of the company, but to inspect subsidiary books of accounts, you should be authorized by the board. Any director, whether non-executive or executive, non-executive or executive, example, non-executive example, nominee, independent and executive director, promoter, whole-time director, can inspect books of accounts during business hours. So midnight 12 o'clock, if you knock the door, if you ask, I came here to inspect books of accounts, is there any obligation on the company management to provide inspection? No. A director can inspect the books of subsidiary only if he is authorized by the board resolution. So simply here you can write company books of accounts can be inspected by any director, whereas subsidiary books of accounts can be inspected by authorized director. Authorized director. Who will authorize this director? Board of directors. Next one, assistance from the officers and employees. Officers and employees must provide reasonable assistance during inspection of books and papers. Suppose director is asking, bring all the sale invoices, and accounts manager is telling, sir, go to that room, you will find the records right top corner. Can he tell like that? No. He should provide all the reasonable assistance. Financial information outside India. If a director needs financial information maintained outside India, they shall furnish a request detailing the information and the period. And the company must provide requested information within 15 days of the request. Directors can seek the information individually, not through attorney, agent, representative. Here you have to remember this 15 days. Once a director is requesting foreign branch office to submit records, within how many days they should submit the records? 15 days. 15 days. Sir, what about Indian branch, sir? Indian branch in India only, no. Whenever we ask, immediately they should submit. But foreign branch, 15 days. Preservation of books of accounts, another important point. Sir, how long I should maintain books of accounts? 8 financial years books of accounts I need to maintain. Answer my question. 8 financial year means current year books of accounts I should maintain for the next 8 years. Or last 8 years books of accounts I need to maintain. Both options are same only. Both options are same only. Current year books of accounts maintaining for the next 8 years, or 8 years books of accounts I'm maintaining this year, means both are same only. But as per law terminology, last 8 years books of accounts I need to maintain. Sir, I was incorporated in the year 2024, sir. I'm just 2 years old company, sir. How can I maintain 8 years books of accounts? That means period of existence. In that case, period of existence or 8 years, whichever is less. Getting my point? Sir, my company is Sachem Computers, sir. Recently I did a scam. Government ordered me to maintain books of accounts for 16 years. Now for how many years I should maintain books of accounts? 16 years. So if an investigation is ordered under chapter 14, the central government may extend preservation period beyond 8 years. So tell me, who is having authority to increase that period of 8 years? Central government. Can I proceed? Entire section compliance responsibility is with MD, whole-time director, in charge of finance, and CFO. Or else any other person charged by the board with the duty to comply with section 128. That means if books of accounts are not up to date, if books or accounts are not following double entry system, not on accrual basis, then these people will get punishment. Sir, what is the punishment, sir? 50,000, maximum 5 lakhs. Minimum 50,000, maximum 5 lakhs. An important point, books of accounts in electronic form. May 25 attempt or September 25. I didn't remember the attempt number, but last year only in 2025, this point was tested for, I think, 2 to 4 marks. Books of accounts in electronic form. So tell me, can a company maintain books of accounts in electronic form? Yes. But the conditions, remember 7 conditions, 7 important conditions. First one is they should remain accessible in India. They should remain accessible in India. To understand this point, once upon a time, government banned PUBG app, PUBG game. But still our Indians, our people, our brothers and sisters, what they did, they installed VPN, one app, virtual private network. They changed the location, India to Russia, India to China, like that. And then they installed the game, they played the game. That means, is that app accessible in India or not accessible in India? not accessible in India. It should not be like that. Books of accounts in electronic form should be accessible in India. Next one, audit trail and edit log. Audit trail and edit log. For companies using accounting software like SAP, Tally, they must that software must have audit trail, edit log, and it should not be disabled. Sir, audit trail means, suppose I'm posting an entry like, I made a sale, data or account debit to sale account. It is 1 lakh rupees. Who entered this transaction? Mr. V. When, say for example, some 16th March, time 4 p.m. So the creator of the entry, the complete details should be there. Suppose next day I'm changing the entry. It's not 1 lakh, 1,20,000. When this entry got edited, so history must simply, when it was created, source, when it got edited, everything should be recorded. That is what audit trail and edit log. So it should be enabled or disabled, or it should be enabled. Retention in the original or accurate form. See, when you are entering data in English language, whenever you want to open that file, same English language only it should come. Yes or no? Sometimes, in mobile, if you see, if you change the language, application language will be changed. It should not be like that. Retention should be in original and accurate form. Branch office data should remain unaltered. Next one, legible form. Electronic record must be legible and capable of being displayed clearly. Whenever you want to access that file, whenever you want to open the file, that file should be opened. Storage and retrieval. Storage, retrieval, display, printout of the records. Proper system must exist. That means there should be a storage. Say for example, if you take Apple mobiles, iPhones, max to max 2 days call data will be there. 2 days call data only will be there. A third day or fourth day call data will be erased automatically. Android mobiles, I think 30 days storage is there. But here, the system, the accounting software you're using, it should have capability of storage, retrieval. Whenever you want to reopen it, it should be opened, it should be displayed, and printout should also be possible. Backup. Remember periodicity. Sir, how many times I should take backup in a year, sir? Daily 1 backup. Daily, how many times? 1 backup. Daily 1 time backup should be maintained. And filings with ROC. Yes, who is providing accounting software services? Mention the service provider name, IP address, location of the service provider. If cloud storage is used, address provided by the service provider. For example, today, if you take Google Drive, 15 GB, everyone of us getting. Whenever you open Google Gmail account, you'll get free, how much data? 15 GB. Free storage 15 GB, right? So similarly, this Tally software is also can be maintained on cloud. Then you have to provide these details. So who is providing this storage facilities, cloud storage facilities? You need to mention the details. If service provider is outside India, provide details of the person in control of the records in India. That means authorized person or representative from India. Next, can I proceed? 128 over. Next one, 129, financial statements. 129, financial statements. Remember, financial statements, rules, FAT rules. F stands for Form Schedule 3. A stands for Accounting Standards. When you complete these two things, automatically financial statements will give true and fair view. But FAT is not applicable to big companies. FAT is not applicable to big companies. Banking, insurance, generation and distribution of electricity. Why? Because for them, separate schedules are there. Financial statement, different schedules are there. Provision calculation, different formats, different calculation criteria is there. So it's enough if they follow their respective schedules. Listed companies, SEBI regulations, normal. Laying of financial statements at AGM. The board of directors must lay the financial statements before AGM for each year. So that's what, in ordinary business we have seen ADDA. What is A stands for? Adoption of financial statements. For adoption of financial statements, directors has to place financial statements in front of members at AGM. So that is nothing but laying of financial statements at AGM. CFS. Remember, if our company is having one or more subsidiary, associate, joint venture companies, when our company is having one or more, that means one company also enough, one or more subsidiary, associate, joint ventures, then our company is required to prepare consolidated financial statements. In which form? In the same form. For standalone financial statements, which form you are following? Same form, Schedule 3. Comply with accounting standards. Attach a separate statement of salient features of subsidiaries and associates in E-form AOC 1. Salient features, nothing but, summary ma. Generally financial statements, around it would be some 50 pages. 50 pages. Suppose, my company is having 300 subsidiaries. Complete set of financial statements of 300 subsidiaries means it will go around 1500 pages. So lawmaker is not asking complete set. He's just asking a summary, brief. So next one, manner of consolidation. Manner of consolidation, I told you, schedule 3 AS to be followed. If company is not required to prepare CFS under AS, it is sufficient if it complies with schedule 3. Many students had a confusion with this point. Sir, what is this point? Suppose I'm having 10 subsidiaries. One of these 10 subsidiaries is immaterial. Say for example, my turnover is 1 lakh crore That subsidiary turnover is just 1 lakh rupee. 1 lakh crore, 1 lakh rupees. Material, immaterial, immaterial. So AS is giving exemption. No need to prepare, no need to include that subsidiary company information in you. But if you want to add it, okay, you just comply with schedule 3 norms. AS not applicable. AS is telling no need to prepare. But if you want to still prepare, you can prepare as per schedule 3 norms. Next, a company without subsidiaries but having associate companies, having joint venture companies is exempted for the first financial year. This is just a relaxation for the first financial year only. When Companies Act was enacted, when this section was notified as on 1st April 2014. So first year relaxation was given. Not important right now. Next one. This rule does not apply to the companies consolidating financial statements for subsidiaries incorporated outside India from 1st April 2014. That means in case if you are having foreign subsidiaries, company having foreign subsidiaries, no relaxation, you have to prepare financial statements. Can I proceed? Now, this is another tricky point. So far not came, it might come. What is the general rule, ma? Every company having one or more subsidiary, associate, joint venture companies should prepare consolidated financial statements as per AS. But if 3 conditions are satisfied, how many conditions? If 3 conditions are satisfied, my company is not required to prepare CFS. Sir, what are the three conditions? First one, my company is a wholly owned or partially owned subsidiary and all other members have been intimated in writing, have not objected with the proof of delivery available. See, look at the screen. See, my company is having subsidiary. Generally, C Limited is required to prepare CFS along with standalone financial statements. CFS is required. But when 3 conditions are satisfied, CFS is not applicable. First condition, C Limited is a subsidiary to another company. What? C Limited is a subsidiary to another company. Maybe wholly owned subsidiary or partly owned subsidiary. That means more than 50% up to 100%. If it is 100% wholly owned subsidiary or else partly owned subsidiary. In my example, 99% was held by H Limited and remaining 1% was held by some 9 people. How many members? 9 members. According to condition number 1, all these 9 members should give NOC. NOC by other members. I repeat, NOC by other members. What is this NOC? Sir, even if you don't prepare CFS, we don't have any objection. Even if you don't prepare CFS, we don't have any objection. First point. Second point, neither listed nor in the process of listing. Neither listed nor in the process of listing. My company should be unlisted. And third condition, H Limited should prepare CFS covering C and S. Ultimate holding company is there, right? H Limited. Ultimate holding company should prepare consolidated financial statements including the figures of my company as well as my subsidiary company. If these 3 conditions are satisfied, CFS is not applicable. Able to remember? Come on. Just recap these points, ma. When I'm exempted from preparation of CFS, I'm either wholly owned or partly owned subsidiary to another company where my members, all other members, give permission in writing stating that no need to prepare CFS. And second one, neither listed nor in the process of listing. And third one, my ultimate holding company prepare CFS. That's it, ma. Whatever provisions applicable to SFS are equally applicable to CFS. That means in the general meeting, not only standalone financial statements, but also consolidated financial statements require approval of the members. Okay, na? In general meetings, I forgot to ask one point, ma. All ordinary business items require ordinary resolution and all special business items require special resolution. True or false? All ordinary business items require ordinary resolution. Special business items require special resolution. True or false? False, 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 false. Because special resolution depends on Companies Act and AOA. For example, you take bonus issue, special or ordinary business, special business, but OR is enough. Rectification of name, special business, OR is enough. Differential voting rights, special business, but OR is enough. Clear? So type of resolution depends on Companies Act and AOA. Fine, ma, fine. Non-compliance. Sir, I am unable to comply AS or Ind AS. Then what should I do? You have to disclose it. You have to make disclosures. Which AS you didn't comply? For example, ma, inventory. What is the AS2 is telling? Inventory, regarding valuation of inventory. Cost or NRV, whichever is lower. Suppose cost is 80 crores, NRV is 100 crores. Sorry, NRV is 60 crores. How much value I should enter into the balance sheet? 60. But I am showing it as 80. Now tell me which standard I deviated? AS2. Deviation from the standard, AS2. Reasons. Explain the reasons. Explain the reasons. Maybe pandemic time, that's why prices fallen, sir. But once pandemic is over, once this war pandemic is over, automatically my prices will go up, sir. My NRV will go up, sir. So this is a temporary adjustment, like that, convey the reasons. And financial effects, sir, because of non-compliance of AS2, 20 crores, how much? The difference between 80 and 60. 20 crores worth of stock was overstated. Net profit was overstated by 20 crores. Like that, you specify the reasons. You specify the financial effects of the deviation. And of course, CG is having complete powers to exempt any class or classes of companies from complying with the above provisions. And CG will give permission considering public interest. For example, segment reporting, you all know segment reporting. If defense companies follow that segment reporting, if defense companies specify that we are having some 2 nuclear bombs in Chennai, 1 nuclear bomb in, for example, Bangalore, and some military, factories at Delhi, etc. If you tell those details, our enemy country will first target those bases only. Next one, penal provisions. Penal provisions. Over, 129 over. Non-compliance of section 129. Like, I'm not preparing CFS. Applicable but not preparing. Or I'm not following AS. And I'm not telling the reasons. I'm not telling the reasons which AS I deviated. Or if I don't prepare financial statements. In these cases, the penal provisions, it is imprisonment up to 1 year, fine 50,000 to 5 lakhs, both. Who will get punishment? Same. Section 128 people are there, no? Section 128 people. MD, whole time director in charge of finance. Next one, CFO. And any other person authorized by the board. Same, but you have to remember all directors. You have to add one more point, all directors. See, when all directors get punishment, when the above mentioned 4 people are not there. Which 4 people? MD not there. Whole time director finance not there. Next one, CFO not there. Person authorized by the directors also not there. No one is there. Then who will get punishment? All the directors will get punishment. What is the punishment? There it is 50,000 to 5 lakhs. Here 50,000 to 5 lakhs common. In addition, imprisonment up to 1 year or both. 129 over. Next one, 129A. 129A. Already for listed companies, this periodical financial results concept is applicable. So this section 129A talks about unlisted companies to prepare periodic financial results. The form and frequency will be as prescribed. Unlisted companies. Day 1 prospectus chapter I discussed with you. Day 1, no, day 2. Day 2, I think. Day 2 I discussed with you. Listed, unlisted. Come on, tell me, 3 companies are not treated as listed companies. Which 3 companies? No. Public company, equity shares unlisted, NCD issued under private placement basis, listed, unlisted company. Next one, NCPS, non-convertible preference shares, issued under private placement basis. Next one, private company, issuing NCD, not preference shares, only NCD, under private placement basis. And last one, company which is listing its equity shares outside India in foreign jurisdiction. But equity shares were not listed in India. Remember those four unlisted company, 4 exceptions. 4 exceptions, remember. Next one, The board of directors must approve the periodic results. Periodical results must undergo either a full audit or limited review in the manner prescribed. A copy of periodical results must be filed with ROC within 30 days of completing the relevant period along with the applicable fees. So what is the time limit for filing periodical financial results with ROC? 30 days. 30 days from the completion of period. If you remember GST, 3B should be filed by 20th of the next month, right? Periodical financial results should be filed by 30th of the completion of quarter. Say for example, if quarterly financial quarterly is that periodicity. If quarterly is the periodicity, within 30 days of the closed off quarter. Can I proceed? Next one, 130. 130, reopening of books of accounts. Reopening of books of accounts. Remember ma, here there should be an application ma. There should be an application. That application can be by CG, income tax authorities, SEBI, any statutory body. For example, SEBI also statutory body, right? Or concerned person. So for the time being, I'll write only three names, CG, income tax authorities, SEBI. Other two names, any concerned person or any other statutory body. They have to file an application with either court or NCLT for reopening of books of accounts. That means this is not done on suo motu basis. Court or tribunal will not react on suo motu basis. Court or tribunal requires an application in writing from, that application should be by CG, IT, SEBI, any other statutory body or any person, any concerned person. Most of the cases, not most of the cases, almost, SEBI will come for listed companies only. That means for all companies, which two persons are common? CG and IT. Okay, na? So the court or tribunal may pass an order to revise and recast financial statements if court or tribunal is having a belief that earlier accounts were prepared fraudulently or the company affairs were completely mismanaged, leading to unreliable financial statements. Suppose my turnover is 200 crores ma. If this amount is getting reported, for example, if I report this amount, I may get bank overdraft facility. How much? Only 40 crores I will get. To get more finances, what I did, I inflated the turnover by another 100 crores. So now I got more finance from the bank. But is this correct? Fraudulent financial reporting. Fraudulent financial reporting. Case 1. Case 2. Company affairs were mismanaged. Say for example, Shivaji company, you remember Shivaji Foundation, Shivaji Rajini sir movie. Using some money laundering techniques and hawala techniques, he converted black money into white money. So these are the examples where court or tribunal will react, will pass an order to revise the books of accounts. The court or tribunal shall give notice to the applicant and consider the representations before passing any order. Representations means what, Suppose, if CG is filing an application with court will ask IT department, court will ask SEBI what to do. That means if CG is filing a notice, court will immediately send that notice to the IT and SEBI. Suppose if IT department is sending notice to the court, then court will forward it to CG and SEBI and will ask whatever you want to tell, you can tell. Getting my point? If one party is filing application, it will forward that application to other parties and it will ask for representations. Next one, revised accounts. The accounts that are revised and recast shall be final. An important point, this one time 4 marks or 5 marks question came. The question is like this, man. The question is like this. First understand the question. We are in which financial year, ma? 26-27. Correct, financial year 26-27. Just 10 days only. Financial year 26-27. Income tax department, while investigating the company books of accounts C Limited, income tax department came to know that 2011-12 record should be reopened and filed an application with court. Whether court is having power to grant permission or not is the question. And the answer is no. Why no? Every company is required to maintain books of accounts only for the last 8 years. 11-12 is something beyond the 8 years. So no order can be made for reopening of books of accounts for a period earlier than 8 financial years immediately preceding the current financial year. If CG orders books to be retained longer than 8 years, then accounts can be reopened for the extended period. Suppose CG already ordered C Limited to maintain books of accounts of 20 years. Now 11-12 records can be reopened. All of you getting my point? So in section 130 ma, only remember 2 points ma. First, who is having permission to order for reopening? Court or tribunal? And who will file application? IT, central government, SEBI, person concerned, statutory authority. And second one, how long books of accounts? If you go back, for how many years books of accounts can be reopened? 8 years. Or any period extended in case of CG order. For CG already ordered company to maintain more than 8 years. Then more than 8 years books of accounts can also be reopened. So remember these 2 points. And also criteria. Third point is criteria. What is the criteria for applying section 130? The point is either financial statements were prepared fraudulently or affairs has been mismanaged. Clear? Next, 131, voluntary revision of financial statements. In 131, remember, financial statements not complied with section 129 or board report not complied with section 134. Financial statements not complied with 129, board report not complied with 134, then only 131 will apply. In 130, there is no limit on revision. No limit on revision means revision can be to any area, any particular ledger in the books of accounts can be revised. There is no limitation. But coming to section 131, there is a limitation. The limitation is you can rectify only financial statements and board report, that too non-compliance of 129 and 134. I told one example, right? Suppose I bought a capital asset. By mistake, I charged it to profit and loss account. Sir, is there any deviation of 129? Yes, there is a deviation. What 129 is telling? Financial statement should comply with which rules? FAT rules. In FAT, A stands for what? Accounting standards. Accounting standards, it is clearly telling, capital expenditure to be capitalized, revenue expenditure to be charged to the profit and loss account. So since I failed to comply with AS, I can revise my financial statements. But is this an intentional fraud or unintentional error? Unintentional error. Fraud is covered under 130, error is covered under section 131. So if the directors find that financial statement or board report does not comply with 129, 134, they can prepare a revised financial statements or revised report for the 3 preceding financial years. Oh my god, here one more difference is there. Revision, you can go for how many years? 3 preceding financial years. So standing in 26-27, you can revise 25-26, 24-25, 23-24. Sir, 22-23, can I revise it, sir? No, 3 years only. Whereas 130, 8 years. Or any period extended by the central government. Next one. Revision can now only occur with the prior approval of the tribunal. This is another difference, ma. Under section 130, either court or tribunal can grant permission. But here, who will grant permission? Only tribunal. Only tribunal. Through an application by the company. Oh my god. Section 130 application can be filed by CG or IT or SEBI or any person concerned, statutory authority. But here application is filed by company. File an application in form NCLT1 within 14 days of board's decision. Oh my god. See, board decided to revise the financial statements. So when board resolution was passed, within 14 days, file NCLT1 with the tribunal. File form NCLT1 with the tribunal. And file the certified tribunal order with ROC within 30 days of the receipt. Tribunal will take a decision whether to revise it or not, whether we approve or reject. Whatever order passed by the tribunal, communicate the same with the ROC. Can I proceed? The tribunal will notify CG, SEBI, tax authorities or any other relevant party, and the tribunal will consider any representations made by these parties before issuing an order. Suppose I told you, right, instead of capitalizing the expenditure, I charged it as a revenue. Immediately tribunal will ask, hey my dear IT department, this fellow is increasing the profit. Ask him to pay extra tax. That's it. Revision is allowed only once. Revision is allowed only once. A revised statement or report can be filed only once in a financial year. You have to understand this one. Revised only once in a financial year means preceding 3 financial year financial statements or board report, you can revise only once. Second time revision not allowed. See, this is not with respect to application year. Suppose I'm filing application in 26-27. I'm filing application in which year? 26-27. It's not about when you are filing the application. It's about revision of which year. Sir, I want to revise for 24-25. I want to revise 25-26. So can I file 2 applications at a time? You can file it. But once you revise 24-25 and 25-26, second time subsequent revision allowed or not allowed? Not allowed. You can revise only once. All 3 years revisions you can file one time application. Getting my point? But revision limited to one time only. Once revised, subsequently can't be revised. Once revised, it can't be revised again for the same period. Tricky point, one time it came. Detailed reasons for the revision must be disclosed in the board report of the relevant financial year in which such revision is being made. Suppose I want to rectify 24-25 mistakes. When I am rectifying these mistakes, 26-27. I identified this mistake in which year? 26-27. Which year? 24-25. That year board of directors report, I can't prepare it right now because it was already prepared. So when you are preparing board report for 26-27, you incorporate the changes which you did for 24-25 and communicate with the members. Limits of revision. Revisions are limited to 129-134 but not others, and necessary consequential alterations. Framing of rules by the CG. CG may create rules to guide the revision process, such as replacing supplementing documents to indicate the correctness. Original financial statements to be removed and revised financial statements should be placed in public domain, right? So that all the things. Defining the role of auditors for revised documents. So for revised documents, one more time audit required. Yes, definitely required. And what is the duties of the auditor while auditing revised financial statements? So role of the auditor, prescribing steps for the directors. The next one, application must include financial year related to the accounts 24-25. Contact details of the director, CFO and company secretary for that financial year. Who is the director for 24-25, CFO 24-25, and also mention auditor name. Is auditor doing meditation while doing audit? How he missed out this kind of mistakes? And board resolution copy. Board resolution copy. Application must include all these things and grounds for the revision. Disclosure if auditor or director changed before applying. That means I'm talking about old management only. Sir, old management is still continuing, sir. Then this point will not come. Old management changed, sir. Then only this point will come. That's what I told you. Who were the directors at the time? Who was the MD? Because only these people, if you remember, MD, whole-time director finance, CFO, these people are responsible for maintenance of books of accounts, preparation and presentation of financial statements. Speed okay na? Next, advertisement of the application is required 14 days before the hearing date. Oh my god. See, prior advertisement prior advertisement. First, once you file application with here you see, once you file application with tribunal will fix a hearing date. So the next hearing will be after 30 days. Tribunal will fix a hearing date where tribunal will raise questions and you need to give answers. So that means appointment date, for example, when you can meet tribunal is, that is what? Hearing date, appointment date. So tribunal will fix a date. Prior to that date, 14 days before that date, advertise in newspapers. Getting my point? I'll tell you all the limits, just wait. Tribunal shall issue notice to the auditor and heard him before passing an order. After approval, general meeting may be called and reasons for revision must be published in 2 languages. After approval, general meeting should be called because members gave approval to original financial statements. What about revised financial statements? For revised financial statements also, approval is required. But this is EGM. At the general meeting, revised financial statement, board report, auditor statement will be considered and approved revision shall be filed with ROC within 30 days of general meeting approval. Oh my god. Now see So the time limits. First, board of directors passed resolution to revise financial statements. Imagine this is day 0. From here onwards, within 14 days, day 14, application shall be filed with NCLT. 14 only, right? 14 days, right? Yeah, 14 days. 14 days. NCLT will fix one hearing date, NCLT will fix one hearing date. 14 days before that hearing date. 14 days before hearing date. That means day minus 14, minus 14. Hearing date minus 14 days. By this time, advertisement should be done. Advertisement should be done at least 14 days. Understood? Everyone? Now, say for example, NCLT gave approval here, ma. NCLT gave approval here. Within 30 days, file a copy with ROC, NCLT order. File NCLT order with ROC within how many days? 30 days. Getting my point? 14 days of board resolution, 14 days before hearing date, and 30 days after NCLT order. 30 days after NCLT order. And one more filing is there. What is that one more filing? 30 days of general meeting approval. This is, you know what, you fixed AGM, for example, some other time, EGM, you fixed EGM. So EGM, for example, day 0, where the revised financial statements were approved. From this date onwards, again within 30 days, by day 30, you file revised financial statements with ROC. So company has to file revised financial statements with ROC. Total ma, ROC filings, 2 filings ma. How many ROC filings are there? 2 filings. One is NCLT order, other one is revised financial statements. Clear? Both 30 days only. Next one, advertisement 14 days before hearing. Application with NCLT 14 days, within 14 days after board resolution. 14, 14, 30, 30. One is post board resolution, other one is before hearing. Next one is 30 days after NCLT order, 30 days after general meeting. I mean within 30 days, Can you remember? Can be tested, ma. This can be tested because 130, section 130 came multiple times. More than 3 times section 130 was tested. 131 not yet tested, can be tested. Next, NFRA. In NFRA, first you need to understand applicability of NFRA, duties of NFRA, composition of NFRA, and punishments by NFRA. Getting my point? Applicability. To which companies NFRA is applicable? Next one, their powers and duties. Their composition, and the punishments. Let me go through this. So who is having power to constitute NFRA? CG. Next one, NFRA main objective is protection of public interest. Satyam computers, after Satyam's computer scam, many new concepts came. For example, rotation of auditors. And after this PNB scam also, government want to shift power from ICA to NFRA regarding monitoring these auditors. The role of ICA should be conducting examination and qualifying the students. That's it. So if NFRA gets complete powers, of course it already got complete powers, ICA will lose its powers. The role of ICA will be limited to the conduct of examinations only. Okay, fine ma. So NFRA main objective is protecting public interest. How they will protect public interest? They ensure that financial reports prepared by the company are absolutely correct. It will be correct only when there is a high quality AS and SA compliance. So who will comply AS? Companies, accounting standards. Who will comply SAS? Auditors, standards on auditing. Functions of NFRA: maintain auditor details, make recommendations to CG, monitor and enforce compliance with these standards. See, ICI recommend accounting standards and standards on auditing to NFRA. NFRA further recommends to central government. That is second point. First point, maintain auditor details. Not all auditor details. Auditors of the entities governed by NFRA. Reliance is governed by NFRA, so Reliance auditor will be monitored by the NFRA. Suppose there is a small company, for example, Sanders Private Limited, small company. It is not under NFRA governance. It is not governed by NFRA, and I am the auditor of that company. Will NFRA control me? Will NFRA govern me? No. Not all auditors. Only auditors of the covered entities. Last one, monitor and enforce compliance with the standards, whether you are complying with the standards or not. NFRA recommendation process, just now I told you ICA recommend to NFRA, NFRA further recommend to CG. Give one time reading. Complaints and oversight. NFRA review financial statements of companies NFRA requests additional documents and explanations from the company and director. If necessary, NFRA may require the presence of company officers and auditors. Sir, what about this B point? I will mail you. You give me that information. C point, you come to me. I'll inquire you. Non-compliance findings are published on NFRA website. It's like insult only. Insult only. If NFRA identifies violation of accounting standards, it may investigate further and take enforcement action. All these are powers and duties of NFRA only. Next one, monitoring and enforcing auditing standards. For that, auditor, bring your audit working papers and show me your quality control systems. I will evaluate them and conduct additional testing, supplementary audits or test audits. Require auditors to report on governance practices. Seek extra information, and also if at all needed, auditor personal presence also they may demand. Conduct monitoring and enforcement through experienced officers or experts. Publish again audit non-compliance findings. Above one is AS non-compliance findings. AS non-compliance findings. Below one is SCA non-compliance findings. Publish on NFRA website. Exception, proprietary confidential information unless necessary for the public interest with recorded reasons. Next, submit a confidential report with the sensitive information to the central government. So NFRA is like one department under central government. So what are all the things happen, it will send a confidential report to the central government. Overseeing service quality, just give one time reading, because still remember May 25, September 25. May 25, September 25, NFRA duties, same question repeated, 5 marks, 5 marks. So mostly this May attempt, this question will not come, but we don't know. That's why remember 4 to 5 points, general 4 to 5 points. Instead of leaving that question, you can write that 4 to 5 points. Direct auditors to improve audit process, implement improvements, track progress, and experts will help NFRA in how checking and monitoring the activities, oversight and monitoring the activities. NFRA works to raise awareness about AS and SCS. NFRA collaborates with global national audit regulators. For example, international financial reporting standards, IFRS. So for that, I think USA, gap, like that. In India, NFRA department is there, right? So in other countries, similar departments will be there. These NFRA will collaborate with them to improve the accounting standards and auditing standards. NFRA performs any additional functions necessary to fulfill its mandate instructions. This is a newly added point, you will not find in the material. Just observe it carefully. If an individual auditor is doing a mistake, the punishment would be 1 lakh rupees to 5 times of the fees received. Minimum 1 lakh to maximum 5 times of the fees received. Partnership firm, 5 lakhs to 10 times of the fees received. There is a penalty to the audit firm. This is the penalty to the audit firm. Sometimes debarment will also be there. Debar, like if you are doing some cheating practices in examination, next 3 items will be debarred, right? Like that. So audit firm may be debarred from being appointed as an auditor or internal auditor or performing valuation. Sima, stat audit debarred, not only audit but also valuation. Valuation things can also, you can't do valuation things also. And period of debarment, minimum 6 months, maximum 10 years. Appeal, aggrieved person may appeal to the appellate tribunal. That means the auditor who was debarred, if he want, he can prefer, he can refer an appeal to the, he can appeal to the appellate tribunal. Can I proceed, everyone? So 1 lakh to 5 times, 5 lakh to 10 times. Partnership firm is more than one individual. That's why it will be more, 5 lakhs to 10 times. Whereas individual, 1 lakh to 5 times, 5 times of the fees received. Can I proceed? So simply, if you are writing, write like this. No need to copy entire thing. 1 lakh to 5 times of audit remuneration. In case of partnership firm, 5 lakhs to 10 times of the audit remuneration. And period of debarment, 6 months to 10 years. And next one, appellate tribunal. You can appeal to appellate tribunal. These 4 points, remember. Can I proceed? Next one, composition of NFRA. Composition of NFRA. NFRA consists of chairperson and other members not exceeding 15. So who appoints or who will constitute, who is having power to constitute NFRA? Obviously, central government. The chairperson will be a person having expertise knowledge in accounts, auditing, finance, law. Other members may be part-time or full-timers. Each division is presided by the chairman and a full-time member authorized by them, either chairperson or full-time member. That means part-time member cannot take chairperson position of the divisions. See, these divisions means NFRA might have departments like this. One division is for AS, other division is for SA, other division is for secretarial standards, other division for cost accounting standards, cost audit standards. So each division will be headed by chairperson of NFRA or any other full-time member. Any other full-time member. So this is an executive body, consists of chairperson and full-time members to ensure efficient discharge of the functions. Appointment of the chairperson and other members is done by CG, already known point only. Chairperson and members must declare no conflict of interest. This is nothing but they must declare that they are independent. There is no conflict of interest. Suppose I'm a chartered accountant. I'm a practicing chartered accountant. I'm also doing audit of Reliance Industry Limited, for example. If I was appointed as chairperson of NFRA, so will I order anything on my firm, whether that firm is negligent or whether that firm is complying with the rules and regulations or not? Will I order anything on my firm? No. That means there is some interest. So the point is there should be no conflict of interest. Full-time chairperson and members cannot be associated with any audit or related consultancy firm during their tenure and 2 years post tenure. Remember, current tenure plus after retirement next 2 years. After retirement next 2 years, you should not go in connection with any audit firm. That means you should not have any kind of undue influences. Part-time members include, representative from MCA, CNDG representative, RBI representative, SEBI representative, ICA president, chairperson, 2 experts in accountancy, auditing, finance and law. And CG may also appoint a secretary and other employees as needed for efficient functioning of NFRA. So meetings, normally AGM once in a year, right? Board meetings, 4 board meetings in a year. Whereas small company OPC can have 2 board meetings in a year. Like that NFRA meetings also. Frequency of the meetings and place of the meeting, everything CG will prescribe. No need to read that points. CG may appoint a secretary and other employees as necessary for efficient functioning of the NFRA, like managers, supervisors, etc., etc. That means CG will provide necessary resources for discharge of functions, duties. Head office, this you need to no need to remember, but remember head office of NFRA is at where? New Delhi. Okay, in this composition you have to remember one chairperson and other members not exceeding 15. They may be part-time or full-time, and each division will have a head of chairperson or any other member, but he should be full-time. Only those 2 points enough. Next, important, this is really important. Classes of companies governed by NFRA, five companies. First one, straight away without any limits, listed company. Every listed company is under the control of, every listed company is governed by NFRA. Next, unlisted public companies, because public interest is there in public companies only, not in private companies. Unlisted public company satisfying any of the following, any of the following 3 parameters they have mentioned: paid up share capital 500 crores or more, or annual turnover 1000 crores or more, or outstanding loans, debentures, deposits 500 crores or more as of 31st March of immediately preceding financial year. Listed company, no financial parameters. Whereas unlisted company, 3 parameters they are mentioning: paid up capital, turnover, loans. Remember like this: paid up capital, turnover, loans. Paid up capital, what is the limit? 500. Turnover, what is the limit? 1000. Loans, what is the limit? 500. PTL. Can I proceed? Next one, special entities, nothing but big companies. What are the big companies? Banking, insurance, electricity generation or distribution, and special acts, body corporates incorporated by an act. For example, LIC. LIC is a body corporate incorporated by LIC Act. Next one, entities referred by CG, nothing but prescribed entities. CG will prescribe few entities for which NFRA is applicable. Any company, body corporate or person referred by CG to the NFRA in public interest. In public interest. Suppose you take Vodafone Idea. Of course, it is a listed company. Imagine it is an unlisted company and also not falling in the above categories. But CG is thinking about Vodafone Idea. A lot of public interest is there. Now CG may refer Vodafone Idea to NFRA. Next one, E point, tricky point. So chances of coming in examination is very high. What is this E point? Subsidiary or associate company of A to D above, if its income or net worth exceeds 20% of the consolidated income or net worth of the parent company. Oh my god. See what they are telling. Suppose Reliance Industry Limited is there. It's a listed company already covered in A. Reliance Industry is having a subsidiary company, Geo Platforms Limited. Geo Platforms Limited. Imagine Geo Platforms Limited paid up share capital is 500 crores. Geo Platform Limited will be covered under B point. B point. But Geo Platform Limited, imagine it is not falling in second category. Now open CFS of Reliance Industry Limited. In this, from which subsidiary 20% of turnover, sorry, 20% of the income, 20% of the net worth, from which subsidiary we are getting? That material subsidiary, material associate companies will also be governed by NFRA. Getting my point? Everyone? Materiality means how much percentage? Remember, 20 percentage. 20. Remember, 20% of the income, 20% of the net worth, exceeding 20%. Next. So here you have to remember that these subsidiary associate companies were registered outside India. Remember this point. Subsidiary or associate company registered outside India. But from these subsidiaries and associate companies, if Indian company is getting 20% of its net worth or 20% of its income consolidated basis, then those companies are also governed by NFRA. And let me correct it, it's not 20%, it's greater than 20%. Exceeds 20 means greater than 20%. Clear? Can I proceed? Yeah. Next one, it's about existing body corporates already covered under these rules. Once after commencement of the rules, within 30 days of commencement of the rules, they need to update the details with the NFRA. These people are our auditors, these people are our company auditors, like that. Report them. Company or body corporate remains governed by NFRA for 3 years after it ceases to be listed, or its paid up capital, turnover, loans, debentures, deposits fall below the prescribed limits. Suppose AB points are there, right? Sir, last year listed companies are, this year all the securities got delisted, now I am unlisted company. So NFRA still control me or will not control? Will control. How long? 3 years. Once you come out of the scope, AB points, once you come out of AB points, but still next 3 years also you will be monitored by, you will be regulated by NFRA. If company officers in default, auditors, other persons contravenes NFRA rules, they will get punishment under section 450. So with this, the biggest section 132 completed So in the entire NFRA, we have seen composition, powers and functions, punishment, and then NFRA governing companies. So total 4 points. In this again, I'm telling you, NFRA governing companies important. You have to remember. How many are there 5. Easy to remember. Listed, unlisted public company with paid up share capital 500, turnover 1000, loans 500. Over. Next one, big companies, statutory companies, special companies. Okay. Over. Next one is CG prescribed entities. And last one is material subsidiary, material associate companies registered outside India. But from these companies are Indian companies. Which companies? A, B, C, D, above companies. On consolidation basis, having net worth or income more than 20% from these subsidiaries and associates. Can I proceed? Yeah. So this is the Bare Act text. This is the Bare Act text. So whenever you want, you can refer it to it, but no problem. Body corporate, incorporated or registered outside India. Fine. Next one. 133, very simple 133. If you are following schedule 3, you need to apply accounting standards. See here preparation of financial statements, presentation of financial statements. So 2 concepts are there Preparation means we are preparing the financial statements. Presentation means display simply. Presentation point of view, form schedule 3 is applicable. Form Schedule 3 is applicable. Which format you can present? Form Schedule 3. But preparation point of view, AS is applicable. Sir, preparation of presentation, what is the difference? Valuation of closing stock, AS. Valuation of fixed assets, AS. Getting my point? Cash flow statement, next one, investment accounts, for example, everything is AS. So while you are preparing financial statements, comply with AS. Presentation of financial statements, comply with Schedule 3. Who will recommend accounting standards, or who is having power to declare accounting standards? CG. CG will get recommendation from NFRA. NFRA gets recommendation from ICA. ICA gets recommendation from NACAS. Advisory committee it's a. Okay na? Next one ma. With this 133 also over. Next 134. In the entire section 134, remember signing of financial statements. Only signing of financial statements is important. Contents of the board of directors report, it's a theory question only ma. You can remember the points, what are the contents of the board report, you can remember the points, but signing is very important. Sir, who will sign the financial statements and board report? Signing two ma. One is financial statements, other one is board report. Financial statements shall be signed by chairman if authorized ma. If authorized by board of directors. In brackets BOD means what? Sorry. In brackets BR means what? Board authorization. Sir, there is no chairperson or not authorized by the board, sir. Then two directors, one should be managing director. This is A. Either chairperson or two directors, one should be MD. And next B, in case company is having CEO, CFO, CS, they should also sign it. If appointed, they should sign it. They should sign financial statements. Are you all getting my point? Option B, when it is applicable, if these people are present in your company, they will sign. Not present, sir. No need. Not present means what? Not appointed. Then B is not applicable. But compulsory signing should be done by either chairperson or two directors. One should be MD. Coming to the board report, only one option will be there ma. Chairperson if authorized by board of directors, or two directors, one should be managing director. CEO, CFO, CS, they will not sign board report because it's a report by the directors to the members. CEO, CFO, CS, they are KMP. But not fall in the board. Are you all getting my point? And one extra point you have to remember, that is OPC. Sir, myself only one director of company. In OPC, how many minimum directors are there? One. Private two directors are there, so two directors condition can be satisfied. But OPC only one director is there. No. If that one director signing the financial statements, complaints is there. Getting my point? Can I proceed? This point was tested in the last attempt. And if they want to ask a tricky question, I have seen in the case scenario booklet ma. I have seen this concept in case scenario booklet. How they will ask question, company is having a three directors, MD Ram, WTD Rahul, and other director, say for example Ravi, and company is also having CEO Mr. Raghu. Company is also having CFO Mr. For example Anil. Now financial statements were signed by, they will mention like this: financial statements were signed by Rahul, Ravi, Raghu. Whether this signing valid or invalid? Whether the signing is valid or invalid. Why? Two directors should sign. Rahul and Ravi signed, but where is MD? Out of two, one should be whom? MD. So MD signature missing. Next one, CEO, CFO if appointed, they both should sign. Only Raghu signature is there. Where is Anil signature? So like this, one MCQ is there. Getting my point? So four options. In one option you will find MD and CEO. In one option you will find other directors and CEO. In one option you will find MD plus CEO plus director, other director. Last one, some other different option. So can I proceed? Chairperson if authorized by board, or two directors, but one should be MD. And see, end means see ma, this is like 1 and 2, 1 and 2, but in one we are having alternative, in one we are having alternative, but there is no alternative to 2. If appointed, CEO, CFO, CS should sign it. For OPC, it's enough if it is signed by one director for submission to the auditor for his report thereon. Auditor report shall be attached to every financial statements, and signed copy of every financial statements including CFS must be issued, circulated, published along with notes to accounts, audit report, board report. See, these are attachments ma. Once financial statements company want to issue, once company want to issue financial statements, company can't issue financial statements in individual manner. Compulsory attachments, which are the, what are the attachments? Notes to accounts, N2A, notes to accounts, plus audit report, plus board report. In one practical question, in one attempt, I have seen it. I have seen a question. The question is, company want to circulate unaudited financial statements among the members of the company. Board of directors decide to circulate unaudited financial statements with members, among the members of the company. Whether such circulation valid or invalid. Financial statements means what type of financial statements? Audited or unaudited? Audited. Because when audit report is attached, automatically those financial statements becomes audited financial statements. Getting my point? Yeah. Next one, board report contents ma. Board report contents. This point you remember. Board report is completely based on standalone financial statements. The contents of the board report is prepared based on SFS or CFS? SFS, not CFS, only SFS. And the report should include highlights of the performance of subsidiary, associates, ventures, joint ventures, and their contribution to overall performance of the company during the reporting period. Board report shall always be prepared based on standalone financial statements. No two board reports, only one board report, that too based on standalone financial statements. And contents ma, website link where annual return is placed. The same point I have shown you in section 92. Website. Number of meetings of the board, minimum 4. Director responsibility statement. This is important point, can be tested. I will discuss with you. Wait. Fraud 143.12. In audit concept, I will discuss with you 143.12. Statement on declaration by the independent directors, and policy on directors remuneration appointment, directors appointment remuneration policy, and the qualifications by the auditor. Here auditor means not only company auditor but also cost auditor, secretarial auditor. What remarks they disclose and what is the reason for such remarks, board of directors should give explanations on remarks. Next one, 186 disclosures, section 186 disclosures, related party transactions disclosures, state of company affairs, nothing but balance sheet, amount proposed to be carried to the reserves, amount recommended for the dividends. See, automatically if this is retained earnings, my profit after tax minus retained earnings will be dividends. Material changes affecting financial position post financial year up to the report date. See ma, financial year closure date will be 31st March, right? Obviously financial year closure date will be 31st March. But do you think financial statements will be ready by 31st March? No. Suppose company took 2 months to close financial statements, 31st May 26. During these 2 months, April and May, any material changes happen in the company, you give them disclosures. You make a disclosures in the board report. Make a disclosure in board report. Information on conservation of energy, technology, and foreign exchange. How you are controlling the foreign exchange reserves. Controlling in the sense, if you are keep on relying on imports, if you don't export and if you keep on making imports, our foreign reserves will come down. So how you are saving foreign exchange, how you are saving over technology absorption, how you are saving energy for future generations ma. This is from future point of view. Yes or no? Power comes from coal. 100% if you utilize coal right now in this generation, what about future generations? That is the point. And next one, risk management policy, CSR initiatives. This another point ma. Another point, in case of listed company and public company with paid up share capital of 25 crores or more, a statement indicating manner in which formal annual evaluation of the performance of the board, its committees, and of individual directors has been made. See, this is like self evaluation ma. Self evaluation, very simple ma. In our board total 10 directors are there. Each and every director, how they contributed towards the success of the company. It's like a mark sheet only. Mark sheet, self evaluation. Each and every director contributed towards the success of the company like this. So this is not applicable to all companies. This is applicable only to the two companies, listed company and public company with paid up share capital of 25 crores or more. Remember, listed company and private or public, public companies with paid up share capital 25 crores or more. Only to these two companies formal annual evaluation is applicable. Next one, yeah, this is an amendment ma. In RTP this point is there. In RTP, no need to by heart this point, this highlighted point, that these 2 points are there in RTP. In recent RTP, 4 points are there. Two such points are there here. In rules, it was mentioned. Okay, Rule 8, financial summary highlights nature of business, directors appointments, resignations, and board opinion about the independent directors, their expertise, knowledge, integrity, and name of the companies that became subsidiaries in the current year, in the reporting year, joint ventures, and which companies got terminated, which companies came out of subsidiary relation, joint venture relation, associate relation, those details. Next one, deposits ma. At the beginning of year, what is the opening balance, outstanding. Current year, what is the highest balance we are having. At the end of the year, what is the closing balance. Details of the deposits which are not in compliance with the requirements of chapter 5. Material orders by the regulators, court, tribunals impacting going concern status. Then this will be in risk management policy only. About internal financial controls, about cost records, and about internal complaints committee about sexual harassment of women at workplace. During the year, how many complaints were received and how many complaints were resolved. Suppose 90 complaints were received, as 80 resolved, 10 pending. Out of this pending, how many cases are pending for more than 90 days? Extra point, that's it. Application proceedings under IBC. Suppose if company is under liquidation phase, or if company is under revival phase, say for example internal reconstruction, those details also you need to mention in a board report. And details of the difference between valuation done at the time of one-time settlement and while taking loan from the bank or financial institution. The meaning of this point is, suppose company C Limited took a loan on one factory from SBI. At the time of taking loan, suppose 2020 they took loan, the valuation of this property is 120 crores. Company is unable to pay the amount. As a result, SBI came and seized this property, sold this property under OTM. OTM means OTS. OTS means what? One time settlement. Outstanding balance some 100 crores is there. You are not able to pay the amount, right? We are taking this property. So at the time of settlement, what is the valuation? Suppose same valuation, sir. Oh, no difference. Okay, no problem. No, sir. At the time of settlement, valuation fall into 80 crores, sir. Then you have to mention why 40 crores was down, depreciation, like that. You have to mention the reasons. See, all these are one-time reading points only, because in examination they won't ask you what are the contents of the board report. Why? Because if you look at the quantum of the answer, it is approximately 1.5 page. If you write in the examination hall, it will go up to some 2.5 to 3 pages. So how they will ask 5 marks question? But simple points like, listed company and public company with paid up share capital 25 crores or more, for them formal annual evaluation is applicable. Those kind of points I want to tell you. And this sexual harassment cases, here 90 days is another point you need to remember. So for these 2 points only I'm reading all the things. And Maternity Benefit Act 1961 for female workers. Yes or no? 1 month before delivery date, how can you expect that employee to come to the office and work? So whether you are complying with Maternity Benefit Act 1961 or not, confirming a statement. Give me just a statement. Yes, we confirm. Sorry, we comply with this Maternity Benefit Act 1961 also, like that. Next one, board report signature. I already told you, board report signature. Who will sign board report? Either chairman or 2 directors. No CEO, no CFOs, no CS. Chairperson. If not authorized, 2 directors, one should be MD. Company with 1 director, signed by that single director. Punishment for contravention. Company penalty 3 lakhs, officer in default punishment 50,000. Next one, abridged board report. Same above points only, but here you will not find some points. For example, take small company. Yes, this abridged report is applicable to small company and OPC. if you see above points, in that one point is there details of subsidiary company, associate company, and financial performance of subsidiary company and associate company. Or if you take small and OPC can never invest in body corporates. Small company can never be holding or subsidiary. That means that information required or not required. Unnecessarily writing headings not applicable. Writing headings not applicable. Why? Remove that points. You will get a little bit board report contents. That is nothing but abridged. I told you abridged means either short or fast track. Just to give one time reading ma. Just give one time reading. No time limits are there, so that's why I'm ignoring it. Yeah, contents of DRS ma. Director responsibility statement. 6 points are there. 6 points. Very simple to remember. First thing, while preparing financial statements, we complete AS. If not, give the disclosures. Which AS you deviated, what is the financial effect, and what is the reason. AS. Next one, all the accounting policies we applied consistently. For example, do you remember LIFO, FIFO? So last year we followed FIFO. This year also I am following FIFO. There is no change in accounting policies. Therefore, true and fair view will not be affected. Next one, adequate accounting records to safeguard assets and prevent frauds and irregularities. You tell me, if cash book is not properly maintained, if asset register is not properly maintained, there is a chance of looting cash. There is a chance of looting assets. Yes or no? So yes, we maintain adequate accounting records. Our system is enough to prevent all the frauds and detect the frauds. And next one, financial statements were prepared based on going concern basis. Sima, financial statements we follow historical cost method. That means we show asset at cost only, not at fair market value. If you want to show asset at fair market value, it is possible only if company enters into the liquidation phase. That means if there is no going concern, then financial statements will be prepared based on realizable value basis, not going concern basis. Getting the difference? Going concern means historical cost we will follow. No going concern means we follow realizable value methods. Listed company, E point is applicable only for listed company. IFC was adequate and operating effectively. Internal financial controls. Next one, proper systems were devised to ensure compliance with all applicable laws and found adequate and operating effectively. See, today if you want to do business in India in the form of company, Companies Act is applicable. On turnover, GST is applicable. On profit, Income Tax Act is applicable. For related to employees, Code on Wages, okay, gratuity, PF, ESA, like that, n number of acts. And if you are doing some manufacturing operations, Factories Act is applicable. So whether there is a system to cover all this, to incorporate all the applicable laws or not, and whether we are following all the applicable laws or not. So you need to confirm. Total how many points ma? 6 points. First AS, next AP, accounting standards, accounting policies. Next one, safeguard of assets. Safeguard of assets. Next one, going concern. Going concern. And next one, IFC. And last one, system to ensure that all the applicable laws and regulations have been following. Regarding IFC 1 point. IFC, safeguarding company assets, frauds and errors, identify frauds and errors, maintain complete and error free, ensuring timely preparation of the accurate financial information. See, one example I want to tell you, one example. Suppose cashier is there. Whenever he collects the cash, he is recording an entry in the system. Suppose that editing of the entry, deletion of the entry, that power is also with the cashier. What he will do? What will he do before leaving the office? If he need extra cash, he will delete some 2-3 cash receipts and that amount he will loot it and he will go out. So you tell me whether proper controls are there or not there. Not there. That means the cashier who is updating the record, he should not have control over editing the entry, deleting the entry. That power should be given to some accounts manager or finance manager. That means segregation of duties, division of works. If it is proper, we can tell internal financial controls are there. If internal financial controls are there, no fraud will happen. Even if fraud happened, detection will be there. Like cashier, he took some cash, left it. Accounts manager, at the end of the day, system balance, physical cash balance, he will monitor, he will verify, immediately he will detect the fraud. That is the main objective of internal financial controls. That's it. You will learn about this point in your articles 134 over in 134 you have to remember signing, and next you have to remember DRS, director responsibility statement. And next, that annual evaluation, public companies with paid up share capital 25 crores or more, listed companies. Enough. Next, CSR, section 135, CSR. In CSR, first you need to understand applicability of CSR. Applicability of CSR. Just a summary I'll give here. Just a summary. See, applicability. When CSR is applicable, you tell me. Net worth of the company, any company you take, maybe it's a foreign company or maybe it's an Indian company, incorporation not matters. Incorporation in India or outside India is not a matter. If it is doing business in India, net worth 500 crores or more, turnover 1000 crores or more, net profit 5 crores or more, then CSR committee is applicable. What is applicable? CSR committee is applicable. Expenditure part is different, I'll tell you. Expenditure part is different. CSR committee is applicable. In CSR committee, how many directors should be there? General rule, GR, 3 directors. One should be independent director. One should be independent director. If independent director is not there, then 2 directors. 2 directors without independent director. In my company, independent director is not there, sir, and my company is a private company with 2 directors only. Then 2 directors. If it is a foreign company, directors will be outside India. So that's why I can't name the directors. Here I call them as authorized persons. Authorized persons. 2 authorized persons are required. A person means authorized person. But remember, CSR committee is not applicable if my total CSR commitment, CSR expenditure is 50 lakhs. My committee means what? Committee of directors. Committee of directors. So CSR committee means that committee will focus on business or committee will focus on CSR? CSR. So dedicated committee is not required if my commitment is 50 lakhs. Small amount only, for that small amount expenditure also, again having a dedicated committee, time waste to money waste. So if my CSR committee is 50 lakhs or less than 50 lakhs, CSR committee is not required. Remember, because September 25 attempt, the same point was tested. Whether CSR committee applicable or not applicable. General rule, once you cross these limits, CSR committee is applicable. But if it is up to 50 lakhs, CSR expenditure 50 lakhs, not applicable. Sir, CSR expenditure is how much, sir? CSR expenditure, how to calculate? Very simple. Average 3 years net profits, Average 3 financial year net profits. On that multiply with 2%. On that apply 2%. My 3-year profits, for example, 10, 15, 20, for example, if you average it, it will be 15 crores. 15 crores into 2% means how much? 15 crores into 2% means how much? I think 30 lakhs. 30 lakhs means less than or equal to 50 lakhs only, right? CSR committee applicable or not applicable? Not applicable. That's it. Now, the point is, when you are applying these parameters to foreign company, suppose Amazon is doing business in India. So financial parameters of 500,005, we need to check Amazon globally or Amazon in India only. Amazon in India only. For example, another example you take Netflix, for example. Netflix, it's incorporation outside India, USA, but doing business in India. From Indian subscribers, if they are getting 1000 crores turnover, applicable. Now 1000 crores turnover, is it from India or global turnover? I am checking Indian turnover. Understood, everyone? Yeah. So these points, yes, wherever limits come, I will explain it. Just observe carefully. So CSR, you have to remember these 6 activities. Excludes. They will ask how companies is having a CSR commitment of 6 crores. And company spent amount on the following activities. They will give some 5 activities and you need to tell whether it is a qualified CSR expenditure or disqualified CSR expenditure. If amount is spent for these 6 purposes, then it is disqualified CSR expenditure. What are those 6 activities? First one, activities in the normal business of the company except R&D related to COVID for financial year 20 to 23. Suppose Dr. Reddy Laboratories, I'm doing some research. Because of research, my company will be benefited. But the objective of CSR, it's not company. Society should be benefited. Of course, COVID pandemic time 20 to 23, that 3 years, okay, you can do research about your business also, we are permitting you. That means financial year 20 to 23, those 3 years, 2021, 21, 22, 22, 23, those 3 years, R&D expenditure by pharma companies is a qualified CSR expenditure. But right now, disqualified CSR expenditure. Okay, na? Next one, activities outside India. Are society to be benefited, ra? Which society? Our Indian society. Outside India, disqualified. But observe carefully, except. Excludes, except means two negatives, that means positive. What is the meaning? If you spend amount on this purpose, it is qualified CSR expenditure. This is qualified CSR expenditure. This is qualified CSR expenditure. Which one? Training Indian sports personnel at national or international level. Olympics, you all know. How many gold medals we are getting? Is it in 10 number or less than 10? Less than 10. Total medals, I think 4 to 5. So if you are training our people outside India, but still qualified CSR expenditure, excludes except, that means eligible. Next one, contribution to the political party. Society to be benefited, not political party. Activities benefiting company employees. Society to be benefited, not your employees, So if you spend amount on benefiting your employees, that is also disqualified CSR expenditure. Next, sponsorship activities. Best example, IPL, Kingfisher, RCB, I think. Yes or no? Now Kingfisher sponsorship fees, some 600 crores they are paying to franchisee. Is this a CSR expenditure? No, disqualified. Activities required for fulfillment of statutory obligations under any other law in India. Statutory obligations, like payment of taxes, for example. Suppose my company is having own land and building and it is paying municipal taxes. Payment of municipal taxes to the municipality, definitely society will get benefit. Since you are using the property, you are paying the tax. If you don't use the property, will you pay the tax? No. Now, is that a CSR expenditure, sir? No. Remember, 6 activities. Business activity, disqualified. Sponsorship, disqualified. Let me write here. Business, disqualified, but there is an exception. Exception is R&D 20 to 23 allowed. Sponsorship, disqualified. Political parties, disqualified. Employee benefits, disqualified. Outside India, disqualified. 1, 2, 3, 4, 5. One more point is there. Statutory obligation. Some statutory fees, for example. 6 amounts you have to remember, and one more is training outside India, our Indian personal people only. That is qualified expenditure. Can I proceed? Everyone? Next one, CSR committee. Yes, as usual, just give one time reading, Administrative overheads, all these are definitions. Yeah. Next, net profit. This you have to observe carefully. Under CSR, net profit means which profit? PBT. Profits before tax. It's not after tax. Profits before tax. Next, while calculating these profits, you should exclude two amounts. Sir, which two amounts, sir? I'm having a branch outside India. That branch is generating profit. You tell me that profit I earn from Indian society or outside Indian society? Outside Indian society. That amount is not responsible for CSR. So overseas profits excluded. Next, my company is receiving dividends from Indian companies. So dividend income excluded. No. I'm not telling dividend income is excluded. If you are receiving dividend from Indian company which is complying 135. Suppose Reliance Industries Limited is there, Jio Platforms Limited is there. Reliance Industries Limited is getting dividend from JPL. JPL already on their profit before taxes, they already calculated 2% and they incurred CSR expenditure. And remaining portion of profits, they are transferring to holding company. Now holding company again on the dividends, if they include it and if they calculate 2%, it will be like double time calculation is happening, like double taxation. You remember, cascading effect in GST, tax on taxes. Already the dividends which we received from that company, on that profit already that company incurred CSR expenditure. Getting my point, Sima? Another example, same company. Reliance is having 2 subsidiaries, Jio Platform, other one, for example, Jio Infocom Limited, Jio Infocom Limited. Jio Infocom, it is not covered under 135. From this company, dividends. From this company is receiving dividends. Now, whether these dividends included or excluded? Included. Only dividends that are received from the company which already complied section 135, those dividends are excluded. So which amounts are excluded? Overseas profits and dividends received from an Indian company which already complied section 135. Okay na? Ongoing project means, it's a more than 1 year project ma. Ongoing project means we can't finish it in the 1 year, but it should not cross 4 years. Sir, here it is 3. No sir, 3 excluding financial year in which it was commenced. Suppose ma 26-27 current financial year I started one project. Ongoing project means next 3 years excluding 26-27, that means 27-28, 28-29, 29-30. Excluding current year next 3 years means including this year 4 years, right? Or else remember like this, 1 plus 3, current year plus 3 years. It should be completed within next 3 years excluding current financial year. Remember, sir, can an ongoing project be 5 years, 6 years? No, 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 no. Next, net worth, very easy to determine. Net worth means all assets minus outstanding liabilities, or paid up share capital plus free reserves plus not free reserves, reserves and surplus. Paid up share capital plus reserves and surplus. But in this process you have to remember revaluation reserves, written back of depreciation, amalgamation reserves excluded, accumulated losses, deferred expenditure, miscellaneous expenditure excluded. Able to remember? Accumulated losses, deferred expenditure, miscellaneous expenditure are excluded. Okay na everyone? Section 135 is not applicable to IFSC companies for 5 years, not infinity. 5 years. Just now you came and you started business. Immediately if I ask you, come on, follow CSR means compliance burden. So up to 5 years not applicable. Administrative overheads ma. See ma, CSR committee is there, right? And to carry out CSR activities there may be a manager, supervisor, like that. So to run this system I had some 3 employees, for example. Now the salary is paid to these 3 employees. Whether society is getting benefited or no, we call them as overheads, administrative overheads. This administrative overheads shall not exceed 5% of CSR commitment. Suppose my CSR commitment, if it is 1 crore ma, if it is 1 crore into 5%, I can incur max to max 5 lakhs as administrative overheads. If I incur more amount, that more amount will not form part of CSR expenditure. Getting my point? Suppose what is my commitment? 1 crore. 95 lakhs public should be benefited. 5 lakhs administrative overheads allowed. Suppose sir 6 lakhs I incurred administrative overheads, sir. I won't consider 6, I will consider only 5 only. Next, surplus from CSR activities. This is also another tricky point only. You have to remember. Any surplus generated from CSR activities shall not be considered business profit and shall be plowed back into the same project, transferred to unspent CSR account, transferred to the fund in schedule 7 within 6 months of the financial year's end. What is this point? Sima, suppose you started promotion of education. You are in different business. This is a different activity. You constructed some schools. You appointed teachers also, teachers, principal, everyone. And that school started, admissions, also collecting some fees, nominal fees only they are collecting. Gross receipts minus teacher salaries, there is some profit. Now can I consider it as my business profit? Can I use it for business? No, that amount should also be used for that thing only. Sir, I can't use it, sir, that is a surplus. Okay, transfer that amount to schedule 7 fund. Within how many months, sir? Within 6 months from the closure of financial year. Within, until then, where to keep that amount? Keep that amount in unspent CSR account. Getting my point? Very, very important. Surplus from CSR activities is not a business profit. It should be spent on CSR projects only. Unable to spend, temporarily keep it in unspent CSR account. Then also unable to spend, transfer it to schedule 7 fund. See, all these accounts are like, for understanding purpose, I'm telling you. Income tax, if you remember, capital gain savings scheme account. You sold one property. If you invest that amount in another property, you will get exemption. But unable to find out that property, you can deposit this money with any bank. Getting my point? Can I proceed? Next. CSR applicability, just now I told you, net profit, turnover, net worth, everything I covered. At least 3 directors, including one independent director. There is no independent director, at least 2. In case of foreign company, 2 persons, not directors, 2 persons. One should be authorized person. And disclose your CSR committee in the board report. Exemption ma, I told you, remember, if CSR commitment does not exceed 50 lakhs, then CSR committee is not applicable. CSR expenditure, CSR commitment does not exceed 50 lakhs, then CSR committee is not applicable. Those duties board of directors will discharge. Next points. These points also I covered. CSR committee responsibilities. Remember FRM, fraud risk management, like that. FRM is, F stands for formulate policies, formulate CSR policies. R stands for recommend to the board, this time this is our CSR activity, and for this we need some 5 crores or 6 crores, recommend. And M stands for monitor, formulate the policy, recommend the expenditure, monitor the policies. FRM. Next one, CSR committee must recommend an annual action plan. In that, name of the projects, manner of execution, utilization modalities, monitoring and reporting, need and impact assessment. Impact assessment I'll discuss with you, just wait. Duties of board of directors, whatever recommended by the CSR committee, that recommendation will be approved by board of directors. Approving the recommendation alone is not sufficient. They should also monitor. Okay. Next, minimum amount to be spent on CSR activities. Monetary point of view important. Limits, monetary limits point of view important. Statutory limits. Existing company, how much more? 2% of 3 years profits. New company, that means, sir, 25-26 my company was incorporated in 25-26. In the first year itself, my turnover 1500 crores, my net profit 60 crores. Now how can I average it, sir? Only 1 year. No need to average. 16 to 2%. If it is 2 years, 60 plus 80, for example, second year 80, 60 plus 80 divided by 2. This is another point. Preference should be given to which areas, ma? Abroad, India. That to local areas. Listen carefully. I am from Andhra, but I established a factory in Chennai. Now I should give preference to the Chennai or Andhra Pradesh. Chennai. Where your unit is there, preference should be given to the local areas and surrounding regions. Failure to spend the required CSR amount. Failure to spend CSR amounts. You tell me, unpaid dividend amount is there, right? You'll keep it in unpaid dividend account and you'll wait for how many years? 7 years. If member is not coming, after that you will transfer to IEPF. Here also government fund is there. But time limits you have to remember. So here projects are of 2 types, ma. Projects are of how many types? 2 types. Ongoing project, others. Ongoing project means, tell me, current financial year plus how many years? 3 years. Whereas others means what? Single year project. You started project in the financial year 26-27. Current financial year you started this project. Imagine the project, your CSR requirement, your CSR commitment is 6 crores. Figures you remember. 6 crores is the commitment. Other than ongoing project, suppose you spent only 5 crores. By the time of completion of financial year, you spent how much amount? 5 crores only. What is the closure date of this financial year? 31st March 27. And how much idle fund is there? 1 crore. Within 6 months, by 30th September 27, transfer it to schedule 7 fund. Within 6 months. No, sir, this is ongoing project. This is for 4 years, sir. Current year plus 3 years, sir. Acha, you do one thing. What is the closure of financial year? 31st March 27, right? I'll give you 30 days time. By 30th April 27, open unspent CSR account. This is nothing but bank account only, ma. And the ledger name is unspent CSR account. Within 30 days, transfer amount to unspent CSR account. And utilize this money within next 3 years. This money belonging to which year actually? Financial year 26-27. Unable to fulfill that, unable to use that amount. Next 3 years you can use that money for the ongoing project. Next 3 years means which years? 27 28, 28 29, 29 30. Getting my point, sir? By the completion of 31st March 2030 also, there is some idle fund of 5 lakhs, sir. 3 years over, but still some 30 lakhs, 5 lakhs idle money is there. Now immediately within next 30 days, immediately next 30 days, by 30th April 2030, transfer to Schedule 7 fund. Transfer to Schedule 7 fund. Just go through it once, ma. If it is other than ongoing project, within 6 months of the financial year. If it is ongoing project, within 30 days, transfer to Schedule 7 fund. No, unspent CSR account. Use it in the next 3 years. Use it in the next 3 years. Unable to use, then within next 30 days, after third financial year ends, transfer to Schedule 7. So simply, ma, I'm writing here once again, financial year 26-27, this is the period, ma. This is the period. One is not ongoing project. One is not ongoing project. In this case, idle funds shall be transferred within 6 months. That means by 30th September 2027. Remember, 6 months, within 6 months. No, sir, if it is ongoing project, I'm using different color, ongoing project. Now, I'll give you 30 days. I'll give you 30 days. What to do within these 30 days? Open a separate bank account. 30th April 27, open a separate bank account. Name it as unspent CSR account. Use this money in the next 3 years. Next 3 years means financial year 27 28, 28 29, 29 30. When 30 will be over, 31st March 2030, still left, then within next 30 days, that means by 30th April 2030, 30th April 2030, transfer that amount to Schedule 7 funds. Are you all getting my point? Hello? Schedule 7 fund. Can you remember? Yeah. Penalties, ma. Penalties. Fails to comply with these above sections, lower of twice the unspent CSR amount or amount to be transferred to Schedule 7 or unspent. Both will be same only, ma. How much amount you need to transfer to Schedule 7 or unspent CSR? 2 times or 1 crore, whichever is lower. This is for company. And officer in default, lower of 1/10 2 lakhs. Here it is 2 times, but here is 1/10 time. Here it is 1 crore, but here it is 2 lakhs, 2% only. It's like this. Okay, fine. Ignore. Can I proceed? Yeah. Treatment of excess CSR expenditure. My CSR commitment 5 crores, ma. How much is my CSR commitment? 5 crores. Suppose I spent 7 crores or I spent 4 crores. Spent 4 crores means shortfall. For shortfall, just now I told you the treatment. What to do? I told you the treatment. Suppose if I spent excess, in that case, you can claim set off in the next 3 years. Next 3 financial years, you can claim set off. That means next year, your commitment is 6 crores. You can spend only 5 crores. Sorry. You can spend only 4 crores. Why? You already spent excess. How much? 2 crores excess you spend, right? So next year, you can claim set off. Okay, na? Remember, 3 years. Set off is possible for 3 years. The excess shall not include any surplus generated from CSR activities. Surplus means what, sir? Sir, excess shall not include surplus means what? I told you example, right? Construction of school is done. I got some school fees. Deducting teachers' salaries, some amount is there. That amount will be added or not added. Or that amount if I spend for other CSR activities, can I tell that this is also CSR expenditure? No. No. The point is, what is my commitment? 5 crores, ma. How much I spend? 7 crores. Suppose On the school, I got 6 crores fees, and I paid 5 and of crores as salaries. How much excess is there? 50 lakhs. This 50 lakhs again I spent on school. Now the point is whether this 50 lakhs can be added here to 7 crores? No. This 7 crores should not contain that 50 lakhs. That is a point. Can I proceed? Yeah. Implementation of CSR policy, you can implement either directly or through a Section 8 company or society or trust. But which Section 8 company, which is trust, which society, which registered with central government, for this they need to file form CSR1. Okay, sir, I should concentrate only on business, sir. I can't concentrate on CSR activities. Then what to do? Transfer your CSR commitment amount to Section 8 company or to society or to the trust. Which society, which trust, which is registered with central government. If you pay to them, we assume that it was paid to the society only. Or you can also collaborate with other companies. For example, Tata Steel Foundation is there. Reliance Industry, individually it can do CSR activities or it can collaborate with Tata Steel. Capital asset for CSR activities. Just now I told, right? My activity, my objective is education. For that I constructed a school. Now that land and building, is it an asset or not an asset? Asset. It's a capital asset. Who can be the owner of the capital asset? Can company be the owner of the capital asset? No. That asset should be immediately transferred to Section 8 company or registered public trust or registered society with charitable objectives. Sir, this rule came recently, but before that only I owed such schools, sir. I owed some land and building, sir. Okay, within 180 days of commencement of the rules, transfer these properties to Section 8 companies. Getting my point? Because of incurring CSR expenditure, any asset was generated. Don't be the owner of that asset. You transfer it to Section 8 companies, trust societies. CSR reporting, in that CSR reporting, impact assessment is important. Impact assessment is like, getting a feedback information, getting feedback information. Like, you spent something on society, right? Whether public got benefited or not. To what extent society got benefited. For doing it, one study will be conducted, that is we call it as impact assessment, which will be done by an independent agency. Impact assessment is not applicable to all the companies. It is applicable only to the prescribed companies. Sir, which companies, sir? My CSR obligation is 10 crores or more last 3 years. What is my CSR commitment? How much is the CSR commitment? 10 crores. See, net, it's not net profit. It's not net profit. CSR commitment to 10 crores. And for a particular project, I spent 1 crore or more. See, in a year, I'm taking up 8 projects, 8 or 9 projects. All 8 or 9 projects doesn't require CSR impact assessment. Only the project where 1 crore outflow is there. Only the project where 1 crore or more outflow is there and where 1 year has been completed. Like, recently I spent that amount. For that impact assessment required or no. After completion of the project, wait for 1 year. After 1 year, impact assessment should be done. 3 conditions. Remember, 3 conditions. Impact assessment is applicable to the companies which is having CSR obligation of 10 crores for the last 3 years. Impact assessment will be carried out for the projects for which we spent 1 crore or more and 1 year has been completed. Now, sir, this independent agency is coming and doing impact assessment. No. Will they charge fees? Yes. What extent we can pay fees? 5% or 2% of the CSR expenditure or 50 lakhs, whichever is higher. Suppose 10 crores, right? 10 crores into 2%, that will be 20 lakhs. 20 lakhs or 50 lakhs, whichever is higher, that amount you can incur impact assessment cost. Administrative overheads is different. Administrative overheads is 5%, but whereas impact assessment it is 2%. Few clarifications, just to give one time reading, whether they are qualified CSR expenditure or not, like, COVID-19 awareness programs, makeshift hospitals, ambulances, for example. Ambulances, you spend amount on ambulances, healthcare infrastructure, and recently this was added, Har Ghar Tiranga campaign, 75th Independence Day, I think, Har Ghar Tiranga campaign, promotion of education related to culture. All these are qualified CSR expenditures. Okay, na? With this CSR over, So one last time, what are the limits we studied in the CSR? One by one. First, applicability, net worth of 500 crores. turnover 1000 crores, net profit 5 crores. Okay na? CSR committee is compulsory, but CSR committee is not applicable in case CSR commitment is up to how much amount? 50 lakhs. If 50 lakhs is if the CSR commitment is 50 lakhs or less, CSR committee is not applicable. Who will be the directors? How many directors will be there? 3, including 1 independent director. If there is no independent director, 2, private company 2, and foreign company 2 persons. Okay. While calculating net profit, 2 amounts are excluded. Which 2 amounts? Overseas profit, dividends from Indian 135 companies, section 135 companies. And next one, coming to the limits, how much amount I should incur on CSR? 2% of 3 years average profits. Ma, suppose 3 years I'm in losses 3 years I'm in losses. CSR expenditure I need to spend on? No need. No need. Section is applicable to me. Section is applicable to me, but no need. Okay na? These limits when to check? Preceding financial year. We need to check these limits preceding financial year. If you go through my question bank, you will find a beautiful question. The question is, sir, 24-25 turnover is 500 crores, net worth is 100 crores, and net profit is 2 crores. Tell me any limit satisfied? Net worth 500 crores not satisfied, turnover 1000 crores not satisfied, net profit 2 crores not satisfied. But in the current year 25-26, they mentioned period like this, 1st April 25 to 30th September 25. That means 6 months only. 6 months only. In the 6 months, turnover went to 1500 crores. Net worth normal only. Net worth there is no change. For example, 100 only. And profit went to 20 crores, for example. Now director got a doubt whether CSR committee is applicable or not for the balance, for the remaining year, that is 1st October 2025 to 31st March 2026. Whether CSR is applicable for the balance 6 months or not, they asked a question. And the answer, yes or no? No. Why? We need to check which year figures, current year, preceding financial year, preceding financial year. So for 26-27 CSR is applicable, but 25-26 in the middle of the year it's not applicable. Beautiful question. I think it was asked 8 years back. Clear? Next one, limits, we have seen 50 lakhs, we have seen 2%. Next important, ongoing project. Ongoing project means more than 1 year, but it should not be more than 1 plus 3 years. So now transfer to unspent CSR account. Transfer to unspent CSR account is possible only for ongoing project. Within how many days? 30 days of closure of financial year, spend within next 3 years, or else after completion of 3 years, next 30 days, within next 30 days, transfer to schedule 7 fund. Sir, if it is not ongoing project, immediately after completion of year, within 6 months, transfer to schedule 7 fund. How much administrative overheads I can incur? Up to 5%. Impact assessment is applicable only to the companies for the last 3 years if CSR commitment is 10 crores or more, and to the projects 1 crore or more rupees has been spent and 1 year has been completed. For that impact assessment, 2% of CSR expenditure or 50 lakhs, whichever is higher, I can incur that expenditure. Clear? Everyone? CSR over. Next, three small sections. Before I start 136, 137, one small section, because 134 big section, 135 also big section. So one small section I'll take up, that is section 138. Internal audit. Remember, internal audit, who can be internal auditor? Only a practicing CA? No. Maybe practicing CA, CMA, or any professional decided by the board. Even employee can also be appointed as internal auditor. Getting my point? Who can be internal auditor is important. Suppose company wants to have internal audit mechanism internally, not externally. Suppose company hired practicing chartered accountant to do internal audit, but suddenly they changed the policy. They want to remove practicing chartered accountant and they want to appoint employee as internal auditor. Allowed or not allowed? Allowed. Any person can be internal auditor. And second important thing is applicability. Second important thing is applicability. 3 companies are there. Listed companies. Remember. Listen carefully. Listed companies, unlisted public companies, private companies. Listed, unlisted, public, private. Listed company, don't remember any financial criteria. Listed company by default, internal audit is applicable. And unlisted public company, private company, how to remember? remember 4 financial parameters ma. One is paid up share capital, next one is turnover, next one is loans, borrowings, and last one is deposits. Loans or borrowings. Remember how many? 4. What are the 4? Paid up share capital, turnover, loans, deposits. First increasing trend ma. Paid up share capital 50, turnover 200, increasing 50 200. Now loans exactly half ma, 100. Deposits exactly half ma, 25. 50 200, 100 25. Getting my point? 50 100, sorry, 50 200, 100 25. It's like multiples of 25 if you are able to remember. 25 1, 25 2's 50. No 3's ma, 4's only. No, 8's only. Like, okay, remember like this only. 50 200 100 25. What is for 50? Paid up share capital. 200 turnover, 100 loans or borrowings, 25 deposits. These 4 you need to check for public company, unlisted public company, whereas for private company only these 2 are applicable. Only these 2 are applicable. Can you remember? Paid up share capital 50. Any one limit satisfied ma, enough. Any one limit satisfied, enough. Private company turnover, outstanding loans 100 crores or more. And another important point, I forgot. You know, these two are there, right? Loans or deposits. First 2, you know, generally checking will be done 31st March. But these 2, any point of time, at any point of time during the financial year. At any point of the time during the financial year. If you go through the question bank, you'll find a question like this. You know, the question, let me narrate you the story. Company C Limited ma. What is the name of the company? C Limited. Unlisted company. Company is unlisted company. Paid up share capital 10 crores. Limit satisfied or not satisfied. Turnover 150 crores. Limit satisfied or not satisfied. Deposits 0 only. Okay. Limit satisfied or not satisfied. Loans, coming to the loans. Closing balance ma. 31st March 26. Closing balance is 80. Limit satisfied or not satisfied. But note point, they are telling that on 1st January 2026, outstanding loan balance is 103 crores. On 2nd January 2026, repaid some 10 crores. It came to 93 crores. Closing balance is 80 crores. Now you tell me whether internal audit is applicable or not applicable. Answer: applicable, because we need to check loans or deposits not as an year closure date. We need to check at any point of time during the financial year. At any point of time, 100 crores crossed, 25 crores crossed. That's it. I think 2 times this point was tested in the examination. 2 times. Are you all getting my point? So remember these points at any point of time in the financial years. Internal audit over. Next 2 sections ma. Next 2 sections, 136, 137. Section 126, sorry, 136, 137. What is section 136? Who is the owner of the company? Member. Is he allowed to participate in day-to-day affairs of the company? No. He is not allowed to participate in day-to-day affairs of the company. Then how they will know about financial performance of the company? Whether company is in profits or losses. What is the position of the company? Whether company is solvent company or insolvent company. How they will know? They will know through financial statements. So section 136 is the duty of the company to circulate copies of financial statements among the members. Which financial statements? In 134 we already seen financial statements means they should be attached with audit report, board report. If I'm attaching audit report means, is it audited financial statements or unaudited financial statements? Are unaudited. So in a question paper, if a question comes like this, company wants to circulate unaudited financial statements among the members, allowed or not allowed? Not allowed. Do you remember notice shall be given to all the members of the company, all the auditors and all the directors. Same, but extra points you will see here. Trustee and other entitled members means who? Directors and auditors only. So the extra point you will see is trustees. That's it. And what is the length of the notice, ma? Section 101, 21 clear days before the meeting. Here also same concept. For section 8 companies, what is the length of the notice? 14 days. Financial statements also 14 days only. Do you remember shorter notice conditions? Shorter notice. For AGM, shorter notice require how much consent? 95% of the members. In case of EGM with share capital, EGM company with share capital, majority of the members with 95% of the paid up share capital. If it is a company without share capital, 95% of the voting power. You just remember shorter notice for EGM criteria. Same points will apply. See, majority. Observe carefully. Majority. They must possess how much capital? Paid up share capital. 95% of the paid up share capital. If I want to give financial statements for a period less than 21 days before meeting, then I need to get consent from how many members? I need to get consent from how many members? If it is a company with share capital, majority members with 95% of the paid up share capital. In case of companies without share capital, at least 95% of the voting power. That's it. That's it. Simply EGM shorter notice you remember. That's it. Over. Listed companies, financial statements, subsidiary financial statements, there will be, bunch of documents. It's not possible for them to circulate that bunch of documents. That's why you keep them available for inspection at least 21 days before meeting. If you are making them available for inspection, automatically you complete section 136. But circulate salient features, nothing but a fast track in prospectus you will see year by year figures, 23, 24, 25 side by side figures you will see. Like that, prepare a summary and give it to the members if requested by the members. If shareholders request for full financial statements, give it. For that criteria, you all know section 17. If you remember section 17, they need to deposit sufficient fees amount, and within 7 days of the written request, company should send documents to the requested members. Next one, listed companies shall also publish the financial statements on their official websites. Next point, audited financial statements of subsidiaries should also be available on the website. If company is having foreign subsidiary, then foreign subsidiary financial statements shall also be displayed on website. In which language, sir? In English language. If they are not available in English, translate them in English and certify it. That means certified true copy. As it is in English only, we translated. As it is, whatever there, we translated. Nothing added, nothing deleted. If they are unaudited, no problem, allow it. Because recently we are hearing a news, we are listening to a news that is small companies may be exempted from the audit. Small company, government may declare that, government may notify that small companies may be exempted from the audit. Now small companies financial statements audited or unaudited financial statements are similarly outside India. If that company is not coming under audit purview, those financial statements are audited or unaudited or unaudited, mention that unaudited. Generally, which financial statements we need to attach? Audited. But if audit is not mandatory, publish unaudited financial statements. Format schedule 3 format only, no change. Yes, Nidhi company. Tricky point. Nidhi company, if you remember, voting power is limited to what extent? Do you remember? Voting power of a member in a Nidhi company is limited to how much? 5%. And Nidhi company dividends 100 or less, individually going to member and giving money required? No. Advertise it and display it in the notice board for 3 months. In dividends chapter we have seen it. And another point here, for Nidhi company, if you start giving financial statements to each and every member, printing cost, Nidhi company will become insolvent. And moreover, who will be the members of Nidhi company? Village rural people. Rural people may not have knowledge of financials. So for them, giving to them individually, why? Waste only. So that's why instead of giving to them individually, attach a notice board. Interested person will come and go through the notice board. Okay, this time profit this much, company is in profits only, like that they will make analysis. That's it. Listen carefully. Nidhi company must comply with modified rules for the members who hold shares of face value up to 1000 or own up to 1% of the paid up share capital, whichever is lower. I can call them as small members. I can call them as small members. Why? What is their percentage of holding? 1%. or what is the face value of the shares they are holding? 1000. Small members. For small members, public notice is enough. For small members, public notice is enough. No need to serve them individually. In dividends point, we didn't discuss the 1000 rupees or 1%. We discussed if dividend amount is 100 rupees. Disclose it in the disclose it on the notice board. Here 1000 rupees face value or 1%. Anyone, whichever is lower. Non-compliance punishment, company 25,000, officer in default 5,000. Can I proceed? Manner of circulation of financial statements. Two modes electronic, physical dispatch. Electronic mode compulsory for listed companies. And public companies with net worth. This is another wonderful point Why? Because generally wherever you see greater than or equal to symbol is there, but here net worth greater than 1 crore. In CSR, if you see net worth or turnover or net profit, but here it is end. Net worth 1 crore, greater than 1 crore, and turnover greater than 10 crores. Oh my god. Getting my point? Listed companies compulsory in electronic form, whereas public companies where net worth greater than 1 crore and turnover greater than 10 crores shall send through electronic mode. Next, in all other cases, all other companies can send financial statements in which mode? Physical mode. Members holding shares in demat form, you will get it through email. If members are not holding shares in demat form, and if they give consent, okay, send me all the financial statements in electronic form only, then send in electronic mode. See, to understand it simply, company 3 categories listed. Next one, public company with net worth greater than 1 crore, turnover greater than 10 crores. End. These two cases, shares held in demat form. Shares in demat form. And other cases, those who have given consent for electronic form of documents, electronic mode of documents, for them send documents in electronic mode. In all other cases, physical mode. Okay, na? Can I proceed? Filing of financial statements with ROC. Filing of financial statements with ROC. Sima, every company under section 92, under section 137 has to file 2 returns with ROC. What is section 92? Annual return. What is the time limit for annual return? Within 60 days of AGM. And what is section 137? Copies of financial statements. Copies of financial statements shall be filed within how many days? Within 30 days of AGM. Now here you need to observe, sir, no AGM, sir. Suppose we didn't conduct AGM, sir. Then within 30 days of due date. Here also we discussed it same. If there is no AGM, if AGM was not conducted, within 60 days of due date. Correct? If no AGM was conducted, within 30 days of due date. Sir, AGM conducted, sir, but at AGM they were not adopted, sir. AGM they were not adopted, not unadopted. And at adjourned meeting they were adopted. Understandable? AGM unadopted. In case in AGM unadopted, within 30 days of original meeting, within 30 days of AGM, file unadopted financial statements with ROC. ROC will consider them as provisional. Final or provisional? Provisional, that means temporary. Once adopted at adjourned meeting, file final financial statements with ROC. Sir, what is the time limit? Within 30 days of adjourned meeting. Getting my point? General rule, 30 days of AGM. If no AGM was conducted, 30 days of due date. AGM conducted but not approved at AGM, sir. Within 30 days of AGM, file unadopted financial statements which ROC will consider them as provisional. And at adjourned meeting, financial statements will be adopted. Those adopted financial statements, file them again within 30 days of adjourned meeting. And now ROC will consider them as final financial statements. Clear, everyone? So here also same time limit within 30 days. Within 30 days. I think January 25 attempt it seems. Yeah, bah, January 25 attempt only. Super. Only on this time limit ma 8 marks MCQs came. 8 marks, 4 MCQs came. One is if financial statements were not adopted, if financial statements are adopted at adjourned meeting, if AGM was not conducted, like that 4 MCQs. Each and option is of 4 to 5 lines. Option, not question. Question 3 lines only. Option, 4 options, 4 into 4 lines means 16 lines options. Like that 4 MCQs. Psychologically 90% roasted at examination hall itself. Balance 10% on result date, balance roast. So that is what, this single point. I'm stressing on this. I'm stressing this single point. Yeah. This single point is very important in section 137. Not adopted within 30 days of AGM, file them as unadopted. ROC will consider them as provisional. If financial statements are adopted at an adjourned meeting, such adopted financial statements shall be filed within 30 days of the meeting with applicable fees or additional fees. Now the point is for OPC, general meeting applicable or not applicable? Not applicable. Then 30 days of AGM is not possible to calculate. That's why for them 180 days from the end of financial year along with the required documents. And you know what interesting point? For annual returns, separate time limit is not there. For annual returns, separate time limit is not there. Practically what is happening, the website, how it is working, if OPC also conduct AGM, what would be the due date? 30th September. To that, system is adding 60 days and it is giving due date, that date. Getting my point? Ignore. So remember this point. For OPC, what is the time limit? 180 days from the closure of financial year. It would be 27th September, if I'm not wrong, 27th September. Because April 30, May 31, July 31, August 31. So 3 days gone, right? So September 27th only. Yeah. Clear? Next one, XBRL applicability. Recently, Jan 26 attempt it came. Maybe it won't come in May attempt. But still go through it. XBRL applicability, 4 companies you have to remember. All the listed company and their subsidiaries. Paid up share capital with 5 crores or more, turnover 100 crores or more, and required to follow Ind AS. And remember the highlight of XBRL. Remember. Once applicable, forever applicable. Once applicable, forever applicable. Sir, last year I'm listed company. This year I'm not listed company. Or last year my turnover is more than 100 crores. This year it is 60 only, 50 only. So this year, can I claim exemption? No. Once applicable, forever applicable. XBRL filing. What is XBRL? It's a IT point of view. Separate software, separate PDF. What is it? Ignore. Just remember applicability of XBRL filing. And these are the forms for different companies. Generally AOC for FS. If you are having subsidiary, CFS. For NBFC separate, for NBFC India is separate. Okay na? Yeah. And this we have seen it in section 136 also. I'm having subsidiary companies. If it is foreign subsidiary, I need to add this information in my financial statement reports. Indian subsidiary not required. Why? They will file it. Every company has to file financial statements with ROC. Indian subsidiary will file it, no problem. But foreign subsidiary, additionally you have to add it and you have to submit. Which financial statements? If audited, audited. If not audited, unaudited. If not available in English copy, then obtain a translated copy in English. All these are common points only. Same point I explained. Go through the penalty once. Okay na? Since this section was tested last time, I'm ignoring this section. With these accounts of companies Revision completed. Let's continue marathon with the next chapter, Audit and Auditors, section 139 to section 148. So total 10 sections are there. So before I start marathon, I'll give you the section summary. And the expected weightage of this chapter in your examination is 5 to 6 marks. Either you can expect one descriptive question 5 marks or 3 multiple choice questions 6 marks. Sometimes both also. 5 marks descriptive question, 6 marks MCQ. So minimum weightage 5 marks. Can I proceed? Okay. So starting with, yes, audit. Two categories ma. Company audit, cost audit. Company audit, cost audit. So audit, you know, section numbers 139 to 148, right? Cost audit is section 148. Over. Now let's talk about company audit. Company audit. So company audit will be done by company auditor. Regarding auditor, appointment is dealt by section 139. Appointment with section 139. Removal or resignation. Appointment of the auditor 139. Removal and resignation is dealt by section 140. Section 140. So I'm talking about appointment of auditor, right? I'm talking about appointment of auditor, removal of the auditor. So auditor should possess some qualifications and he should not possess disqualifications. Getting my point? So who can be the auditor? Qualified person can be the auditor and he should not have disqualifications. So qualifications, disqualifications, next section. Qualification, disqualification, next section, that is section 141. What auditor will do? What will auditor do? Audit the financial statements. At free of cost, will he charge remuneration? He will charge remuneration. So definitely auditor take remuneration. That is next one, remuneration. Remuneration. What is section 142? Audit remuneration 142. So qualifications and disqualifications of auditor, remuneration of auditor. So being an auditor, he will have certain powers and duties. He will have powers and duties. True duties, namely two duties, namely one is signing the audit report. Sign audit report. Other one is attend general meeting, AGM. No, general meetings. Attend general meetings. So duty to sign the audit report, that is, sorry, powers and duties 144. I'm sorry, 143. Next, 144, being an auditor, he should not do some services. He is prohibited from rendering some services. Prohibited services. 144. Once, you know, this narration is over, I'll once again dictate the, once again I'll narrate the story. Once writing done, I'll narrate the story. Next, signing the audit report 145. General meeting 146. Finally, we are left with one section. What is that one section? 147. 148 already over. 147. Sir, what is 147? Non-compliance punishment. Punishment for non-compliance. Punishment for non-compliance. Section 147. All done. So can I repeat one more time? What is our chapter? Audit and auditors. So the concepts first we will see. First the concepts are audit, two types: company audit to cost audit. Cost audit section 148. Company audit remaining sections. Who will do company audit? Auditor. First you need to know the appointment procedure and removal resignation procedure. Appointment of the auditor, removal or resignation of the auditor. 139, 140. Who can be appointed as an auditor? He need to possess some qualifications and he should not possess disqualifications. Qualifications, disqualifications 141. And the appointed auditor will expect something in return, that is remuneration 142. And the appointed auditor will have some powers and duties. 143. Along with powers and duties, he is prohibited from doing some services. Prohibited services. 144, 143, 144 over. Name some two duties, sir. One is duty to sign audit report, 145. Duty to attend general meeting, 146. And overall punishment for non-compliance, 147. Possible? Easy to remember? Yes. Audit, two types. Company audit, cost audit. Cost audit, 148. Company audit. Appointment of the auditor, 139. Removal of the auditor, resignation of the auditor, 140. And what are the qualifications, disqualifications? 141. Expect remuneration, 142. Powers and duties, 143. Prohibited from rendering some services, 144. Sign audit report, 145. And attend general meeting, 146. Non-compliance punishment, 147. With this, up to 148 sections I narrated stories for all the chapters, except deposits. Only 5 sections are there. 73 from members, 76 from the public, 76 here is the punishment, 74 is for old deposits, 75 damages for fraud. But in deposits chapter, maximum questions will come from exempted deposits, so no need to remember section numbers. But if at all needed, 73 from members, 76 from public, you remember that. Charges I told story. And what about dividends, sir? Dividends, if you see, how many sections are there? 5 sections. Declaration, sources, unpaid dividend, IEPF, kept in abeyance, hold, and punishment for non-payment of dividends. Simple 5 sections. Can I proceed? Yes, ma. Qualifications to become company auditor. Two people can become auditor. Natural person, individual. Other than individual, firms. In case of firms, a natural person, individual can become company auditor, right? But that individual should possess a qualification. What is the qualification? CA with COP, certificate of practice. Firm, coming to the firm or LLP, 2 conditions to be satisfied. One is majority of the partners should be CAs and they should practice in India. They should practice in India. Majority of the partners should be CAs and they should practice in India. Suppose 10 partners are there in firm. Majority means 6. 6 should be chartered accountants holding certificate of practice and the 6 should practice in India. Suppose 1 practicing outside India. In India only 5 are there. Majority are no. Majority of the partners in the firm should be practicing chartered accountants and they should practice in India. Over. Signing authority. Individual, he will sign the audit report. Firm, who can sign the audit report? Practicing chartered accountant on behalf of firm can sign the financial statements. Over. Next, disqualifications. Disqualifications. I'll write in the margin. Body corporate disqualified. But LLP is qualified, ma. LLP is qualified. Every body corporate is disqualified, but LLP is qualified. Next one. Remember EO. EO of company. EO of C Limited. What is EO? Employee officer. No independency. No independence. So that's why disqualified. Next one. PE of EO of C Limited. Partner of the officer, partner of the employee. Employee of the employee, employee of the officer. 4 people, ma. 4 people. Partner, employee. Of officer, employee of company. So far, in this second point and third point, I'm talking about only company, not related entities, only company. Next point, if you see, 3 persons are covered here. 3 persons. Yes means self, ma. Myself. My relative. My partner. 3 persons are covered. From here onwards, observe carefully. 3 partners. Yes, RP. Myself, my relative, my partner. And 5 companies. Remember how many companies? 5 companies. What are the 5 companies? CASH plus SH. Company, associate, subsidiary, holding, subsidiary of holding. Myself, relative, partner. Partner means which partner, ma? Business partner, ma. Either me or my partner or relative. Holding security, any security in these 5 companies, disqualified. But there is an exemption to the relative. The relative can hold securities up to 1 lakh face value. Remember, face value. It's not market value. Many times in examination, they created a confusion. Suppose face value, suppose market value, like that they started asking questions. So remember, exemption is only for relative or partner or self. Exemption is only for relative. Exemption is only for relative. How much face value of securities? 1 lakh. Remember carefully, face value 20,000, market value 20 lakhs. Face value 20,000, market value 20 lakhs. Qualified or disqualified? Qualified. Sir, face value 2 lakhs, market value 50,000. Face value 2 lakhs, market value 50,000. Qualified or disqualified? Disqualified. Importance should be given to the market value or face value? Face value. Getting my point? And benefit is given to self relative partner or only self? Only relative? Only relative. So here you see total 3 points are covered here. One is security. Second one is indebtedness. Indebtedness. But here indebtedness there is a limit. The limit is exceeding 5 lakhs disqualified. Up to 5 lakhs not disqualified. Sir, exactly 5 lakhs. Either myself or my partner or my relative indebted up to 5 lakhs, no disqualification. Exceeding 5 lakhs, that means if the outstanding balance is 5 lakhs 1 paisa, disqualified. And third point is guarantee. What is the third point? Guarantee. For guarantee, the limit is greater than 1 lakh, disqualified. For guarantee, what is the limit? 1 lakh. Up to 1 lakh, qualified. Above 1 lakh, disqualified. Can I proceed? Now, sir, you told relative benefit, no, sir, 1 lakh face value of securities. Suppose after appointment, suddenly relative holding increased, sir. Company issued bonus shares, ma. As a result, relative holding increased more than 1 lakh. Now, what is the consequence? Don't worry, 60 days you are having time period. Within 60 days, if your relative is selling the shares in such a way that total holding comes to 1 lakh, then no disqualification. Remember, what is the time limit? 60 days. Whenever it crossed, from the date of crossing the limit, 60 days time period is there. Within 60 days, ask him, compel him to sell the shares in such a way that outstanding amount should come to 1 lakh. So tell me, first one, body corporate. Second one, EO, employee officer. Third one, PE of EO. And fourth one, SRP, self-relative partner. How many companies? 5 companies. Cash, company, associate, subsidiary, holding, subsidiary of holding. Holding security, disqualified. Indebtedness, excess of 5 lakhs, disqualified. Guarantee, excess of 1 lakh, disqualified. But for security, relative is given a benefit of 1 lakh face value of securities. At any time, if it cross 1 lakh, corrective action to be taken within next 60 days. Can I proceed? Okay. So with this, D point also over. D point also over. In margin itself, I am writing one more time. I am writing SRP to CASH plus SH. First one is security. Second one is indebtedness. But in bracket, you write greater than 5 lakhs. And third one is guarantee. In bracket, greater than 1 lakh. Exception, investments by the relative up to 1 lakh face value. Okay, next one ma. E point ma. E, here total 6 companies ma. Total 6 companies. Cash plus SH plus AH. AH, associate of such holding company also. What is this point? Business relationship ma. What is this point? Business relationship. In debenture trustee, we studied about pecuniary relationship, right? Similarly here, business relationship. If you are having any business relationship with the group companies, you will be disqualified. But we had 2 exceptions. Important point is exceptions only. Exceptions. What are the exceptions, sir? If you are rendering professional services permitted by ICI, suppose that company got income tax notice from income tax department and you are handling that notice. And this is a permitted service by ICI. So not disqualified, even though you are having some relationship, not disqualified. Next one, if the transaction happen in ordinary course of business, that is at company's arm length price, then also not disqualified. Suppose I'm taking services from Jio, Reliance Jio. That means to the entire Reliance group, I'll be disqualified. But if the transaction, the Jio fiber services, if the transaction is happening at arm's length price, that means between unknown buyer, unknown seller, what is the price? Same price if I'm paying, I'm qualified. No, sir. 1 lakh rupee worth data, I'm using it just for 1 rupee. Is it ordinary course of business, sir? No. Now, am I qualified or disqualified? Disqualified. Remember, business relationship, group company. 6, 2 exceptions. What are the 2 exceptions? Permitted professional services and business relationship at ordinary course of business. Over. Next point. So, self-relative partner came only for 4th point. Here, Relative is a director or employment of the company as a KMP. I'm talking about whom? R. Sir, suppose if you are a director of the company, can you be the auditor? I'll be the officer. Officer already disqualified. So I'm talking about here only relative, not partner. Relative. Relative director disqualified. Relative KMP again disqualified. Can I proceed? One attempt question came like this, 2 marks question. Mr. C is a chartered accountant holding COP. He is having wife W, who is a storekeeper in company A Limited. Storekeeper. Now that company wants to appoint C, chartered accountant, as an auditor. Allowed or not allowed? Allowed, because storekeeper is neither director position nor KMP position. Getting my point, everyone? Next. Ma, relative different to partner different, ma. Don't get confused. Sir, partner means business, personal life partner also, no, sir. Life partner comes in relative, ma. Life partner comes in relative. Business partners comes in the definition of partner. Next one. Full-time employment. If you are an employee elsewhere, if you are an employee of this company, you are disqualified under second point itself, you are disqualified. Sir, I am employee of Adani company, sir. Can I be appointed as an auditor of Reliance Industries Limited? No. Full-time employee disqualified. Next one, if you are having 20 company audits, then for 21st company you will be disqualified. Getting my point? You are having 20 company audits. Now for the 21st company audit only you will be disqualified. No sir, it's my dream audit, sir. Then do one thing. Out of present 20, resign from one company. Now it becomes 19. So you can be appointed as an auditor of 20th, that company. However, this point is very, 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 very important. 4 companies: OPC, small company, dormant company, private company with paid up share capital less than 100 crores. 4 companies. Remember, 4 companies. OPC, small, dormant, private company with paid up share capital less than 100 crores, not defaulted under 92-137, are excluded while counting 20 companies. Students, cash flow statement and count of audits, similarity is there. Cash flow statement is not applicable to OPC, small company, dormant company, startup private companies. There it is startup. But here all private companies, paid up share capital, it's not up to 100 crores, it's less than 100 crores. If it is a partnership firm, suppose 3 chartered accountants holding COP, 3 chartered accountants are holding COP. Now limit will be 3 into 20, 60. Limit 20 is per partner. Can I proceed? Next one. If you are convicted by a court for an offense involving the fraud and a period of 10 years has not been elapsed, remember this point. If you are convicted by court, 10 years disqualified. If you are convicted by NCLT, 5 years only disqualification. Remember this point. Not NCLT, NFRA, I think. No, NCLT. Remember, court to conviction, 10 years disqualification. NCLT conviction, 5 years only. This point, I'll repeat once it comes. But for the time being, 10 years disqualification in case of conviction by the court. Okay, here only it is there. If such conviction is held by tribunal, then prohibition is only for 5 years. Clear? Okay. Next, any person who renders prohibited services which are there under section 144, then also disqualified. Now these disqualifications. Yes, ma, over. Disqualifications over. Very easy to remember. Body corporative, EO of the company, PE of EO of the company, SRP of cash plus SH, security, indebtedness, guarantee. Next one, relative, director or KMP. Business relationship, exceptions, professional relationship. Next one, ordinary course of business. And then next, full-time employee. Next, company audits up to 20. And next one, prohibited services. And next one, convicted by the court, 10 years disqualification. Convicted by NCLT, 5 years disqualification. Over. Disqualifications over. Now these qualifications I should possess throughout the audit also, not only at the time of appointment, throughout the audit. And the disqualifications I should not possess. One second. Yeah. disqualifications I should not possess at the time of appointment as well as subsequent to the appointment. That is the second point. They will ask, 2 years back they tested one point. The point is, at the time of appointment, no disqualification. After 3 months of appointment, suddenly disqualification came. Now, can he continue the audit officer? Immediate vacation. Immediate vacation. But you have to remember there is one exception. That exception is relative holdings crossing 1 lakh face value of securities. No immediate vacation. 60 days. 60 days corrective action is given. After 60 days also there is no corrective action. Then vacation. Next one, relative definition, officer definition. Just give one time reading. Relative members of HUF, husband, wife, all remember step except spouse. For spouse there is no step. Okay na? Father step, mother step, brother step, sister step, son step, son's wife no step, daughter no step, daughter's husband also no step. That means adopted people. Directly or indirectly, it refers to what? Directly means I am rendering the services. Indirectly means either my sister concern or my relative or the company in which I am having a interest. Getting my point? So that means individual auditor directly. In case of firm, you will see here indirectly means through other entity in which I am having interest. Let's see next one, section 144. 141 completed. Qualifications, disqualifications. 144 prohibited services. Sir, what are the prohibited services? Accounting, bookkeeping, internal audit, design and implementation of financial information system, actuarial services, advisory, banking, financial services, any other services as prescribed by the law. See, the point is, you can do these services, see, you can provide these services. These are not illegal. But simultaneously providing these services and becoming an auditor of the company, not allowed. Suppose, a CA may ask like this, say a CA, a CA came to you and asking the doubt. I'm providing management information system services to C Limited. Company wants me to take the position of auditor. Advice, very simple. Immediately you resign from the position. Which position? Providing MIS services is there, no? You resign from the position and you can be appointed as an auditor. Or there is a question like this, 2 attempts back question came like this. Company auditor, one day company approached company auditor for outsourced financial services. Outsourced financial services. Company auditor is in dilemma whether to provide that services or not. Please advise. Very simple. If you start providing the services, disqualification, you'll come out of the position. That's it. So as an auditor, don't provide these services. Remember the list, remember the list. Advisory, banking, financial. Next one, financial information system, actuarial services, management services, investment. Next, internal audit, accounting and bookkeeping. See, no auditor can take a position of stat audit and internal auditor simultaneously. At the same time, company auditor and cost auditor, same positions, one person not allowed. Okay na? Okay. Next one. Same points were given here. Just to give one time reading. If the proposed auditor withdraws from providing the services, they become eligible for appointment after withdrawal. Next one, selection of auditor. So see, 141, 144 completed. So next 139. What is 139? Appointment of the auditor. Before appointment, we need to select the auditor. So who selects the auditor is important. And the answer is board of directors. But in case company is having audit committee selects the auditor. So remember the structure, audit committee recommends proposed auditor to board of directors. If board of directors are convinced with audit committee recommendation, they will further recommend to members at general meeting, AGM. Suppose board of directors are not convinced with audit committee, then board of directors will return back the recommendation to audit committee. Now audit committee will have two options, either change or no change. They may change recommendation and they will forward to board of directors, or they will give same recommendation to board of directors. Now board of directors will have two options. Option number one, now at least get convinced, not convinced. You make a fresh recommendation. Also specify the recommendation by audit committee. Audit committee recommended this candidate, but we are not interested in this candidate, we are considering this candidate. You convey to the members. Final decision is taken care by, final decision will be taken by members. Getting my point? Now the question is, audit committee, is it applicable to all companies? No, it is applicable only to the specified companies. In your material, make this change ma. Equal to symbol is not there, printing error, you just keep equal to symbol. In your material, just keep equal to symbol. See, there is no change in the material, small changes only. Maybe you think that, sir, next page, content is falling in the next page. That is due to space adjustments. Space adjustments only. No new concepts were added, just space adjustments. Overall, this book is of 228 pages only. Your book is also of 228 pages, including that, cover page also. If I delete all the cover page content, 220 pages only. There is no change in, number of pages. Content due to space adjustment, next page it got shifted, that's it. Okay, audit committee is applicable to listed companies, public companies with paid up share capital 10 crores or more, turnover 100 crores or more, loans, borrowings, debentures, deposits 50 crores or more. Any one condition satisfied, these companies are required to have audit committee, a dedicated audit committee. If company ceases to fulfill any of the three conditions for 3 consecutive financial years, audit committee is not applicable. So next 3 years, if it is not falling in the criteria, then they can close audit committee. Audit committee shall have minimum of how many directors? 3. Majority should be independent. Suppose, sir, in audit committee 5 are there. Majority means how many? 3. In audit committee I kept 10. Majority means 6. Majority of the directors should be independent. They should have knowledge of reading and understanding financial statements. So here you can see audit committee selects the auditor and recommends to the board. If there is no audit committee, this duty will be handled by board of directors. If board agrees with audit committee, it further recommends to the members at AGM. If board disagrees with audit committee's recommendation, it will send back for reconsideration. If audit committee does not change and is sending same recommendation, then final decision by the directors and members. That is, board can still recommend the auditor of own choice while recording reasons for disagreement with the audit committee. That is a procedure, and members at AGM will take final call. Can I proceed? Auditor selection. This is before selection ma. That means before appointment. Process before appointment. Process before appointment. So on what basis auditor will be selected? Based on the requirements of the company. But before appointment, audit committee or board of directors will collect this information. Which information? Pending cases, disciplinary actions, or any professional misconduct against the auditor before ICA or any competent authority or any court, because these cases will decide auditor certificate. Suppose in these cases, if auditor lose the cases, auditor certificate of practice may be cancelled. In that case, can he express opinion on our financial statements? No. So some kind of risk is there. That's why pending proceedings against the auditor or auditor firm. So board of directors will go through that information. Suppose for us audit committee is not applicable. For us audit committee is not applicable. But still company constituted audit committee. In that case, board of directors had no duty to listen to audit committee. They can make their own choice recommendation. Getting my point? Audit committee, if applicable, audit committee selects the auditor, board will recommend to the members. If audit committee is not required, but still if you are having audit committee, board of directors can choose any person as any auditor to take the position of company auditor. Board selects the company auditor. Appointment is done by the members. So before appointment, company shall obtain from the proposed auditor the following things. One is written consent, not a new point at all. Appointment of director, written consent. Nominee, written consent. Trustee, written consent. Written consent of such auditor for appointment. Declaration that auditor is eligible for appointment and not disqualified. Confirmation that auditor total company audits within the limit of 20 only, including proposed appointment, it will not exceed legal limit. Next, list of pending proceedings against the auditor, the partner and the firm must be disclosed appropriately. Getting my point? Sima, 4 informations. Auditor should give it to the audit committee or board of directors. What are those 4 things? Written consent, pending proceedings, common. Next one, accepting this engagement, there will be no crossing of legal limit. And the last one is I'm not disqualified to accept this engagement. So 4 points. Regarding disqualifications, 2 points ma. I'm not disqualified and the proposed audit engagement is within the ceiling limits. Next one, written consent and no list of pending proceedings, that is common. Next, appointment of the auditor. Simple chart. You know, here companies are of two types ma. Companies are of two types: government company, non-government company. Government company, non-government company. Government company auditor appointment, you know, first auditor, subsequent auditor. First auditor, subsequent auditor. Non-government company also first auditor, subsequent auditor. So tell me, first auditor means who? After incorporation, for the first time, if someone is appointed as auditor, he will be called first auditor. Now, who is having power, authority to appoint the auditor? That is the question. Who is having authority to appoint the auditor? First auditor in case of government company, C&AG. Within how many days, sir? Within 60 days of incorporation. Within 60 days of incorporation. Failed. No, sir, C&AG failed. Then board of directors within 30 days after C&AG failure. Sir, board of directors also failed, sir. Then members at EGM within next 60 days. So first auditor appointment tenure, if you see 60 plus 30 plus 60, it's like that. First 60 C&AG, next 30 board of directors, next 60 EGM. Okay na? Subsequent auditor is appointed by C&AG within 180 days of commencement of financial year. Within 180 days of commencement of financial year. Clear? Next one, sir, first auditor in case of non-government company. First auditor in case of non-government company. There you can see appointment is by board of directors within 30 days of incorporation. How many days? 30 days of incorporation. If not, then at EGM within 90 days. At EGM within 90 days. For subsequent auditors, AGM. Members will appoint subsequent auditor at AGM. So now you have seen authority. Next one, important point is tenure. You know, these three people, which three people? First auditor of government company, subsequent auditor of government company, first auditor of non-government company. Their tenure is up to next upcoming AGM. Whereas here, once appointed, maximum 5 years. Getting my point? Auditor appointed at first AGM. His first AGM. When he came to first AGM, it's not company's AGM, ma. It's not company's first AGM. For him, what is the first AGM? Appointed at that AGM, his appointment will be continued till the end of 6th AGM. That means how many years? 5 years. Getting my point? So first auditor of non-government company, first auditor of government company will continue the position till the conclusion of first AGM. And whereas subsequent auditor of government company will continue the position till the conclusion of upcoming AGM. Whereas non-government company subsequent auditor can be appointed for one term of 5 years. Can I proceed? Oh, that's it, over. So 30, 90 first AGM, 60 days, 30 days, 60 days, first AGM, over. Subsequent auditors, non-government company, you know, company appointed AGM, his appointment will be continued till the conclusion of 6th AGM. In case of government company, C&AG, within 180 days of the commencement of financial year. Appointed auditor shall hold office till the conclusion of next AGM. If no auditor is appointed, existing auditor continues in the office, but this will not happen. Because ordinary business, ADDA, adoption of financial statements, appointment of the auditor and fixation of remuneration, is a compulsory business item. Without discussing that item, AGM is not said to be properly concluded. Next one, intimation to the authorities. Once you appoint auditor, you know, in all the cases, once you appoint auditor, from the date of appointment, DA, from the date of appointment, communicate with ROC. Within how many days, sir? Within how many days? 15 days, ma. Simply DA plus 15. appointment plus 15 days. Within 15 days of appointment, communicate with ROC. If you are someone governed by NFRA, also communicate with NFRA within 30 days. Within 30 days of commencement of NFRA rules. Newly appointed auditors, same time limit, 15 days only. What is the difference? NFRA didn't came in the year 2014. It was came suddenly in between. 2018 it was constituted. The rules was commenced, later period of time only. So, but by the time already you are a company governed by NFRA, then for you 30 days time limit is there to update your auditor details. Suppose after commencement of rules, you started governed by NFRA after commencement of rules. After commencement of rules, since the limits crossed, or since you became listed company right now, if you are appointing an auditor, within 15 days of appointment, communicate the same with ROC as well as NFRA. In this way, NFRA maintains the records of auditors of the companies which are governed by NFRA. So 139 over. 139 over. No, not at over. Casual vacancy is also 139 only. But before that, small point, powers of C and AG. This powers of C and AG is only with respect to government company, for government company, who appoints auditor? C and AG. Logic is very simple, Government company, majority capital is with whom? Government, 51%. For appointment of auditor, which resolution is required? OR. That means government should appoint the auditor. But government is having a number of activities. That's why government delegated power to one of its departmental person, that is C&AG, Comptroller and Auditor General. C&AG means nothing but it's a agent of government only. Okay, na? So yes, for one government company, C&AG appointed Mr. A as an auditor. A submitted audit report to C&AG. But C&AG is having a doubt. Oh my God, one particular area, I think auditor was negligent in one particular area. For that particular area, again do audit, we call it as test audit. Only for that particular area, like receivables, payables, turnover, purchase, only that area do audit, means test audit. No, I think overall auditor is negligent. Once again, one more fast audit is required. Then he will call for supplementary audit. If C&AG wants to call for supplementary audit, he is having right to conduct he is having right, but this right he should exercise within 60 days. C&AG within 60 days shall call for supplementary audit. 60 days from which date? 60 days from the date of submission of audit report by the government company auditor. Within 60 days from the date of receipt of audit report, have a right to conduct a supplementary audit, comment upon the supplementary audit. Sir, either he can directly do it or he can appoint another auditor to do supplementary audit. Any comments by C&AG shall be sent to the company members, debenture trustees, other entitled persons presented at the AGM in the same manner and the time as the audit report. That means along with audit report, supplementary audit report shall also be placed before the members. Can I proceed? But to the government company, who will attend the meeting? President or representative or representative? Counted for the purpose of quorum or not? Yes, counted. Next one, casual vacancy arising in the office of the auditor. Casual vacancy means before expiry of the tenure or before next AGM. Simply, auditor tenure is getting expired by the next upcoming AGM, but before expiry of the tenure, if there arises any vacancy in the auditor position, why, sir? Maybe disqualified, or it is a partnership firm, dissolution happened, partnership dissolved, or maybe he lost qualifications, ICA cancelled his certificate of practice, or maybe died, and finally resignation. Out of these 4 no problem at all. 4 normal issues. It may happen, may not happen. So in these 4 cases, which cases? Death, next one dissolution of partnership firm, next one disqualification, no qualification. These cases, board of directors shall appoint auditor to fill up that casual vacancy within just 30 days of casual vacancy. But resignation is a serious concern, severe concern. Why auditor resign? Maybe board is not cooperative with the auditor. Whatever auditor is asking information, board is not providing that information. So that serious case is there. So that's why, in case if you are filling up the casual vacancy which was caused due to resignation, board resolution alone is not sufficient. Within 3 months of board resolution, conduct EGM and get approval from the members. Ordinary resolution. That means ratification. See, everything is applicable to non-government company, because for government company, who is there? C and AG. If C and AG fails, who will come? Board of directors. If vacancy is not due to resignation, simply death, dissolution, disqualifications, or no qualification, board shall fill the vacancy within 30 days based on audit committee recommendation if applicable. But if the vacancy is due to resignation, board shall appoint a new auditor, and that appointment shall be approved by the members at general meeting within 3 months of the board recommendation. Can I proceed? Simple. In case of government company, C&AG fills vacancy within 30 days. If C&AG fails, board of directors will fill the vacancy within next 30. So time limits, if you see, total overall time limits, if you see, to overall time limits. First auditor, GC, non-GC. First auditor, GC, non-GC. GC 60, 30, 60. First 60 is for C and AG. Next one, board of directors. Next one, members at EGM. Whereas non-government company, board of directors 30 days. EGM members 90 days. Clear? Everyone? This is first auditor appointment time limits. Subsequent auditor. Again here also GC, non-government company. Government company, C and AG appoint subsequent auditor within how many days? 180 days. 180 days from which date? Commencement of financial year. Whereas non-government company appointment happens at AGM. You all know the due date of AGM, right? 30th September. Majority cases 30th September of the year. So 2 auditors over. Next, one more auditor is there. Who is that one more auditor? Casual vacancy auditor. In case of casual vacancy auditor, again GC, non-GC. Government company, non-government company. In case of government company, C and AG, how many days? 30 days. Board of directors, next 30 days. Clear? Non-GC, you have to classify into 2. One is others, that means other than resignation, and next one is resignation only. In case of other reasons, board of directors 30 days of vacancy. Board of directors 30 days of vacancy. If it is a resignation case, same time limit, board of directors 30 days and members at EGM within next 3 months. This is end. Clear? 3 auditors are there, that's it. 10, 100, 50, right? Paid up share capital. Audit committee applicability. Tell me, audit committee applicability. 10 crores paid up share capital, 100 crores turnover, 50 crores outstanding borrowings, loans, deposits, everything. Is it clear? 10, 50, 10, 100, 50, right? Any doubt? Just go through it. Till examination, you have to remember the limits, ma. Till examination, you have to remember the limits. And what is the limit? Yes or no? 10, 100, 50. Next one, appointed auditor to fill up the casual vacancy. He will continue the office till the conclusion of next AGM. This is important. Sir, to fill up the casual vacancy, I appointed one auditor for 5 years, sir. Valida, invalida? Invalid. Okay. See, if you go through the previous examination questions, the question is, MD appointed first auditor of the company, whether appointment valida, invalida? MD appointed first auditor of the company, valida, invalida? Invalid. Why? MD is not equal to board of directors. Board means a group of directors. Board is different, MD is different. Okay, na? Next one, government company auditor was appointed by members at AGM. Valida, invalida? Invalid, because he must be appointed by C and AG. Government company auditor will continue the position till the conclusion of next AGM. Casual vacancy auditor will also continue the position till the conclusion of next AGM. And first auditor obviously will continue the position till the conclusion of first AGM. Over, ma. Next one, duties. This is with respect to resignation. So this is a new section, ma. 140, 139 over. Appointment related, everything is over. 139 over. 141, 141, 139, 141 over. 144 also over. Next 140. If you want to resign from audit office, resign, no problem. But if you decided to resign, and after resignation you have to communicate that matter with authorities. Sir, which authority, sir? ROC. Sir, my company is a government company, sir. ROC and CNDG. Getting my point? Sima, auditor, Mr. A, auditor. He gave resignation notice to the company C Limited. Resignation letter immediately within next 30 days. How many days? Within next 30 days. From the date of resignation, auditor should communicate with the same matter with two people, ROC and CNDG. CNDG is not applicable for all companies. CNDG is applicable only for government companies. What is the time limit? 30 days. Applicable form ADT 3. If you don't comply with this duty, then punishment. What is the punishment? Minimum 50,000 or audit remuneration, whichever is lower, plus 500 per day up to 2 lakhs. You know how to remember this kind of punishments, 50,000 or audit remuneration, whichever is less. This is standard. This is standard. Suppose you complete this duty on 35th day. 35th day. That means how many days delay happened? 5 days. For each day, 500 rupees will be added. Maximum how much? 2 lakhs. Can I proceed? Next, rotation of an auditor. Okay, some points 139 is still pending. Rotation. Rotation means what? Can a company have auditor for infinite period? It depends on the type of company. Suppose these companies, which companies? These three companies. Which three companies? Listed company, unlisted public company with paid up share capital 10 crores or more, borrowings from public financial institutions, banks, as well as deposits. Deposits also covered, loans, borrowings, or deposits 50 crores or more. And coming to the private company, paid up share capital 50 crores or more, borrowings 50 crores or more. So if you observe carefully, borrowings, these two are common, right? So that means these two are applicable to all companies, whether it is private or public or not a matter. Only the difference is, for unlisted public company, paid up share capital is 10 crores. For private company, paid up share capital is 50 crores. That is the difference. That is the only difference. Are you getting my point, everyone? So three companies, how many companies? Listed without any criteria. Unlisted public companies 10 no 50, 10 no 50. All private companies 50-50. Paid up share capital 50, borrowings also 50. Then for them rotation is applicable. OPC small companies are exempted. Oh my god. Are a small company maximum paid up share capital 10 crores ra. Okay na. So definitely they will not come in the purview. So okay, OPC small companies are exempted. Government companies also not required. Why? Every year rotation is there. CNDG appoints auditor for every year. So three companies, these rules are not applicable. OPC, small, government. That's it, over. So what is the manner of rotation, ma? What is the manner of rotation? Here, auditor is of two types, ma. Individual auditor, firm of auditors, firm of chartered accountants. Individual can be appointed for one term of 5 years. One term of 5 years. Whereas firm can be appointed as 2 terms of 5 years. Remember, appointment for 10 years is not possible. Maximum appointment, appointment maximum cover 5 years only. Depends on the terms. 1 term, 2 term, 3 terms. Suppose if you take OPC, 10 term of 5 years allowed. Small company, 20 terms of 5 years also allowed. But to these companies, individual can be appointed as an auditor only for 1 term of 5 years. And firm of chartered accountants, 2 terms of 5 years. Sir, once this tenure is over, then what is the next consequence, sir? 1 term of 5 years cooling period. 1 term of 5 years cooling period. Suppose sir, listen carefully. One doubt. C Limited appointed. C Limited, which is already covered in this criteria. Suppose C Limited is a listed company, ma. What is a C Limited? C Limited is a listed company. Appointed A as an auditor for 4 years only. How many years? 4 years. After that, he took 1 year break. He took 1 year break. Again, he came to the company. Sir, please appoint me for next 5 years, sir. Why? Because I didn't complete 5 years. No. Allowed or not allowed? Not allowed. Here, what is the point is, once your tenure is done, sir, 5 years not done. No, 5 years is maximum. 5 years is the maximum. You can be appointed for 3, 4, 5, but not more than 5. Once your tenure is done, 5 years cooling period. So that means 5 years he should not come to this company. After 5 years, he is eligible for appointment. Getting my point? So any break in service, that break you should check 5 years cooling period, whether satisfied or not, you have to check. 1 year break there, no sir, that 1 year I'll fulfill now. No, 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 wait for 5 years. Clear? And no, in the rotation you have to remember these three special points ma. Incoming auditor, outgoing auditor, incoming auditor, outgoing auditor, they should not operate under same network. They should not have common partner. For example ma, for example, Reliance Industries Limited is there. Big Four only, I'll take two examples. Deloitte, EY. Two different auditors, right? Two different auditors. Deloitte is outgoing, completed, tenure 10 years completed. Now they want to appoint EY. Now one partner from Deloitte, he want to resign from Deloitte and he want to join EY. If this partner joins EY, EY will also be disqualified for the next 5 years. Getting my point? That is the third point. Third point, if a partner who was in charge of audit firm, certified the financial statement, retires and joins another CA firm, then new firm will also be disqualified for 5 years. Getting my point? Three special points. How many? Three. Remember, outgoing auditor, incoming auditor should not operate under same network, same brand name. They should not have common partners. Suppose ABC is outgoing, CDE is incoming. Who is the common partner? C. Disqualified. Both the firms are disqualified for the next 5 years. Over. Next, special points ma. Internal rotation is also possible ma. Internal rotation. Internal rotation means, for example, Reliance Industries Limited appointed Deloitte as an auditor. Imagine in Deloitte 5 partners are there. How many partners? 5 partners. Members can tell like this. First partner, you do audit of first year. Second partner, second year. Third partner, third year. Like that, internal rotation is also possible. It's up to the members. And company can also have joint audit concept. That means more than one audit, we call it as joint auditors. The joint auditors, classification will be like this. One auditor for North India operations, one auditor is for South India operations. Or one auditor is for assets, other auditor is for liabilities. Like that. Okay na? Fine ma. Even auditor tenure under Old Companies Act will also be considered while calculating 5 and 10. Under Old Act you already completed tenure, but there is a transitional provision ma. There is a transitional provision. The transitional period is, there is a transitional period. The transitional period is 3 years. After commencement of this section, I don't ask you immediately resign from the company because you completed the tenure. No, I'm giving you 3 years. That means balance tenure or 3 years, whichever is higher is allowed. Balance tenure. Suppose you are appointed as an auditor, only 1 year completed. Suddenly these rules came. Now what is the balance tenure? 4. Statutory period 3. 4 or 3, whichever is higher, 4 you can do. Sir, I am already auditor of that company for 20 years, sir. Now insertion of this section, I should immediately resign. But lawmaker is telling, don't worry, I'm giving you 3 years time period. Actually, balance tenure is 0. 0 or 3, whichever is higher means 3. 3 years you can continue as an auditor. Already, the provision lost its significance. 14, 15, 15, 16, 16, 17. Almost one decade is over. So that's why we can ignore that point. Next one, removal. Resignation done, removal. So tell me, who can remove the auditor? Who can remove the auditor? Removal can be done by the company ma. Can be done by the NCLT. Company also, 2 ways removal is possible. One is section 115, special notice. Yesterday I discussed in management and administration chapter, special notice. 1% of the voting power or 5 lakhs paid up share capital if you are having, not to reappoint retiring auditor. Okay. Other case is in between the year, board resolution plus CG approval plus special resolution. Remember the structure. What is the first one? Board resolution. Second one, CG approval. Third one, special resolution. If this equation is satisfied, then also you can remove the auditor. This special resolution shall be obtained within 60 days of CG approval ma. Within 60 days of CG approval, special resolution should be passed at general meeting. In one attempt, the question came like this. Board of directors decided to remove the auditor. Immediately called for a general meeting. In the general meeting, members removed the auditor. And then they filed application with government for the removal of auditor. Whether that removal valid or invalid. Because before SR, government approval is compulsory. CG approval is required. So BR plus CG approval plus special resolution. Within how many days special resolution should be passed? Within 60 days of CG approval. Just go through this. Board resolution to pass the auditor before expiry of the term, and yes, within 30 days ma, listen carefully, within 30 days of board resolution, file an application with CG. Time limits you observe carefully. Suppose this is board resolution date. Application to CG shall be done within how many days? Within 30 days. CG may give approval, we don't know. When CG gives approval, we don't know. But CG gave approval at one point of time. From that approval date onwards, call for general meeting within 60 days and obtain special resolution. If these conditions satisfy, then removal of auditor will be valid. Can I proceed? So yes, CG approval. For that, within 30 days of passing board resolution, file an application with CG. Once CG give permission, within 60 days, obtain special resolution. For IFSC companies, there is a deemed acceptance. Deemed acceptance. What is the deemed acceptance? Board passed resolution to remove the auditor and filed an application with CG. Wait for 60 days. If there is no response from CG for the next 60 days, you can assume that CG approved it. And immediately call for general meeting and pass special resolution for the removal. That is a privilege given to the IFSC companies. No need to wait. It's already a lot of administrative burden is there on the company, on the government. So you filed application. If there is no response from the government, wait for 60 days. Assume that it is deemed approved. And company shall appoint a new auditor within how many months, ma? Within 3 months from the expiry of the 60-day period. This privilege is only for IFSC company. And before removal, of course, auditor should be given an opportunity of being heard. Next, removal by the tribunal. That's what next point. Removal by the tribunal. Sir, why tribunal will remove the auditor, sir? We have seen NFRA section 132, accounts of companies. NFRA observed that auditor is negligent. Definitely it will raise a complaint. D bar is there. There is removal by the NFRA. But here it is NCLT. This section came before NFRA. That's why this section, that's why this section is important at that point of time. But right now, NFRA is taking care of all the things. A little bit administrative burden on NCLT was removed. Let's see. Who can apply for removal? Tribunal on suo motu. Tribunal on suo motu. Central government or any concerned person. If you remember, section 130, voluntary opening of, 131, revision of financial statements, voluntary revision of financial statements. Directors filed an application with a tribunal. Tribunal observed that auditor is negligent. Now tribunal on suo motu will pass an order for removal of the auditor. Application shall be submitted to tribunal. Procedure for removal. If tribunal is satisfied that auditor has acted fraudulently or colluded in the fraud with the directors and officers, it may direct the company to change the auditor. And it will file an application with CG, nothing but ROC only. If CG applies for the auditor removal and tribunal agrees, tribunal shall make an order that he shall not function as an auditor within 15 days of receiving the application. Now you tell me, here auditor is getting convicted by court or tribunal? Tribunal. Disqualification period will be 5 years. Disqualifications I told you. Convicted by court 10 years. Convicted by NCLT 5 years. Automatic removal 15 days of receiving the application. Disqualification for 5 years. Disqualification for 5 years. Liability. Fraud was committed by entire firm. Entire firm is liable. No sir, only one partner is involved in the fraud. That partner will be liable. If the conviction comes from a court, the prohibition period is not 5 years, it is 10 years. Already I discussed. Appointment of auditor other than retiring auditor. Section 115 just now I completed, right? 1% of the voting power or 5 lakhs paid up value. The same point Special notice. Special notice. How many days we need to send special notice before meeting? 14 days. Company will send it at least 7 days before the meeting. But here, extra point you will learn is, upon receiving the special notice, company shall immediately send a copy to the retiring auditor for their representation. And the auditor may request the company to circulate, the retiring auditor is having one opportunity to represent himself before the members. So he can make a written representation which should be circulated along with special notice. If not possible, allow the auditor to read the representation in the general meeting. Suppose if auditor is misusing the power, If auditor is misusing the power, if tribunal believes that auditor is misusing the right, that representation contains all defamatory content or detrimental content, baseless allegations, then tribunal may order not to read the statements, not to read the representation. The application for such an order can be made by the company or any aggrieved party. Okay, na? So if company fails to circulate the representation due to late receipt or company default, auditor can request that it can be read out of the AGM. If representation is not sent, copy shall be filed with ROC. Filing with ROC, extra point. And this provision does not apply if the retiring auditor has completed their mandatory rotation period. Or 5 years completed. Rotation of auditor applicable, 5 years completed. Automatically he will come out. Again, sir, I will file special notice, sir. I don't want that fellow to be reappointed. Even if you don't file that notice also, that fellow will go out because 5 years completed or 10 years completed. That means special notice required in this case, not required. Okay. Next. So with this what sections we completed so far? 139 appointment, 140 removal, resignation. In resignation, I'm telling you, it's your interest, you can resign, but your duty is to communicate with ROC and C&AG within 30 days, or else 50,000 or audit remuneration, whichever is less, plus 500 per day during such default continues up to 2 lakhs is a punishment. Next, 141 qualifications, disqualifications. Disqualifications, body corporate other than LLP, EVO, PE of EVO, SRP of, see, if you are watching in middle, you will not understand. I already gave abbreviations here. Okay. So EVO, partner or employee of EVO. Next one, SRP, self relative partner of group companies, cash plus SH, security, securities. Next, indebtedness guarantee. And next, prohibited services. Next, relative full-time employee, relative KMP or director. If he is full-time employee or if he is having 20 company audits, again disqualified. Okay, now prohibited services also disqualified. I forgot to tell you, prohibited services, important point important point. 144, prohibited services is connected with only 3 companies 3 companies. Company, holding, subsidiary. So far we have seen cash, cash plus SH, or cash plus SH plus AH. We have seen like this. But prohibited services, only 3 companies are covered. Company, holding, subsidiary. You remember that one. Company, holding, subsidiary. That's what. Yeah. Powers of auditor. So generally what powers he will have? He will be given unlimited access to the books of accounts. That's it. Unlimited access to the books of accounts. Unlimited access means all times are no, only during business hours, during working conditions. He can also have access to the books and paper simply. That means minutes, MIS reports, everything. He can go through it. And he is having right to obtain information and explanations like balance confirmation from the debtors, balance confirmation from the creditors, bank also. He is having right to receive notice calling for general meeting. At the same time, he is also having duty to attend the general meeting. Okay, now just I'm reading side headings because that matter you can read it. Explanation is also not required. Right to report to the members on the examined accounts. Also, it is a duty to sign audit report. Okay, duty to report. This report is with respect to 3 items One is balance sheet, other one is profit and loss statement, and the last one is cash flow statement. So yes, these 3 express true and fair view or not. He need to express an opinion. One question one question. Can auditor insist management to revise the financial statements? Can auditor insist management to revise the financial statements? For example, inventory actual valuation 80, but board of directors valued at 100, 20 crores overstated. Auditor observed this 20 crores. Now can auditor insist management to revise the financial statements? Answer is no. Answer is no. Auditor cannot insist management to change the financial statements. Auditor will convey. If management agree, no problem. If management disagree, disagreement. he will express opinion, adverse opinion, qualified opinion, or disclaimer opinion. Getting my point? So auditor can never insist management to revise the financial statements. Whatever he want to convey, he will convey in his report. Can I proceed? Next one, ma. And his duty to comply with Companies Act provisions as well as accounting and auditing standards on auditing. Reporting requirements, ma. Reporting requirements. Yeah, these points, these 10 points. One time reading, just give one time reading, 10 points. In his report, he should tell that whether he received necessary information and explanation or not, whether company maintained proper books of accounts or not, whether returns from the branches were sufficient or not, and how he dealt with branch audit reports. Next one, whether financial statements are in agreement with books of accounts. Suppose in books, suppose in books of accounts means what? Sales and purchases, right? In sales register, reported turnover is 100 crores. In profit and loss account, reported turnover is 110. Agreement or disagreement? Disagreement. Report it. Whether financial statements comply with accounting standards or not. Observations, comments that negatively affect the company. Any other observations? Whether any director is disqualified or not. And the qualifications, reservations, adverse remarks regarding maintenance of the books of accounts. Internal financial controls, and views and comments on the following matters: about the impact on pending litigations, about forcible material losses, adequate provisions were created or not, transfers to IEPF. And next one, this is a recently added point. Recently means 2-3 years back. Yeah, company has not advanced loaned invested funds to any intermediary with an understanding that they will further lend or invest in other entities. Oh my god. See, to understand this point, Shivaji sir is having 20,000 crores black money. He gave it to US person to convert into white, and again he is taking back. Legal practice, illegal practice, illegal practice. Same point here also. See, company has not advanced loaned invested funds to the intermediaries, for example to the subsidiary, with an intention to invest in other entities. See, as a my MOA, for example, my MOA not permit to do that activity. That's why I'm transferring money to subsidiary to do that activity. If such things happen, report it. And another one, see here, company is giving money, and here company is receiving money. Here it is donor giving money, but here it is recipient receiving money. Company has not received funds from any funding parties with an understanding that company will invest or lend that amount to other ultimate beneficiaries. One is donor, other one is recipient. Simply to understand one more example, Kanchana movie you take, Raghav Lawrence sir, one movie. Politician approached Raghav sir and told, we will give you 100 crores. You give us 70 crores. So here also, we will give you loan of 100 crores. You transfer that amount to Swiss account, Swiss bank account or Singapore account, like that. So company should not give and company should not receive. Auditor has not found any material misstatements and declared dividends complied with 123. Accounting software audit trail is there and it was not disabled. Audit trail feature was operated throughout the year but not tampered. So he need to express opinion, he need to comment on all these points. Just give one time reading, as an auditor, what the things I need to report. Just imagine yourself as an auditor, write these points. Direct question will not come, time limit to not there. Maybe this is somewhat different point, no? That's what. Duty to sign the audit report. Who is having duty to sign the audit report? Auditor. One who did audit, he will sign the audit report. Duty to comply with auditing standards. Correct. Duty to attend general meetings. Normal points only, but exception is there. Either you can attend general meeting in personal capacity or through your representative, who must be qualified under section 139. I'm sorry, 141. That means he should be he should also be a practicing chartered accountant. Simply my partner. Next, 143.12. Section 143.12. So what is section 143.12? Reporting of frauds. In this, recent RTP, this amendment came. Recent RTP, this amendment came. What is the amendment? You tell me. Lawmaker. Who is our lawmaker? Senior most outdated lawmaker. According to him, Reporting means what kind of reporting? Manual mode of reporting. But already system has been changed. Electronic reporting already implemented. When electronic reporting is already there, why to send manual reporting? That's what this content was deleted in the recent RTP, and I simply striked off these 2 points. Instead of deleting these 2 points, I simply striked off. Okay, so soft copy content of the soft copy was not changed, simply for better reading purpose, better understanding purpose. 4 to 5 cases, small changes I did it. Even though if you are not aware of that changes, no problem, you can read it. And one more point, the highlight of this material is, this is not a summary notes. First of all, this is not a summary notes. That means you won't find point wise point. Its continuity will be there. Continuity will be there, like heading left side, yes or no, yes or no, like that. It will be not there. Continuity will be there. And the background behind this material, background, why I made it crispy is, we need to answer 5 questions, descriptive questions. How many? 5. In each there will be 3 questions. 5 into 3, 15. Out of 15, 12 questions are practical questions only. Only 3 questions. That too, interpretation of statute, 2 questions, and 1 question from other area are descriptive. So 12 questions if they are practical questions, and the answer you need to write is provision, analysis, conclusion. Analysis, conclusion you can write in own words. Only provision. That means 30 to 40% of your answer only need the content of the book. So going through ICA book, reading that entire content means time waste. Getting my point? If you take ICA book, 990 pages total. I just made it in 220. Don't worry. Question bank is there, separate question bank. That is another 240. That means 220 plus 240 means already 460. So that summary content and students to know these points, like that paragraph points are there. I just made it a one point, one simple line, that's it. So that's why this material came. Only 30 to 40% of your answer should match ICA answer. Balance, analysis, conclusion you can write in your own words. So for the 30 to 40%, mugging up entire content is not relevant. That's why I made it crisp. So happily you can remember this text. Reproduce this text in the provision. Analysis, conclusion you write one words. That's it. Over. Exam over. Okay ma. Fine. So next. So what is this section 143.12? According to section 143.12, remember, fraud amount greater than or equal to 1 crore. Greater than or equal to 1 crore. Less than 1 crore. This should be reported to CG. This reporting to board of directors enough. But here timelines are there. Timelines. Whenever auditor identify the fraud, immediately he need to communicate with board of directors or audit committee. Immediately. That means within how many days? Within 2 days. And wait for 45 days. Wait for 45 days for their replies. 45 days. Within 45 days, board of directors should give reply. If not, within next 15 days, communicate with central government. Communicate with central government electronically. Getting my point? 3 time limits ma. 3 time limits. So let me show you. 45 to 15. To 45, 15. 2 days communicate with the management. Wait for their reply. If reply comes, from the date of reply, within 15 days communicate with government. If no reply, then upon expiry of 45 days, within next 15 days communicate with central government. Can I proceed? Which kind of frauds? 1 crore or more. And who should do that fraud? Customer? No. Employee, officers of the company doing the fraud. Getting my point? Recently one of my client company, what happened is, daily they will receive some 1,000 plus orders without checking bank confirmations. What they did? They asked phone pay screenshots. One customer, intelligent customer, he edited the phone pay screenshot. Suppose I need to pay to the company C Limited. I will save my relative number as C Limited. I'll transfer the money. On screenshot you will see C Limited only. Without verifying the bank account, what company did? Company dispatched the product. Of course, here officers and employees are negligent, but we can't say negligent because too many orders they received on that day. It is not possible for them to verify. So now who committed fraud here? Employer, officer, customer, customer. These kind of frauds no need to report. What kind of frauds to be reported? Officer, employee. And remember, if auditor identify them, auditor should report. Suppose before auditor identified that fraud, company management itself identified the fraud. Management itself identified the fraud. Then auditor is not required to report to CG. Auditor will report to CG only if he detect the fraud. Which fraud? Employees or officers fraud. How much amount? 1 crore or more. So the report must be filed electronically in form number ADT4. If fraud amount is less than 1 crore, same time limit 2 days, 2 days only. 45 days, 15 days concept will not come. And in board report, yes, in section 134 I told 143 12 point. In board report, if you see above point, the report shall include the original fraud report, board of directors reply, auditor comments. And here you will see nature of the fraud with brief description, how much amount involved and who are the parties involved, what remedy directors took. Everything should be there in board report. So same point is there in section 134. I told that I will discuss later. Yes, finished. So board report shall include nature of fraud. Sorry. This report is auditor report, ma. This report is by auditor, and this is the board report. Yeah, that's what. If you go through 134, the point is very clear. Frauds other than the frauds reported to the CG. Other than the frauds reported to the CG. That means 1 crore and above frauds, no need to report them in board report. Which frauds to be reported in board report? Less than 1 crore. Less than 1 crore. Nature of the fraud, approximate amount involved, parties involved, remedial actions taken. Other related provisions. This identification of fraud, report to the board of directors, report to the government. This concept is not only applicable to company auditor, but also applicable to cost auditor, but also applicable to secretarial auditor. Understood? To these three fellows, this concept is applicable, or else listed company auditor will get penalty of 5 lakhs. Unlisted company auditor will get penalty of 1 lakh. Next one, branch office. Simple concept. Time limits are not there. Simple concept. Listen, branch auditor. Branch audit. Who can do branch audit? Company auditor can do branch audit. Sir, more number of branches are there, sir. For example, SBI, you take 20,000 branches are there. Is it possible for company auditor to do all the branches? Is it possible for one auditor to do audit of all branches? No. No, for branch audit, who can be appointed? Who will appoint? Who will appoint? Obviously, company. But members can delegate this power to directors. Seema. Members may delegate this power to directors. Which auditor? Branch auditor. Branch auditor. If that branch is in India, who can be appointed as branch auditor? Same, practicing chartered accountant. If that branch is outside India, availability of practicing chartered accountants will be not there. That's why select a person who is qualified to act as an auditor according to that country. For example, USA, you take CPA. Australia, CPA people are there. Appoint them as an auditors. So branch auditor will prepare a branch audit report, audit report, and it will be sent to company auditor. And reporting of frauds is also applicable to branch auditor. Reporting of frauds is also applicable to branch auditor. That's it, ma. In this entire case, you need to observe this one. Who can be the auditor? Company auditor or any CA with COP. If branch is located outside India, company auditor or accountant of that country or any person qualified to act as an auditor under the laws of that country. That's it. Who can appoint branch auditor? Generally members, but members can delegate power to board of directors. Can I proceed? Audit remuneration. In audit remuneration, you have to remember which will be included, which will be excluded. Included fees, audit fees is included, ma. Any facility given to the auditor, facility like reimbursement of the stage accommodation charges, reimbursements, and also expenses incurred during the audit, facilities provided to the auditor by the company. These three are included. Next one, what is excluded? That is important. What is excluded? I'm the company auditor. Suddenly company got income tax notice. Management called me and asked, please handle this notice. Immediately I will see 144 whether it is there in prohibited services. No, it is not covered in prohibited services. MIS, internal audit, banking service, actual service, accounting service. It is not there. So can I provide it? Yes, I can provide it. Now for providing these services, definitely I'll charge extra some remuneration. Is it part of audit remuneration? No. Getting my point? Getting my point? Everyone. Suppose I'm auditor of some, tell me famous hospital. Famous hospital here. Huh? Okay, whatever it might be. One hospital. I'm the auditor of that hospital. How can I act as a doctor? Ignore. Suppose I'm also a doctor. One day sudden case came. I did a surgery. So is that audit remuneration or separate remuneration or separate? Will it be included or not included? Okay. Auditor, doctor. Ignore ma. I'm not. Ignore this example. Okay. Fine. So remuneration does not include payment for any other services provided by the auditor at the company's request. Example, tax notices, handling tax notices. Now, who is having power to fix the remuneration? Generally, remuneration is fixed by members at general meeting. But first auditor remuneration is fixed by board of directors because board appoints first auditor. Last but one concept. Last but one concept. Oh, NFRA, here also it is there. Oh my god. Okay. Simple ma. Cost auditor, remember, cost auditor. Appointment authority. Who is having appointment authority? Who can appoint? Board of directors. Who can be appointed as cost auditor? Practicing CMA. Can company auditor be appointed as cost auditor? No. Appointment power is with board of directors, whereas remuneration ratification, I repeat, remuneration ratification is by members. Members should ratify the remuneration. And you know what? Company audit report will be addressed to the members, whereas cost audit report will be addressed to the government. Government want this audit, that's it. Remember only this point. Appointment by board of directors. And this appointed person shall submit cost audit report within 180 days of closure of financial year. See, just observe carefully. Who should maintain cost records? Companies with total turnover of 35 crores or more. Which companies? Companies that are falling in table A, table B. Table B. Myself trading entity. I buy, I sell. No further processing. For me, cost audit applicable. Manufacturing entities only. Companies falling in table A, table B. If their total turnover exceeds 35 crores, if their total turnover is 35 crores or more, then cost audit is applicable. Authority. CG may direct the companies to maintain cost records. If company operates under special act, regulatory body of that act shall be consulted before issuing any order. Company operates under a special act means, suppose government brought one act. Under that act, a company has been incorporated. Like for example, IOC, BHEL, BEL, all these are normal companies only. Imagine if these are statutory companies. Now that regulatory authority should be consulted before taking such steps. And this is a relaxation micro small enterprises, MSME. Suppose you take small company, for example, small company. What is the turnover limit? Right now 40. For examination, not examination. Right now what is the limit? 100 crores. If 35 crores turnover touched or crossed, cost record should be maintained. Small company turnover with 50 crores possible or possible. If it is possible, no. Right now, 1st December onwards, 1st December 25 onwards, turnover limit is 100 crores. So there is a small company with a turnover of 80 crores and it comes under MSME. In that case, cost records applicable or not applicable? Not applicable. Exemption. No confusion. Okay, now I'm telling for September attempt, imagine. Or else, for May attempt only, if you want, small company maximum turnover is 40 crores for May attempt. What is the cost records limit? 35. 40 means greater than 35 only, no? So small company coming under MSME, is it required to maintain cost records under this section? Not required. Relaxation. Cost audit. Cost audit is in addition to the statutory audit approved by the board of directors. Before submission to the cost auditor, cost statements and related documents shall be approved by the board of directors, signed by the director. Are same for 134 also. Financial statements before we submit to the auditor for audit, approved by the board, signed by chairperson plus CEO, CFO, CS. Or two directors, one should be MD plus CEO, CFO, CS, right? Same point. Who can be appointed as cost auditor? Practicing CMA or firm of cost accountants. Person appointed as a statutory auditor cannot be appointed as cost auditor. Cost audit report shall be submitted to board. Comply with cost auditing standards. Cost audit report submission. Within 30 days of receiving the cost audit report, the company shall submit it to the CG along with explanation for any reservation or qualification in the report. If CG requires further clarification, company shall provide additional information within the specified time. Normal points ma. Within 30 days of receiving the report, submit it to the central government. If central government asks for additional information or any clarifications, company should immediately provide that clarification. Circumstances, retiring auditor can't be reappointed. I told you before appointment, auditor appointment, if you see, appointment before some formalities are there, after appointment some formalities are there. What is the formality after appointment? ROC filing. ROC filing within 15 days. NFRA filing also within 15 days. But before appointment, if you see, written consent important. Next one, eligibility certificate. Eligibility. I am eligible to accept this audit. No disqualifications. And next one, what? Pending proceedings. Suppose if this fellow is not giving this consent, can he be reappointed? No. Or he resigned from the office. No need of reappointment. Or disqualified. No reappointment. You can see here. Does not meet qualification. Suppose he surrendered CA certificate. He got irritated with CA practice, for example. Surrendered CA certificate. Or he became disqualified, or company auditor has given written notice that I am not willing to continue, or auditor has not given written certificate, or in a general meeting resolution has been expressly passed to appoint another auditor, or retiring auditor not to be reappointed. These 5 cases can be tested. Simply 5 points, right? 5 marks can be asked. This point can be asked for 5 marks. 5 points. Qualifications lost, disqualification attracted. Next one, not giving written consent, or expressly he gave letter not to be reappointed. No, he's telling that don't appoint me. And last one, resolution has been passed not to reappoint this fellow or appoint another fellow as company auditor. Penalty for non-compliance, give one-time reading. Violation of these sections, company violating this chapter 139 to 146, this is punishment to the company, and this is punishment to the auditor. Auditor punishment, second point. Don't mix it and read it. Fines, punishments, generally come for 4 to 6 marks. That means not a separate question. In the question they will ask, and for that punishment 2 marks, allotted marks will be 2 marks. 4 to 6. If you are able to remember all punishments. Or else forget some 4 to 6 marks. That's it. NFRA auditor. In NFRA I covered these points. You already seen these points. NFRA shall publish non-compliance findings in website unless against the public interest. Same points. File NFRA 2 by 30th November every year. So NFRA points already covered. So with this, audit and auditors marathon completed. Let's continue marathon with the next chapter, companies incorporated outside India, which is the last topic of Companies Act 2013. The expected weightage of this chapter in your examination is minimum 5 marks. One descriptive question, or you can expect 3 multiple choice questions which carries 2 marks each. That means 6 marks. So 5 or 6 marks you can expect from this chapter. Simple chapter. So what is our chapter name? Companies incorporated outside India. Section 379 to 393. And again these sections are of 2 types. Section 382, 386, 392, 393. This is one category. And the second category is 387 to 391. 387 to 391. 87, 88, 89, 90, 91. 2 categories. This category is applicable to only foreign companies. This category is applicable only to foreign companies. And this category is applicable to companies incorporated outside India. Now we need to understand the difference between company, foreign company, company incorporated outside India. These three terms we need to understand. Then half of the chapter will be over. Half of the chapter will be over. See, company means company incorporated under Companies Act 2013. Getting my point? Company means company incorporated under Companies Act 2013. All Indian companies, all domestic companies are companies. Then company incorporated outside India means incorporation happened outside India, maybe US, Canada, Australia, America. That is not under Companies Act 2013 for outside companies, simply outside companies. Then what is a foreign company, sir? What is a foreign company? Very simple, ma. Company incorporated outside India if it is having place of business in India. If it is having place of business in India, or if it is having business activity in India, then it becomes foreign company. That means every foreign company is a company incorporated outside India, but every company incorporated outside India need not be a foreign company. Are you getting the difference, everyone? Every company incorporated outside India need not be a foreign company, but every foreign company is a company incorporated outside India. The condition is it should have a place of business in India, either directly by itself, they are coming and establishing a branch, or through agent. And mode of business activity can be either physical or electronic mode. Both are allowed. For example, Facebook, Netflix, PayPal, payment apps, payment gateways. So they are doing business online. Clear? So mode of operations can be physical or electronic mode. Business activity should be in India. And sir, coming to the electronic mode, 5 points are there, ma. If your activity is falling in these 5 points, then business activity is said to be in India. First one, digital transactions, business to business, business to consumer, data interchange, digital supply transactions. For example, Alibaba website. It's similar to Amazon only. So incorporation was China, incorporated in China, having business activities in India. Or else, forget about these things. PUBG is there, right? PUBG is PUBG or Meta. Best example, Meta. WhatsApp, Instagram, Telegram, we are using it. The platform provider is Meta, incorporated outside India. So data interchange, digital supply transaction, financial services, accepting deposit, inviting deposits, accepting subscriptions in securities, or offering financial services to Indian citizens. For example, PayPal. Next one, online business operations, web-based marketing, advisory, transactional services, financial settlements, database services, supply chain management. Amazon was incorporated in India, company Amazon, but headquarters is outside India. Flipkart is an Indian company. So you can take Amazon B2B, and you can take this one also, Windows software. For example, the moment you purchase a laptop, installation of Windows, MS Office. So all these are incorporated outside India, these companies, but they're providing services in India online. Digital services, online services such as telemarketing, telecommuting, telemedicine, education, research, and data communication, conducting business via email, mobile services, social media, cloud computing, document management, voice, data transmission. Another example, Google and YouTube incorporation. YouTube also best example only. It is providing advertisement services also. So all this comes under electronic mode of business operations. But remember this one exception, important exception. If offering securities, subscription of security, listing of securities happens in gift city by IFSC companies, even though it comes under electronic mode, relaxation is given. It is not electronic mode of operation. Relaxation, nothing but these sections are not applicable. Getting my point? So 382, 386, 392, 393 is applicable to all foreign companies. That means they are carrying some business operations in India. Whereas 387, 391, it is applicable to all the companies incorporated outside India. What are these two categories, sir? One is telling about incorporation procedures. And second category, this is, public offer, prospectus, 387 to 391. 387 to 391 is dealing with public offer of securities. Okay, na? Applicability of Companies Act. Okay. But before that, just now I told you, place of incorporation should be outside India and place of business should be in India. That business can be either in electronic mode or physical mode, directly by itself or through agent. Okay na, it's immaterial. Where cloud is, where storage facility is there, where the cloud management is there, immaterial. Business activity in India na, that's it. So based on this, let's see one practical question ma. Incorporation Singapore, registered in Singapore, developed patients database for a hospital in Mumbai. Incorporation outside India, providing services in India. Sir, server was located in Singapore, immaterial. Where server located, immaterial. Is it a foreign company or not a foreign company? A foreign company. UAE, no place of business in India, but employs agents in India. It is having agents, no business activity. It just had agents, no business activity. Therefore, not a foreign company. Getting my point? Employing agents alone is not sufficient. Business activity. Cape Town, board meeting held in India. Board meeting will not come under place of business. Business activity. Simply directors gathered at one place in India. No. At least share transfer agency or share transfer agent located in India. Yes, under electronic mode you can call it as place of business is said to be in India. Germany, 49% of the shares held by Indian company. Here place of business in India they didn't mention. Therefore, this is not a foreign company. This is just a company incorporated outside India, not considered as foreign company. Getting my point? So you have to remember that place of business should be in India and there should be some business activities. Business activity includes all these points: digital transaction, financial services, online business operations, digital services, data communication. So our Google Drive is also a foreign company only. I mean Google, simply Google providing drive facility. Server is located in India, no. Applicability of Companies Act section 379. Here important concept point 2, already tested. What is this point? Remember carefully. First 382, 386, 92, 93 apply to only foreign companies. Next one, deemed Indian company ma. What is the second point? DIC, deemed Indian company. Listen carefully. Two or more Indian citizens or simply one or more Indian citizens. Okay, suppose Indian citizen example and Indian body corporate incorporated in India. If these people are holding 50%, 50 also sufficient, it's not more than 50% of paid up share capital of 50% of paid up share capital of a company which was incorporated outside India. See Singapore, for example, company C Limited, Singapore. And if this C Limited is having place of business in India, then C Limited is deemed to be Indian company. It should comply with all 29 chapters, all 470 sections. That means all the sections that are applicable to normal companies, same sections are applicable to this company. Getting my point? See, equation you should remember like this: Indian citizen or Indian body corporate or both, holding how much? More than at least 50% of paid up share capital of company incorporated outside India, having place of business in India. Actually, the equation to this is foreign company, but this is not foreign company. This is deemed to be Indian company. Getting my point? And tricky point is paid up share capital means either equity or preference or both. If equity is there, only equity. If preference is there, equity plus preference. Let me redraft it. Equity plus preference. Now listen to me carefully. Listen to this example. Mr. A, Mr. B, Indian citizens ma. There is a company in Singapore, Yes Limited, which is also having place of business in India. Yes Limited capital structure, if you see, equity share capital 1 lakh amma, paid up share preference share capital 1 lakh. Equity share capital 1 lakh, preference share capital 1 lakh. And this entire preference share capital is held by A and B. Entire preference share capital was held by A and B. This 1 lakh is held by Singapore citizens. SC, Singapore citizens. Now tell me whether S Limited is a deemed to be Indian company or not deemed to be Indian company. Tell me, deemed to be Indian company or not deemed to be Indian company? Deemed to be Indian company. Sir, equity not there, no. Lawmaker very clearly told whether it is equity, preference, both are not a matter. 50% of the paid up capital. So what is the total paid up capital? 1 lakh plus 1 lakh, 2 lakhs. Out of 2 lakhs, 50% means how much? 1 lakh only. So whether you are holding preference or equity or not a matter. Out of total paid up share capital, if you are holding 50%, and if that company is having place of business in India, then it is deemed to be Indian company. Okay, na? Another example, very important. Another example. Suppose Ram, Rahul, both holding a 96% paid up share capital of U Limited, which was incorporated in USA. Place of business is also USA only. Place of business also USA only. Now whether U Limited is deemed to be Indian company or not deemed to be Indian company, or not deemed to be Indian company, because there is no place of business in India. Conditions. First of all, it should be a foreign company. That means incorporated outside India, having a business in India. And in that company, 50% of the capital is held by citizens, body corporates, combination. Then it is deemed to be Indian company. It should comply all the provisions of chapter 22. All the provisions of chapter 22. Clear? Next one, ma. Do you remember section 7? Incorporation of company. Promoters has to prepare a bunch of documents and file it with a ROC. What are the documents? MOA, AOA. Next, compliance declaration. Declaration by the subscribers and directors. Address for temporary correspondence. And next one, written consent of the directors, details of the directors, details of the subscribers, right? Same points here also you write. But incorporation section 7, before incorporation you have to submit the documents. Only if you submit documents you will get incorporation certificate. But here, after you establish business entity in India, after you come to India within 30 days, remember, every foreign company shall within 30 days of establishing a place of business in India submit the following to ROC CRC. This is an amendment, ma. In your book you will find ROC New Delhi. ROC having jurisdiction over New Delhi. Like that you will see point. But 2 attempts back RTP amendment is there. Amendment ROC CRC. CRC means Central Registration Certificate. Only this one form, ma, FC1. Remember, total in this you will find 4 forms, ma. FC1, FC2, FC3, FC4. FC1, FC2, FC3, FC4. FC1 should be filed with ROC CRC. What is FC1? Incorporation document. So are we incorporating? No. We are just submitting the information. For getting permissions. That's it. FC2 is variation of FC1. Any variation happened in the documents you submitted at the time of establishment of business in India. Any variation you need to file it in FC2. FC3, FC4, annual returns of financial statements. Okay, na? Very simple. Only 4 forms you have to remember. FC1, FC2, FC3, FC4. Amendment ROC CRC for registration. A certified copy of the charter document, there I told constitutional documents MOA, AOA. Here you need to submit same MOA, AOA, but along with that certified copy of the charter. Sir, what is meant by certified copy of the charter? What is the evidence that company was incorporated? Certificate of incorporation, right? In India, we call it as certificate of incorporation. Outside India, we don't know the name. That's why we are asking chartered documents. Available in English, no problem. If not in English, obtain a certified English copy. That means, someone should translate it and someone should verify it. An advocate having knowledge of that country language should certify it. Yes, correct translation only. No defect like that. Full address of registered or principal office of the company. Address for temporary correspondence. So constitutional documents, address copy. Next one, list of directors. That means details of the directors. List of the directors and CS with prescribed details. Prescribed details means what? Name, surname, former name, parents name, spouse name, birth date, residential status, nationality, passport, PAN, occupation, directorship, other directorship held, membership number, email ID. Next one, E point is about there we have seen address for temporary correspondence, right? Here you will see address of authorized person. Foreign company, registered office is outside India. If a department, ROC or income tax department want to communicate something with the company, how can they communicate? Directly writing letters to the head office? No. You can send letter to the person authorized by the company who can carry activities in India. Authorized person in India authorized to accept legal notices and documents. And full address of the Indian office which is considered its principal place of business in India. In case any previous openings, previous closings are there, previously 5 years back you came and you opened a branch and you closed it, those details also you mention. Statement H point ma, statement confirming that no director, no authorized representative has been convicted, debarred from company formation, management in India or abroad. On this point, case scenario booklet, if you see one MCQ is there, read it carefully. I'll ask MCQ, read it carefully. Statement confirming that no director, no authorized representative has been convicted, debarred from company's formation, management in India or abroad. If you remember, in section 7, a declaration that we have not convicted any offense last 5 years, same point. But there all subscribers and all directors will give. Here who is giving it? Director and authorized representative. And let me tell you the MCQ, how the MCQ they framed it. A is a director, B is also a director. Directors Ram, Rahul, two directors ma, Ram, Rahul. Authorized person Anil, authorized person Anil. Company secretary Charan. Now company should obtain a declaration about no debarment, declaration that we have not convicted any offense, or declaration. The declaration should be obtained from whom and whom? Option A, Ram, Rahul, Anil, Charan. Option B, Ram, Rahul, Charan. Option C, Ram, Anil, Charan. Option D, Ram, Rahul, Anil. Getting my point? So declaration shall be obtained from whom and whom? Directors and authorized person. CS is not required. CS, who is CS? Charan. Wherever Charan is there, those options are wrong. Option D. So that MCQ is there in case scenario booklet. So any other details as may be prescribed. So what is the applicable form? FC1. What is the time limit? Within 30 days of establishing the place of business. Contents, just remember ma, if you are able to remember, or else section 7 points only you write. Constitutional documents, details of the director, details of the authorized person. Next one, declaration of no debarment, that is from authorized person and directors. Address for temporary correspondence, for that give address of India, address in the India, give address of authorized person. And then previous openings, if at all there, mention those details. Any other particulars as may be prescribed. What is applicable form? There it is SPICE, here it is FC1. What is the time limit? Within 30 days of establishment of business in India. Over. Next one, if at all your company needs RBI approval, you need to attach RBI approval letters also, because foreign currency inflow and outflow will be there, right? So if at all needed RBI approvals, any additional regulatory approvals are required, they must also be submitted. In case approvals not required, then just give a declaration. We are not required to get any approval from any authority. Like that, give a self declaration. Next one, ceasing business in India. If you want to close business in India, immediately, there is no time limit, immediately give intimation to the ROC. Why? If you give that intimation, subsequent obligations like filing of annual returns, filing of financial statements, those obligations will come to an end, or else that obligation will still continue. Next one, complaints for existing foreign companies. Before commencement of these rules, already some companies came into the India, for example. So for them, complaints with old Companies Act is enough. No need to hurry burry, no need to follow new Companies Act. For you, old Companies Act as usual applicable. Reporting alterations. Suppose I told in my example I told Ram and Rahul are the directors of the foreign company, right? Suppose Ram resigned, in the place of Ram, Ravi was appointed as a director. Is this a variation or not a variation? Variation. These variations communicate in FC2. Communication in FC2 within how many days? Within 30 days of variation. Okay na? That is also same. Whenever you alter MOA, file altered MOA with ROC within 30 days of special resolution. Here also, alteration of any information which you submitted previously, communicate the same with ROC within 30 days. In which form? FC2. Only FC1, ROC, CRC. Remaining forms, ROC having jurisdiction over New Delhi. Can I proceed? Accounts of foreign companies. For this, Just now we finished chapter number 9, section 128 to 138. We finished, right? Same rules will apply, ma. Every foreign company must each calendar year. See, financially, it is not financial period. For each calendar year means, suppose ma, last year 31st March 25 I prepared one financial statements. This year 31st March 26 I prepared one financial statements. That means every calendar year is having financial statements or not? Yes. They are not telling that calendar year is the financial period. They are telling for every calendar year there should be financial statements. And coming to the financial period, April to March. If you want to follow different period, get approval, follow the different period as financial year. So there is no exemption like, first year no need to prepare financial statements. No, every year you have to prepare balance sheet, profit and loss account, and deliver a copy of these financial statements to the ROC. Sir, what is the format, sir? Schedule 3 only. And follow chapter 9. Latest consolidated financial statements of parent foreign company shall be submitted. Getting my point? Not only Indian business operations, your parent company might have prepared CFS, right? Ask them to get it, to provide the documents. That copy of document shall also be filed with ROC. A foreign company with a place of business in India not necessarily have to follow 31st March of financial year if it has obtained approval from the CG. If you get permission from CG, you can follow different period as financial year. But every year there should be financial statements. Next one, ma. If any of these above documents are not in English, obtain certified English translated copies. Okay, na? Next, this is important, ma. This is important. So far, I think not tested. In MTPs, I have seen it. This is important. Attachments to the financial statements. Generally, what we see, board report to audit report to notes to accounts. Here you will see related party transaction, repatriation of profits, transfer of funds. Related party transactions, separate statement. Repatriation of profits means, for example, this year foreign company got 20 crores profit. Out of this, how much profit was paid as a dividends to the parent company or parent entity? Suppose 15 crores. And transfer of funds. This is different. Second one is about, for example, dividends. Third one, investment, some 100 crores came and they withdrawn some 40 crores. So transfer of funds. For transfer of funds, also prepare a statement and file it, including dividends. That is different statement. This is different statement. You have to mention the reasons: withdrawal, dividend, others. Next one, what is applicable form? FC3. There AOC4 for companies. What is applicable form? AOC4. Whereas for foreign company, FC3. Three forms over. FC1 establishment, FC2 variation, FC3 financial statements. Tell me, what is the time limit for filing financial statements with ROC? 30 days from AGM. But for this company's AGM, company is incorporated outside India. How can I ask company to conduct AGM here? So here the time period is 6 months, ma. 6 months. Every foreign company shall submit list of all its business location in India, form FC3 with prescribed fees along with its financial statements. You can see time limit for submission 6 months from the closure of financial year. For OPC 180 days. For foreign companies 6 months. The registrar may grant extension up to 3 months if a written application is submitted by the foreign company showing a special reason. It's like, extension of AGM. AGM can be extended up to 3 months, right? Here also, what is the general rule? 6 months. But it can be extended by the ROC up to 3 months. Who is having power to grant extension? ROC. Every foreign company have its Indian business operation accounts audited as per section 381 by a practicing CA or a partnership firm or LLP of practicing CAs. That means chapter 10 principles will apply as if you are an Indian company. Okay, na? Sima, chapter 9, chapter 10 as usual applicable. But coming to chapter 9 applicability, here we are asking additional 4 attachments, ma. Additional 4 attachments. One is list of locations from where you are operating in India. Second one, related party transactions. Third one, repatriation of profits, transfer of funds. These 4 you need to give. What is the time limit for filing FC3? What is the time limit for filing FC3 form? 6 months. 6 months from the closure of financial year. If at all needed, you can get extra 3 months time period. And next one, sir, parent company financial statement should also be submitted. Yes. Which language? English. Not available? Get certified translated copies. That's it. Another point. This was already tested. Two attempts back. According to this point, ma. See, ma. display of name, display of three items, name, country of incorporation. Next one, if members liability is limited. What? If members liability is limited, members are having limited liability, you have to display these three components. Third component, suppose if members liability is unlimited, you can hide this third one, you can hide this, so third one when required, only when members liability is limited. Sir, where to display, sir? Two places ma. One is board, name board. One is name board. Where should I keep name board? At the entrance of each and every office you are having in India. In how many languages? Two languages. One is English, and the other one is local language where company is operating. Where foreign company is operating. And next one is official publications. Official publications, for example, invoice, notices. In that case, English language is enough. English language is enough. No need of local language. Getting my point? What should be displayed, ma? Name of the company, country of incorporation. If members liability is limited, then mention that members liability is limited. Where to display? Name board as well as official publication. Name board two languages. Name board two languages. But in that attempt, in that options, another option also given. English, local, as well as the country language where company was incorporated. Out of the four options, best option is that one only. Can I proceed? Yeah. So company name, country of incorporation, conspicuously. Every office or place of business in India. In how many languages? English, local language, two languages. And company name, country of incorporation shall be stated only in English characters on all official publications. Next one, if members liability is limited, then clearly you mention it. Where? On all official publications, English language and name board, both in English and local language. So this is the provision that is there in study material. Simplified way you can do like this. Simplified way, very simplified. Display of name, country of incorporation, members liability limited. So name board to official publication. Don't get confused with this. Here local language required, sir. No. Just write and strike it off. Next one, ma. Service on foreign company. Section 20 you remembered, right? How to serve documents to the company, manual mode or electronic mode. So here where at register office, but here register office is outside India. That's why here you can send documents to either authorized person or to the address submitted to ROC in FC1. In FC1 you told that this is the principal place of business. So to that address if you serve the documents, we assume that documents are properly served. 383 over. Next one, 384 I think. See, for debentures, section 71 will apply as if this is an Indian company. If a foreign company is issuing debentures, follow 71. That means what? For CDs, check members approval. Getting my point? Secure debentures, register the charge also. That point is also there. Charges will apply as if this is an Indian company. Next one, regarding annual returns, section 92 will apply. Sir, in 92, the time limit is 60 days from the date of AGM. But here AGM is not required, no. Then 60 days from the date of closure of financial year. Applicable form FC4. Applicable form FC4. See, 60 days from the closure of financial year end. Getting my point? Applicable form FC4. 4 forms over ma. FC1 establishment, FC2 variation, FC3 financial statements, FC4 annual returns. Time limits, FC1 30 days from establishment, FC2 time limit 30 days from variation, FC3 time limit 6 months from the closure of year, FC4 time limit 60 days from the closure of financial year. Books of account, section 128 will apply. Here books of accounts means receipts, payments, sales, purchase, assets and liabilities. Next one, inquiry, inspection, investigation. Chapter 14 will apply as if this is an Indian company only. And whenever you are filing documents with ROC at free of cost, no, some fees will be there. How much is the fees? that fees will be prescribed in the rules. That is sixth point, section 385. Okay, na? Next one, 386, interpretation. Certified means what? It refers to a true copy or correct translation verified in the prescribed manner. So like advocate in high court, these people will have, power to verify such kind of documents. It's like verification. Original language, English language. Exact translation or any intentional manipulation is there. They will verify it. Director. In this entire chapter, director means not only the director of the company but also shadow director. Shadow director means who includes any person whose directions, instructions the board of directors follow. Shadow promoter point I told first day, same point. Place of business includes share transfer, registration office. That's what I'm telling you. Business activity. For example, in an examination, if they ask question like this, company incorporated in Canada and share transfer office is located in India. Only share transfer office is there. Nothing else. No agents. Nothing else. Is it a foreign company or not a foreign company? Yes, foreign company, because place of business also includes share transfer office. Money movement is there, right? See, share transfer office is there means some few people might purchase the shares, might transfer the shares, might sell the shares. Money activity is there. So remember, this point is important. Maybe next attempt may be tested. Place of business includes share transfer office or share registration office. Can I proceed? Next one, ma. Up to here, all the sections are applicable to foreign companies. But 387 to 391 applicable to all the companies incorporated outside India. All the companies. All the companies means including foreign companies. All the companies incorporated outside India means they include foreign company. 387 is about prospectus. Did you remember section 26 contents of the prospectus? As it is, you write it. That's it. Over. Every prospectus shall be dated, shall be signed. Instrument defining the constitution of the company. This is nothing but certificate of incorporation. If it is incorporated in India, we will have SIN. Based on SIN, we will get company information. But here, you give certificate of incorporation which was given by your country. Laws or provisions under which company was incorporated. Foreign company corporate law also you mention. Indian address, nothing but registered office address in India. In India, principal place of business where all the above documents can be inspected. Date and country of company's incorporation. Whether company has place of business in India. If so, principal office address. See, if so means what? If they are not having address, then no need to mention this point. Sir, without place of business in India, can they offer securities in India? Yes. That's what this provision is applicable to all the companies incorporated outside India. It states that matters required under section 26, same applicable. 1, 2, 3 points, ma. These 1, 2, 3 points are not required if the prospectus is issued by more than 2 years after company become entitled to commence the business. Ma, simply when it is entitled to commence the business after incorporation. So these 3 points are not applicable to 2 years old companies. 2 years old companies, these 3 points are not applicable. Only new companies or the companies which are going to get incorporated, proposed companies, for them only 3 points are applicable. Getting my point? It's like, deposits chapter, if you remember, 3 companies CRDA is not applicable. Here also, yes, 2 years old company, first 3 points are not applicable. Reason is very simple, Ignore. Next one. Any condition requiring an applicant to waive compliance with section 387 is void. See, this is also there in section 40. I told you, agreement in restraint of legal proceedings, void. Same point. Next one, ma. Application form shall be issued with a prospectus. Have you heard about abridged prospectus? SAP, security application form, shall always be attached with abridged prospectus. Here also, application form shall always be attached with prospectus. It should not violate section 388. Exception. A form issued in connection with bona fide invitation for an underwriting agreement is permitted. Same point we discussed in underwriting agreement also. Sorry, abridged prospectus also. In case of abridged prospectus, it is not required for inviting underwriters, existing members, and no public offer. Same point here also there. I'm telling you again, this chapter is not a new chapter. This is a byproduct of all the about 10 chapters. Exemptions. 387 does not apply to the prospectus or forms issued to the existing members or securities that are identical to previously issued listed on recognized stock exchange. Try to remember section 26 prospectus. Prospectus is required for both IPO, FPO as well as OFS, but prospectus is not required if an offer is made to the existing members. Getting my point? Or I told you in the marathon session only, I told you, suppose sir, previously I offered 10 crore shares, 97% I got subscription, balance 3% I want to offer right now. So these 3% are belonging to 100% for which already prospectus was issued. Old product and new product, old product. For old product, advertisement required, not required. Getting my point? See, those who are watching only foreign company, first you finish prospectus marathon, then only you will understand foreign company easily. Next requirements for dating the prospectus will apply. There also dating of prospectus there, here also there. Expert statement ma, do you remember? For inclusion of expert statement, 3 conditions to be satisfied. He should not be a person involved in the promotion, incorporation, management of the company. He should give written consent, and such written consent should not be withdrawn until a copy of prospectus has been filed with ROC, and the same should be disclosed in the prospectus. Same conditions here also you can see. Statement by an expert, not withdrawn the consent. Statement confirming the consent is included in the prospectus. Prospectus complies with section 33 and section 40. 33 means abridged prospectus, 40 means stock exchanges. Same conditions will apply. So written consent compulsory, should not withdraw the consent. Okay. Statement is deemed to be the part of prospectus if it appears on the face in this is nothing but disclosures ma. I told you on prospectus you need to disclose the name of the documents which are attached to the prospectus, namely underwriting agreement, expert consent, etc. Next one, registration of prospectus. This is different. In prospectus chapter, filing is enough, but here filing alone is not enough. Registration. So now here the prospectus shall be signed by the chairperson and 2 directors of the company. A certified copy by the company chairperson and 2 directors has been delivered to the ROC, and the prospectus state the face of it that a copy has been so delivered. Prospectus includes any consent to issue prospectus, documents and endorsements. So these are the additional filings. Certified copy from the chairperson and 2 directors. Second one, disclose the same on the face of the prospectus. Also obtain consent from all the parties whose names appears in the prospectus. Documents to be attached. Documents to be attached. On this point, one attempt, I think September attempt only. MCQ came. September attempt. This point. So attachments, consent from the expert. Copy of contracts appointing MD, manager. D point, underwriting agreement. And person who is taking care of all the activities in India, he should be authorized. Whether authorized or not, obtain power of attorney document. Now coming to C point, here 3 points are there. In C 3 points are there. First point, material contracts. See, I'm not asking all the contracts. I'm asking only material contracts, and that too entered last 2 years, not 5 years before, not 3 years before. Entered within last 2 years. And third condition, outside the ordinary course of business. Outside the ordinary course of business. It's not like regular transaction. It's not like a regular transaction outside the ordinary course of business. So 3 conditions. What are the 3 conditions? Contract should be material, important. It should be entered within 2 years before making public offer, and it should be outside the scope of ordinary course of business. And all the appointments of appointment letters of MD, manager, expert consent, underwriting agreement, and power of attorney you need to attach. 5 things. Okay. Section 390, Indian depository receipts. In GDR, I told Indian company, domestic custodian bank, overseas depository. Here roles will change. Company incorporated outside India, one side. Overseas custodian bank. Actually, I told domestic custodian bank, but this time overseas custodian bank. The custody will be outside India. In India, you will find out domestic depository. Actually, there I told overseas depository. Here it is domestic depository. So, company incorporated outside India will make allotment of shares in the name of domestic depository, but the custody is with OCB. And domestic depository will issue receipts to the Indian investors, Indians. These receipts, these receipts are nothing but depository receipts which are getting traded in India, IDR. Now in this entire section 390, it's important to know CG is having power to frame rules, how the offer can be made, what are the disclosure requirements needed, how IDRs are handled in depository, everything. The rules apply to any company incorporated outside India, whether or not having place of business in India. If it is having place of business in India, it is a foreign company. If not, it is not a foreign company, company incorporated outside India. Next one, SEBI guidelines, so RBI directions will also apply. Why? Because currency transaction, currency exchange will be there. And since offer to the public, SEBI, currency exchange is there, RBI. This is a new concept, but simple only. If you remember amalgamation, merger, that's it. Suppose Ford company, Indian company or outside Indian company? Outside Indian company only. Ford came to India doing business. Yes, Ford cars are available. Tata Motors, Indian company. Tata Motors, if they want to acquire Ford or Ford want to acquire Tata Motors, then come and comply section 234. That's it. It's a mergers. See, companies registered under this act, that means domestic company. Company incorporated in the jurisdiction notified by the CG. The CG may, in consultation with RBI, establish rules for such mergers and amalgamations. Prior approval of RBI, a foreign company may merge into Indian company. Prior approval of RBI is required because settlement of purchase consideration in foreign currency. Of course, prior approval from RBI. So purchase consideration can be discharged in cash or depository receipts, or both in cash and depository receipts. If it is Indian company, Indian company issues shares to the selling company shareholders. But here, since foreign company is there, depository receipts. Next one, this section is applicable to all the companies. Simple meaning, all the companies incorporated outside India, whether having place of business in India or not. Next one, 34 to 36. If you remember, 34 talks about criminal liability, 35 talks about civil liability, 36 talks about punishment to the defaulter. Same, these three sections are applicable to foreign companies, companies incorporated outside India, as if they are Indian companies only. So you can see here 34 criminal liability, civil liability, punishment for fraudulently inducing investments. Okay, Mutandis, foreign company, as if it was an Indian company. Okay, next 15th one, 392. See, this is applicable only to the foreign companies, sir. What is this? Non-compliance of this chapter attracts penalty. Suppose, within 30 days you need to file FC1, within 30 days you need to file FC2, within 6 months you need to file FC3, within 60 days of closure of financial year you need to file FC4. Non-compliance, these punishments. Also, name display, for example, display of name improper, this punishment will apply. Next one, 393. Do you remember disabilities of unregistered partnership firm? Disabilities of unregistered partnership firm. Unregistered partnership firm can enter into the contract. Creditor can sue unregistered firm, but unregistered firm cannot sue creditors. Do you remember? That means all the contracts entered by unregistered firms are valid only. They are not void, valid. Unregistered partnership firm cannot take any advantage. Same point, in the place of unregistered partnership firm, insert unregistered foreign company. See here, the point is failure to comply with chapter 22. That means what? If you don't register yourself with ROC, if you don't register yourself with ROC, it will not affect the validity of the contracts. Contracts are valid, but company cannot bring a suit. Company cannot claim set off. Company cannot make counterclaim. Company cannot initiate legal proceedings related to such transaction until those defects are removed. That means creditor can sue unregistered foreign company, but unregistered foreign company cannot sue debtors. Can I proceed? Last but one, without registrations, if someone improperly use foreign company's status, this will be the punishment. This is very simple, ICA is also having same punishment. Suppose I'm not a chartered accountant, suppose, but still if I'm using CA tagline, wherever I'm going, I'm telling that myself chartered accountant. That is nothing but improper use of description. So if a person trades, conducts business under a name suggesting that they are a foreign company registered under the act without actually registered, they will be liable for investigation under 210. Appropriate action will be taken based on the investigation. And last point, this is powers of CG. Powers of CG. It's like self elevation, elevation. CG is telling I'm having superior powers to exempt any foreign company from complying any of the above provisions. That's it. CG may by notification exempt certain class of foreign companies from complying with above requirements. From compliance with subscription offerings, prospectus requirements, related parties in IFSC, related matters in IFSC set up under section 18 of SEZ. It's not C. SEZ Act 2005. SEZ Act. With this foreign company completed. In this entire foreign company, important topics are identification of foreign company, whether it is a foreign company or not. Deemed Indian company, 50% you need to remember, 50%. It's not greater than, it's 50. And next important is, they may ask, what are the documents to be attached along with FC1? They may ask. Next important, display of name. That's it. FC3, FC4 already you remembered, right? Prospectus, any question comes, mix the concept of section 26, 34, 35, 36, you write the points. Over. In preliminary, we are having only two sections, section 1 and section 2. Section 2 is all about definitions. So section 1 is about scope, objective and title of the act. So what is the name of our act? Companies Act 2013. And when it got enacted, it received president consent on 29th August 2013 and it was published in official gazette on 30th August 2013. That means official commencement date is 30th August 2013. Next one, company. What is a company? Company means a company incorporated under Companies Act 2013 or any previous company law. See, Companies Act 2013 is not our first Companies Act. Before also we had a Companies Acts. Namely, the first one is Companies Act 1866, Companies Act 1882, Companies Act 1913, Companies Act 1956. Latest act is Companies Act 2013. Now what the definition of company is telling? Company means company incorporated under Companies Act 2013 as well as companies incorporated under previous company laws. So you all know why amendments are coming. The reason, our environment, our economy is not static in nature, it is dynamic in nature. One live example. Before demonetization, everything we used to pay in cash, but today we are paying in Google Pay, Phone Pay, nothing but online transfers. So business environment, static ka, dynamic ka? Dynamic. Previously, how we used to maintain books of accounts? Manual. Everything, journal entries, posting to ledgers, next summarizing into trial balance, everything is manual. But now books of accounts are in completely electronic form. Yes or no? So when environment is not static in nature, when it is dynamic in nature, our laws should also be revised from time to time. Getting my point? So when lawmaker decides that okay, the old act is completely outdated, now we need to bring a new one which can regulate companies in a modern environment, then they will repeal the old act, they will bring the new act. As a part of it, Companies Act 1956 got repealed, Companies Act 2013 got reenacted. Now the question is, sir, this act came in the year when? 2013. What about old companies? Suppose if you take Infosys, incorporated under Companies Act 1956. If you take Wipro, incorporated under Companies Act 1913. If you take ITC, incorporated under Companies Act 1882. So about these companies, sir, whether new act is applicable or not applicable, to remove that doubt, to remove that confusion, lawmaker came up with this definition. So according to the lawmaker, company means not only new companies that are getting incorporated under New Companies Act, but also old companies which were already incorporated under previous company laws. So according to me, the definition of company means company is equal to new company plus old company. Old company means what? Incorporated under previous laws. That means all the old companies are required to follow Companies Act 2013 the moment the act got enacted. Next one, short title. This act is called Companies Act 2013, nothing but name of the act. Act extends to whole of India. Whole of India means Wherever you incorporate a company within country India, then this Companies Act is applicable. Suppose if a company is incorporated in Russia, our Companies Act applicable or not applicable? Not applicable. And don't apply your GST India definition to my law India definition. Because as per your GST, India means not only physical body but also waters. Yes or no? Up to 12 nautical miles, up to 24 nautical miles. Airspace is also covered. You tell me, can I incorporate company in water within 12 nautical miles, within 24 nautical miles? So don't apply that India definition here. India means here geographical location only. Next one, application. The provisions of this act apply to companies incorporated under this act. This act means Companies Act 2013 or any previous company law. This means our companies only. First one, no problem. First one is about companies. What is second point? Insurance company, banking company, electricity company. I call these three companies as big companies. Big means B for banking, I for insurance, G for generation of electricity. Is it clear? So big companies, to these big companies, whether Companies Act 2013 applicable or not applicable, answer is applicable. But if provisions of Companies Act and respective statutes are in conflict, then respective statutes only you follow. For example, all our companies prepare financial statements in which format? Schedule 3. But for banking, insurance and electricity companies, separate formats were prescribed. Yes or no? Yes. Depreciation electricity companies follow SLM, whereas we follow WDV. Provision calculation, you remember provision calculation? As per Companies Act, we create provisions reasonably. But banking companies, if you see, for provision calculation, they classify assets as standard assets, substandard assets, non-performing assets. Now, whenever there is a conflict between special acts and general acts, we need to follow which act? Special act. Clear? So, insurance, banking, electricity, if the provisions are inconsistent with respect to statutes, follow respective statutes, or else follow our provisions only. For example, banking, insurance, electricity companies act, electricity act, if they are silent on general meeting provisions, then conduct general meeting as per provisions of Companies Act 2013. Clear? Everyone? Next one, any company governed by special act, for example LIC. See, companies are of two types. How many types? Two types. Registered companies, statutory companies. Registered companies means companies incorporated under Companies Act 2013. Statutory companies means companies which came through statute. Companies which came through statute. For example, LIC. LIC Act is there. Our ICA, Chartered Accountants Act 1949 is there. So statutory companies are different. Registered companies are different. Registered companies come under point A, whereas statutory companies come under point E. So here also the same point, unless inconsistent with that act. Clear? Next one, any body corporate specified by the central government through the notification. Tell me, is there any difference between body corporate and company, or both are same? Body corporate company, both are same or different? Same means why two different words? You might have heard about this statement. All companies are body corporates, but all body corporates are not companies. You remember that line, right? See, body corporate and company will have similar characteristics like perpetual succession, separate legal entity. Understood? But both are different. Why? Because body corporate means every incorporated entity is a body corporate. Company means incorporation should happen under Companies Act 2013. Example, body corporate not only covers companies, it also covers LLP, foreign companies, etc. Whereas company means company incorporated under Companies Act only. Are you getting the difference? So that means every company is a body corporate, but every body corporate need not be a company. Let me tell you one more time. Body corporate means an incorporated entity. Suppose you take HUF or a partnership firms, they are not incorporated. That's why they are not body corporates. In body corporate, members liability is always limited. You remember? Okay. So body corporate specified by CG through notification. For example, RBI or ICI. For example, if central government is selling ICI, you also follow Companies Act. Now ICI is also required to comply with Companies Act 2013. So total how many points are there? 6 points. Registered companies should follow Companies Act. Big companies, body corporates, they should also follow Companies Act unless the provisions are inconsistent with the provisions of respective statutes. Next one, body corporate. Yes, just now I covered. Body corporate includes, in interpretation of statutes chapter, we mainly focus on these words only. Includes means, if you find means, it is a complete definition, exhaustive definition. There we are defining the word. For example, if you see company, we are defining the word company. What is a company? But body corporate, here we are not defining the word, we are giving just list of items covered by the word. So here if you see, body corporate or corporation includes company incorporated outside India but does not include cooperative societies, any other body corporate not being a company which CG may by notification specify in this behalf. So did anywhere they define the word body corporate? No, they just gave a list, what are covered, what are not covered. Getting my point? So for the time being, body corporate excludes cooperative societies. That one point you remember. Body corporate excludes cooperative society. This is a futuristic point. In future, CG is having power to prescribe some entities outside the purview of body corporate. But right now, CG didn't exercise this power. As per the Bare Act, as per the provisions of Companies Act, body corporate excludes only one item. What is that one item? Cooperative society. Can I proceed? Next one. Classification of companies based on the members. How many companies we are having on the based on members? Tell me fast. On the basis of members, how many companies we are having? 2 or 3? 2 or 3? Answer is 2. Private to public. OPC is one type of private company where minimum and maximum number of members is 1. Getting my point? OPC is a private company with minimum and maximum number of members 1. So we are having only 2 types of companies. Don't worry, this kind of questions in exam they won't ask. Okay, fine. So we are having 2 companies, private to public. Public company definition very easy. Public company means it's a company which is not a private company. A company which is not a private company automatically becomes public company. And minimum paid up share capital as may be prescribed. When Companies Act 2013 was enacted, minimum paid up share capital they fixed 5 lakhs. But later they made amendment, they removed the word and they've mentioned it as we will prescribe in future. So far they didn't prescribe. Okay. Next one, B point, I'll discuss with you after private company definition. So public company means a company which is not a private company. Then what is a private company? What is a private company? Respond. It is a company in which by its articles of association restricts, limits, prohibits. Getting my point? AOA of a private company should contain 3 clauses. One is restricts, limits, prohibits. What is restricted, what is limited, and what is prohibited? Important. Restricts what? Transfer of shares. Restricts what? Transfer of shares. Private company AOA should contain 3 conditions. Restricts, limits, prohibits. Restricts what? Transfer of shares. Tell me what is the name of company? Private company. Private means privacy, confidentiality. You tell me to maintain confidentiality, members should be fixed. Members should keep on changing. Members should be fixed. If members, if members are coming freely, members are going out freely means whatever decisions they are taking, will they maintain confidentiality? Secrecy will be lost. To maintain privacy, transfer of shares is restricted. Don't write prohibited. Prohibited means not allowed. Restricted means allowed subject to conditions. What conditions? You have to take approval of board of directors. You have to transfer shares to the existing members. What consideration? Consideration will be fixed by directors, which will be certified by the company auditor. So there will be no biasedness. There will be no biased in fixation of the price since auditor is certifying the price. Getting my point? So shares transfer is allowed subject to conditions. That's why restricts. Next one what? Limits. Limits number of members to. When I read Companies Act 1956, the limit is 50, but now they increase it to 200. Trust me, I don't know how 200 members group is a private. Because if you call all of your relatives, if you count them, maybe some 80, maybe some 100. Yes or no? Okay, lawmaker fixed 200. Why 200? There is no logic. But you have to remember 200. While counting 200, two groups are excluded. Can you tell me who are those two groups? Present employees who became members during their employment. And second group is past employees who became members during the employment. Because to promote the concept of ESOP, employee stock option plans. Clear? Today, you ask your seniors, or sorry, you ask your brothers, sisters, elder brothers and elder sisters. Company, if they are giving a salary of, say, for example, 20 lakhs, entire 20 lakhs they won't pay in cash. Some portion will be credited to shares. They will give some portion in cash, some portion in company shares. Why? Because these startup companies, to manage working capital, some portion only they will pay in cash to the employees. Balance portion in future they will credit shares to the employees under ESOP, under employee stock option plans. Clear? So next one. So present employees and past employees are excluded. And joint shareholders. Joint shareholders means if a one share certificate is held by two or more members, then we call it as joint shareholding. Suppose simple see this property, only one owner is there, sole owner. Two owners are there. Joint property, joint ownership. Now for the purpose of this count 200, they will be not counted as 2, they will be counted as 1. Getting my point? Everyone, just answer my question. A Limited, this is a public limited company. As per register of members, total 240 members are there. How many members are there? 240. Now management of A Limited wants to convert A Limited to A Private Limited. They want to convert public company to private company. So for this they are asking whether with these 240 members possible or not possible. And also they are giving some points. Joint shareholders. 20 couples are holding shares jointly. Next one. Some 15 employees who were retired, they are also members of the company. They became members during their employment period. And some 20 employees, these people are present employees and these people became members of the company during their employment period only. Now you tell me, with these numbers, without any reduction, conversion possible or reduction is compulsory? Are you getting my question first? So they gave some data as per register of members 240 and they gave some points. They're asking you whether reduction is required for conversion of public to private or not, they're asking. Now let's see. As per register of members, how many? 240. Joint shareholders 20. Couples means 20 into 2. So I think 20 into 240 are included. But we need to include how many? Only one from that couple. So 20 into 2, I'll exclude total 40 and now I'll include 20. That means I'm removing 2, adding just 1. Past employees who became members during employment excluded. Next one, present employees are also excluded. Getting my point? So 240 minus 40 plus 20, that means 220. 220 minus 15, 205, 185. Getting my point? So care to be taken at this point. At this point, care to be taken. Not all past employees are excluded. Only the past employees who became members during employment period. Suppose sir, Mr. X is an employee. After retirement from employment, he became member of the company. Now included or excluded? Included. Is it clear? Only who became members during employment are excluded. Next, joint shareholders are counted as 1. Next one, prohibits. What is the next point? Prohibits. What is prohibited? Allotment to the public prohibited. Invitation to offer to the public is prohibited. Invitation to offer. First you don't invite them. If you invite them, next step is allotment. First you don't invite them. Don't go to the public. Don't ask for subscription of securities. Why? You're a private company. You enjoy lot of relaxation. And if you want to play games with public company, how it is possible? See, actually when Companies Act was there, when company concept came, only public company is there. Private company concept is not there. Suppose a group of 40 individuals like you came to me and you are asking, sir, we want to start a business, sir, which one is beneficial? Partnership, unlimited liability, joint and several liability. Company, limited liability, separate legal entity. Now every one of you, what you think? Oh, limited liability, company is better. No. Then I'm telling 470 sections are there. Now what you will tell? Sir, we are having only 365 days, sir. Complying 470 sections means when to do business, sir. This much complaints burden don't keep on us. We will go with partnership only. But from government point of view, if you do business under partnership, for government heavy loss. Why loss? If you are a company, registration is mandatory. That means government will have close monitoring. Yes or no? Transparency will be there. Or how many business entities are there? Government can easily monitor you. But if you are a partnership firm, tell me, partnership firm registration mandatory or optional? How government can see you? So government point of view, you associations should come under Companies Act. But at the same time, asking you to comply 470 sections. Yes or no? Are you getting my point? So private companies, when compared with public companies, they enjoy lot of relaxations. Complaints burden is very less. That's why lawmaker is asking, you do business under company type of organization, but don't do business with public money. For that, what point they're telling? Prohibits invitation to public to subscribe your securities. Getting my point? You tell me, how will you categorize, how will you identify whether a company is private or public? Come on, fast. How will you identify whether a company is a private or public? Why name? Because government company name always ends with limited, whether it is a private or public. Section 8 companies won't use word private limited or public limited. Then how to identify whether company is a private or public? Go through AOA. In AOA, if you find these three conditions, it is a private company. In AOA, if you don't find these three conditions, then it is a public company. Clear? Everyone? So tell me, private company, three conditions. Restricts what? Transfer of shares. Limits what? Number of members. Prohibits what? Invitation to the public to subscribe its securities. Next one, in public company, there is one more definition. In public company, 2 points are there. A company which is not a private company is a public company. And second one is, private company is also a public company. What? Private company is also a public company. Sir, when, sir? If it is a subsidiary to public company. Say for example, C Private Limited, one company is there. Paid up share capital of the company is 10 lakhs. In this, 6 lakhs was held by D Limited. D Limited. Then automatically C Private Limited becomes public company. Why? Because D Limited should comply with all 470 sections. That's why they will frame a loophole. They will incorporate a private limited company which is subsidiary to them. This subsidiary private company, they will have a lot of relaxation. So using this subsidiary tool, they will try to play games. And our lawmaker, as a matter of precautionary measure, what lawmaker is telling? See, private limited, even though as per AOA you are a private company, I will assume you as public company, deemed public company. Sir, can I offer securities to the public? No, your AOA contain prohibition. Can I go beyond 200 members? No, your AOA is having 200 only. Can I get relaxation like a private company? No, because you are a deemed public company. No confusion. You will have only disadvantages of private and public. That's it. Getting my point? Tell me, like this companies will exist, or this is just a precautionary measure? Precautionary measure. Once again, I'll repeat. See, the reason for this point is, precautionary measure. These kind of companies will have only disadvantages of private and disadvantages of public. If you ask that company, can you make public offer? AOA prohibited. Understood? Can it enjoy freedom like private companies? No, because it is deemed to be public company. Next one, small company. Many students are having a problem with small company. Sir, recently amendment came. No, sir, 1st December. What are the limits, sir? What are the limits you heard on 1st December? Paid up share capital 10, turnover 100. But for May 26, those limits will not apply. For May 26, 4 crores, 40 crores only will apply. Okay. So let me read this definition. Small company. It is a company other than public company that meets the criteria. Paid up share capital 4 crores, turnover 40 crores. Now just answer my question. There is a company, Joya Lucas. Have you heard about name Joya Lucas? Joya Lucas Limited, paid up share capital 1 lakh, turnover 10 lakhs. Is this a small company or not a small company? Smaller, not a smaller? Not a smaller. Or look at the name, bro. Joya Lucas Limited. Everyone will focus on limits only, I know. But what about this condition? Everyone will remember 4 to 40. But there is one more condition. That company should not be a... Sir, in exam I wrote everything correct only, sir. That fellow is not giving marks, sir. Yes, in your previous or your ancestors and their parents are having a problem. Revenge story. That's why he is not giving marks. You understood my question? What is the name of company I told? Joy Lucas Limited. Is it a private limited or public limited? Public limited company. Public limited company, even turnover 1 rupee also. Paid up share capital 1 rupee also. It is not a small company. To become a small company, 3 conditions to be satisfied. How many? 3. What is condition number 1? Other than public. Other than public. Second one, paid up share capital up to 4 crores. Turnover up to 40 crores. Another interesting question I'll ask. Another interesting question. Sir, financial year 22-23. This time, A private limited only. What? A private limited. Financial year 22-23, turnover is 20 lakhs. Paid up share capital is 2 lakhs. Now you tell me, for financial year 23-24, is it a small company or not a small company? Small or not a smaller? Tell me. Yes, small company. Yes, small company. In financial year 23-24, turnover 50 crores. Paid up share capital 2 lakhs only. Now, for financial year 24-25, what is the nature of the company? Small or not a smaller? Tell me, small or not a smaller? Smaller? No. Answer me. So, not a small company. Why? Turnover already crossed 40 crores limit. So, not a small company. Understood? Everyone? Next, for the financial year 24-25, turnover is 5 crores. Paid up share capital is 2 lakhs only. Now you tell me the status for financial year 25-26. Is it a smaller, not a smaller? Smaller, not a smaller? Smaller, not a smaller? For that only you have to read the definition carefully. Immediately preceding financial year. For 25-26, when you are checking, you have to go through preceding financial year means 24-25. What is 24-25 turnover? 5 crores, within the limits only. Therefore, it is a small company. Don't think like this. Once status is lost, forever it will be lost. No, 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 no. You have to check every year based on preceding financial year figures. Hello? Everyone. Everyone. You may get a doubt, sir. During 23-24, when turnover crossed, from the mid of the year, will it lose status? No, 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 no. For that year, it remains the same. As on 1st April, if you are a small company, till 31st March, you will be small company only. Coming to the next year, you will go with the immediately preceding financial year estimation. Parameters. Everyone. So, small company status depends on immediately preceding financial year parameters. Suppose 25-26, again sir, turnover 60 crores sir. Paid up share capital 2 lakhs only. Now 26-27, what happens? It is not a small company. Suppose that year turnover came to 6 crores sir. Next year it is a small company. Okay. So up to May attempt, May 26, remember 440. And those who are writing for September 26 attempt onwards, for them the revised limits will apply. For them paid up share capital limit is 10 crores, turnover limit is 100 crores. Okay. Sir, why these concepts are small company? Why this concept? Compared with public company, private company had relaxations. Compared to private company, small company will have more relaxations. This is just a biscuit by lawmaker. That's it. Biscuit. It's like a, yes, motivation biscuit only. As long as you do business in partnership type of organization, we can't monitor you. But if you come and join under Companies Act, we can easily monitor you. After completion of year, we will send reminders to you. Come on, file your income tax return, pay your tax. If you are a partnership firm, will you get such kind of messages? No. That means government is losing revenue. Yes or no? That's it. Remember, laws you need to understand in two ways only. One is because of this provision, how much amount government is getting revenue, or because of this measure, because of this provision, how public is getting protected. Only these 2 points for every law. These 2 points only base. Income tax, when I'm a student, when I read Income Tax Act, whenever I read a provision, government is getting more tax. Okay, government is very hungry. If government is giving a benefit, middle class families up to 12 lakhs exempted means, so next election government is getting more votes. That's it. Only these 2 points. Clear? So law, whenever you are reading it, you should understand how public is getting protected or how government revenue is getting increased. That's it. Fine, ma. So small company over a, yes, exclusions you have to remember. 5 companies are excluded from small company. How many? 5. Can you name them? Public company, holding, subsidiary, section 8 statutory. Statutory companies. Statutory companies means what, sir? Companies or body corporate governed by a special act. Can I proceed? Remember exclusions. On exclusions only they may ask a question. Beautiful question. If they want to narrate, they will ask like this. Beautifully they will narrate, ma. Yes, private limited, one company is there. Its paid up share capital is 10 lakhs and turnover is 20 lakhs. Out of these 10 lakhs, 5,50,000 shares are held by some C private limited. Now guess the status of, or what is the status of S private limited? Is it a small company or not a small company? Small or not a smaller? Not a small. Why? 5,50,000 shares held by C private limited means it is a subsidiary. Subsidiary holding. Section 8 companies, statutory companies, 4 are excluded. And by virtue of first point, public company is already excluded. So that's why total I told 5 companies are excluded from the definition of small company. Next one, associate holding subsidiary companies. These companies were classified on the basis of control. On the basis of control, companies are classified into 3 categories: holding, subsidiary, associate. Easiest definition is holding company. A company in relation to one or more other companies means a company of which such companies are subsidiary. He is telling there are 2 companies, ma, A limited, B limited. A limited will be called holding if B limited is subsidiary to A limited. So tell me, a person, when can he become a father? If he is having children. Yes or no? When a company can become holding company? If it is having subsidiary. That's it. That is the meaning of the definition. So nothing to learn, but this point is important. In this clause, company includes body corporate. So holding company status is given only to the body corporate. For example, Mukesh Dhirubhai Ambani sir, you know him, right? He is having some 50.1%. Actually, it is 49 only. Example purpose I am telling. 50.1% of control in Reliance Industry Limited. Now, can I call Reliance is a subsidiary to Mukesh sir? No. Why? Mukesh sir is individual. He is not a body corporate. Therefore, Reliance is not a subsidiary. To call a company as a subsidiary, its holding person should be a body corporate. Next one, subsidiary company. A company is a subsidiary of holding company if the holding company, 2 conditions they told, any one of the condition to be satisfied. C1, C2. What is C1? What is C1? Control over composition of board of directors. Control over composition of board of directors. And what is condition 2? More than half of the total voting power. More than half of the total voting power. See, I can control company in 2 ways, ma. I can control company in 2 ways. One is, if the company directors are listening to me, that's it, that company is under my control only. Getting my point? For that, composition of board of directors means majority of the directors. Majority of the directors of the company, appointment power, removal power. If I am having, I'll be holding company, that one will be subsidiary company. Why? Because of course in company supreme power is with members only. But day-to-day affairs, who will control? Management. Getting my point? So if I can control management, obviously that company will be under my control only. Second one is more than half of the total voting power. In that company, if I am having 60% of the voting power, then myself will be treated as holding company, that company will be treated as subsidiary company. Logic very simple. In general meetings, for major decisions, except few things, all the decisions require what type of resolution? Ordinary resolution. Ordinary resolution equation means votes in favor greater than votes against. If I am having exactly 50% voting power, you tell me, all others having 50%. Now if I want to approve the decision, they want to reject the decision, 50 will be in favor, 50 will be against. Or passed or not passed or not passed. So if I have more than half, I can control the company, I can take the key decisions. Getting my point? Here again I'm telling, I means not individual, I means a body corporate. Can I proceed? Again, this control is of three types: direct, indirect, direct plus indirect. Suppose A Limited is there, 60% of the paid up share capital of B Limited, A Limited alone is holding. Now B Limited becomes direct subsidiary. Suppose B Limited is holding 55% of paid up share capital in C Limited. Now C Limited is subsidiary to B, it is also subsidiary to A. You tell me, is A having anything in C? No. But still A is holding to C. C is subsidiary to A, because C Limited AGM, who will attend? B Limited will attend, other members will attend. B Limited is already controlled by A Limited. That's it. Getting my point? Everyone. VIP movie, VIP 2 movie. Did you watch the VIP 2 movie? Dhanush sir, Kajal man. In that movie, if you remember, I think VIP Constructions Private Limited is the name of the company they incorporated. In that actually Balaji is having 50% stake, Raghuvaran sir is having 50% stake. Due to some accident, Raghuvaran sir shares and Balaji sir's 25% share capital was sold in the open market. Who acquired these shares? Initially villain madam. Who is she? Vasundhara Constructions, right? Did Vasundhara Constructions completely acquired 75% or they acquired through the sister concerns? Through the sister concerns. You remember that point, right? Now total how much madam is having? Direct plus indirect? 75. With that 75, she fired Raghuvaran sir from director position. Yes or no? That means Vasundhara Constructions become holding company. VIP Constructions Private Limited becomes subsidiary company. Did you understand? So that person followed our provision. The director followed our provision. Yeah. So with this subsidiary company definition not yet over. Up to here I completed. Important point is C. B already explained. Appoint or remove majority or all the directors of another company. Then it is said to be controlling the company only. C point you understand. If I am the paper setter, I'll frame a beautiful question on C point for 5 marks. What is the C point? Read it. Shares held as a trustee or in a fiduciary capacity do not make a company a subsidiary. Now listen to my example carefully. Our company is C Limited. Our company is C Limited. In C Limited, A Limited is holding 47% of the paid up share capital. For the time being, paid up share capital, voting power both are same. Like that only you remember. Because in section 43 we will read a new point, that is differential rights. Until differential rights comes into the picture, each share gives equal voting power. Only after differential rights voting power will differ. Okay, after section 43 we will discuss it, but for the time being voting power, paid up share capital both are same only. So A Limited is having how much control in C Limited? 47%. A Limited managing director, he is holding 5% paid up share capital of C Limited. Understood? Managing director of A Limited, holding 5% of paid up share capital of C Limited. Now can I add this both? 47 plus 5, 52, can I add like this? No. Why? Because there is no relationship. Because there is no relationship. MD is not a sister concern to A Limited. MD is not a subsidiary to A Limited. So you should not add like this. Now the point is, one day MD got heart attack 1. Immediately he got 2 also. Doctors warned him, sir, next 1 hour you are going to get third heart attack also, sir. Meanwhile, MD called his lawyer, personal advocate. He told that he's having a son who is 16 years old fellow. Until this fellow get majority, that means 21 years, for the purpose of getting assets, 21 years is the age of majority, or 21 or 18, whatever it might be, don't fight for that number. Now until his son gets 21 years of age, the legal trustee or legal guardian or legal representative for his son will be A Limited. Like that, he wrote a will and he died. Because of that will, who became owner of this 5% shares? A Limited. Now A Limited is having total how much paid up share capital in C Limited? 47% plus 5%, total how much they are having? 52. Now can I tell C Limited is a subsidiary to A? The answer is no. Why? Look at the point once again. Trustee, fiduciary capacity do not make a company subsidiary. This 47%, their right, they can exercise votes in favor or against, it's up to them. But this 5%, they should take decision which is beneficial to son of late managing director. Are you getting my point, everyone? So the shares which a company is holding in a fiduciary capacity as a legal representative shall not be considered for determining the status. Can I proceed? The same point you will also see in associate company too. Same point. So don't mix up 47 plus 552, no. So subsidiary is there. No. Shares held in fiduciary capacity, you need to exclude it. Next one, associate company. Associate company. The difference between subsidiary and associate, if you look at the definition, here the word control is there, but here significant influence. When can I say control? More than half. Significant influence means at least 20%. At least 20%, but should not be subsidiary. That means if you take a scale of voting power, scale, this scale represents voting power. 20% up to 50%. This range is associate. Greater than 50%, this range is subsidiary. Sir, what about this range, sir? No relationship. So tell me, can a company become both associate and subsidiary to another company? No. Either it should be associate or it should be subsidiary. Suppose A Limited, B Limited, relationship, A Limited, B Limited. 60% is there, sir, then subsidiary. Sir, only 40% is there, sir, then associate. Sir, here can I write associate and subsidiary? No. Here can I write subsidiary and associate? No. Because associate company clearly excluded subsidiary company. Clear? Associate company also includes joint venture companies. Next, voting power, how will be determined? Total number of votes that can be cast in a poll if all eligible members are present and vote. So simply, number of shares, imagine each share is giving 1 vote. Imagine number of shares equal to number of votes. They're also writing an assumption. If all the members attend the meeting, if all the members vote at the meeting, what would be the total voting power? In that, more than 50 subsidiary, at least 20 but not exceeding 50 associate. That's it. So far, these 2 points were not tested. Exceptional point means asking question on these 2 points only. Next one, foreign company, government company. Tell me how nationality of a company is decided. Nationality of a company. Place of incorporation, nationality of the subscribers. Suppose these Korean people all are like same faces only. Yes or no? Roti faces, chapati faces. Now you tell me, Korean people came to India, incorporated company in India. Is it a Korean company or Indian company? Sure? Yes or no? Yes. Example, Kia Motors you see. South Korean people came to India in the state of Andhra Pradesh. They established one company, Kia Motors India Private Limited. Now even though 100% of capital is held by foreign people, it is still an Indian company only. Everyone. Meta company is there, right? You remember Meta, which is providing platforms to WhatsApp, Telegram, Instagram. That was incorporated outside India, but providing business services in India. That company is a foreign company. So foreign company means company incorporated outside India, having place of business in India. Two conditions to be satisfied. Incorporation outside India, place of business in India. Suppose sir, place of business also outside India, sir. Then it is just a company incorporated outside India. Everyone. Pepsi, if you remember, I think on Pakistan cricket jersey you will see Pepsi. But it is having business in India also. So Pepsi becomes what? Foreign company. Amazon, foreign company. Flipkart, Indian company. Of course, Amazon opened one company in India. That Indian subsidiary is a Indian company only. Whereas the parent company is a foreign company. Simply you see the SIN. If SIN is 21 digit alphanumeric number like our Indian number only, then it is an Indian company. Next one, government company. What is meant by government company? What is meant by government company? It is a company in which at least, sir, in subsidiary they told more than 50. In government company they are telling at least 51. Why these many limits? Answer is very simple. You are reading entire law, but don't imagine that only one person wrote entire law. Many people wrote provisions. For one fellow, more than 50 he kept. Another fellow kept at least 51%. But you have to remember all the limits. Okay, everyone. So tell me, what is the limit in case of government company? At least 51% of paid up share capital held by central government or one or more state governments or combination of central government and one or more state governments. Then it becomes a government company. Have you heard about public sector companies? PSU, public sector undertakings. So what is a public sector undertaking? Is it a public company? That means all public companies are public sector companies. Yes or no? No. Public sector companies means government companies. IOC, BPCL, HPCL, BSNL, all these are public sector undertakings, but before that they are government companies. Whereas you take Reliance Industry Limited, Vodafone Idea Limited, Jio Infocom Limited, all these are held by private individuals like me, like you. Getting my point? So if control is with government, PSU. If control is with private individuals, it is private sector undertaking. So there is no similarity between private company and private sector undertaking, public company and public sector undertaking. Why? Because you can see Reliance Industry Limited is a public company, public sector, public limited company, but it is not public sector undertaking because majority of capital is with government or private individuals. Private individuals. Clear? Everyone. Now you tell me, government company means who will hold the shares? BJP. Right now ruling party is BJP. No? Do you think BJP? No. President of India. State government company shares are held by governor. Suppose sir, our president madam needs some 10 lakh rupees. Can she sell shares of IOC? Madam need money. Madam want to sell the shares. You told president of India is holding shares. No. As a president, can't she sell the shares? No. For that, they need to prepare a bill to be introduced in both the houses, Lok Sabha and Rajya Sabha. Money bill. Okay. And technically we call it as privatization. So under privatization, public sector companies will become private entities. Okay, that is a different procedure, but for the time being, yes, president will hold on behalf of central government, governor will hold on behalf of state government. So remember this one, CG, SG or SGs or combination. One example, just example. A Limited is a company in which government of India is having 20% control. Government of Tamil Nadu is having 20% control. Government of Karnataka is having 20% control. Now is A Limited a government company? Yes. Yes. But in examination they may ask you question like this. Previously they asked a question, remember. But before that, just read this B point. Just read this B point. Includes a subsidiary company of a government company. Government company also includes subsidiary of a government company. What it mean? Suppose A Limited is having 50.9% control in C Limited. Now C Limited is a subsidiary to A. Yes or no? C Limited is subsidiary to A. A is a government company. Automatically C also becomes government company. Clear? Any doubt? But in examination, one time they asked a question like this. Government of India is holding 48% in C Limited. And IOC, in which Government of India is already holding 55% of voting power. And IOC is holding some 3% in C Limited. Are you getting my question? Now whether C Limited is a government company or not a government company? Government or not a government? Let me repeat question one more time. IOC is a government company, already declared, decided. C Limited, in which 48% of capital was held by GOI, 3% of the capital is held by IOC. Now my question, whether C Limited is a government company or not a government company? Government or not a government? Because if you look at the definition, they clearly told central government, one or more state governments, both central government and state government. IOC is not a government. Getting my point? In the definition they didn't told government plus government company. If they told, then you can calculate 48 plus 351. Therefore C Limited is also a government company, like that you can tell. But in definition it is not there. But if you understand logically, C Limited is already a government company. Why? Because controlled by both government as well as IOC. Just look at this point. Yeah. Logically it's a government company, but as per definition it is not a government company. Next one, this point I'll discuss with you in section 43. This is a benefit. Suffix private limited, limited not required for government companies, provided they have not defaulted in filing financial statements or annual returns with ROC. Government company names always ends with limited. The discussion with respect to this is already over. Can I proceed? Companies based on the liability. See, no confusion at all. In examination, if this point comes, if this point comes, straight away you have to tell it is not a government company. Sir, you told logically it is a government. No, sir. But as per definition, it is not a government company. So in exam, you have to write the definition and you have to tell it is not a government company. Next one, last concept of preliminary chapter. Companies based on liability. How many types? Limited by shares, limited by guarantee, unlimited company. Limited by shares. A liability is limited to the extent of unpaid value. In share, you will find face value and you will find paid up value. So face value minus paid up value, it will be unpaid value. Unpaid value multiplied by number of shares held by the each and every member. Clear? So in company, there is no concept of joint and several liability. Sir, what is meant by joint and several liability? In partnership, you can remember, in partnership, every partner is liable not only to his share of liability, but also his partner's share of liability also is liable. You remember, right? If any one partner become insolvent, if any one partner become unsound, then that partner's share should also be borne by remaining active partners. Remaining solvent partners. But in company, it is not like that. If I am holding 20 shares, unpaid value 2 rupees, my liability is 40. You are holding 2 million shares, your liability would be 4 millions. If I am not paying amount, you are not liable for my share. If you are not paying your amount, I am not liable for your share. So no joint and several liability, and there is only maximum liability, individual liability. Limited by guarantee, here you won't find a shares here you'll find only guarantee. At the time of incorporation of company, every member will make a promise. Tomorrow if company enters into the liquidation, if company assets are not sufficient to meet the liabilities, then we will contribute this much amount. We are liable to this extent. That is nothing but guarantee. Next one, unlimited companies, there is no liability at all. Sorry, there is no limit on members liability. You may get a doubt, sir, what is the difference between unlimited liability companies and partnership firms? So tell me, unlimited company, partnership firms, same or different? Different. Separate legal entity concept is not there in partnership. Everyone, but the similarity is unlimited liability. Maybe 1 out of 1 crore companies can be unlimited companies. 1 out of 1 crore. Practically no one will register unlimited companies except very few, uh, according to their estimation there will be no loss in that business, want to maintain more confidentiality compared with private company, those people will incorporate unlimited companies. That's why I'm telling 1 out of 1 crore companies will be unlimited companies. Clear? With this preliminary completed.